Hello and welcome to the third virtual Tradier Cboe Summit, the Halloween edition. Today we will hear from many distinguished guests as we tackle technical analysis and trading. I'm your host and moderator, Lex, and we'll be moving us along today. Incidentally, we have a large Spanish-speaking community with us today, so to you, bienvenido, nos alegra que estés aquí, esperamos que disfrutas del evento. All right, before we meet our first speaker, let's go over some of the ground rules and some of the items that we're going to see today. We encourage you to ask questions, okay? Make comments. It's in the comment section on the YouTube channels. I'll do my best to get through them. We have Kayla working with us and some others. I know we're on a tight time slot, but we'll try to get to all the questions. We will have several giveaways today, including the shirts that are going to be on my back. However, they'll be real ones that I haven't worn, so they'll come in a package. So what we're doing is our gentleman, NikkiClothing.com, that's Nikki, SEA, clothing.com, is giving everyone a 20% off who goes to the site to buy them. But we are going to give these away during the course of the day. We're also going to put $100 into your Tradier brokerage account if you are a lucky winner on the wheel. You must be present and you have to answer a question before each break to be included in the giveaway. All right. Lastly, for now, we will have those three breaks. The first one's 10 minutes. The second two are 5. I encourage you on the 10-minute one to go grab a bite to eat. And we are looking for a great day. All right. So let's get going. It's going to be a great one. All right. So we're going to jump in with our first guest, who is our CEO from Tradier. And I'd like to welcome Dan Raju to the event. He's a veteran and expert in the retail brokerage space. He's been a 25-year veteran technologist entrepreneur, and he's led Tradier to be one of the most powerful and innovative brokerage enterprises in our space. And we're powering over 200 companies globally. Dan, welcome aboard. How are you, man?
Hey, I'm doing great, Lex. How are you?
Good, good. So you get the distinction of giving us the welcome address today. So I know we're going to hear some great things about the retail space. I'm going to jump out and give it to you solo so we can keep it moving, okay?
Perfect. Can you see? Can everyone see my screen?
Let me share that for you. I might pop back in here, but I'm going to remove myself too. So, okay, we can see it now.
All right. Hey, Lex, thanks for hosting the show. Really appreciate it.
Sure.
Hey, hi, everyone. My name is Dan Raju. I'm the CEO and one of the co-founders of Tradier. Welcome. This is the third Tradier Cboe Summit. And super excited. It's already the third. I thought we just started this earlier this year. And this is the third, and this is the biggest we have done so far. Thousands of registrants. Super excited. There's one reason why we like doing events like this, and that is because of our commitment to education. We've always, from the very first day we started the firm, it was about how do we do everything to empower the retail investor in ways like it has never been done before. And so education is where we find tremendous satisfaction in doing that, right? And we find a great partnership in Cboe who thinks like us, who believes in the same things that we believe in, and has been a great partner. And we hope to educate people with some of the best content that we can help bring to you. So welcome to the event. I'm going to say a few words before. We've got some great speakers today. So I'm just going to say a few words. Wanted to say a special thanks to all the Tradier partners, customers, tens of thousands of account holders who are at Tradier, who basically trust us to engage with the markets every day. We have grown today to be one of the larger brokerage firms. We're probably one of the fastest, or if not the fastest growing options broker in the country. And all this is done just because of you. It's because of what you bring to the table for us every day, and that motivates us to do better and better things every day. It's just not that kind of a firm. We don't promise to change the world every day. I mean, first of all, the world does not need to be changed every day. But we get up in the morning and we do one simple thing. We measure twice, cut once, and bring you the best technology, platform, and service that you can ever get. And so thank you so much. And, from the very first day, we said always do the right thing. And this is a part of our effort to do the right thing for everyone. Thank you. Thank you so much. Before I wanted to actually say a few words. We got some great speakers today. I'm not going to waste too much time in diving any deeper. I've got people more capable than I am on technical analysis to walk you through the day. But I wanted to share with you today, what we are observing on the ground. What we are seeing a rapid graduation effect in the market. Retail investors are graduating to more complex, more advanced, more sophisticated strategies, instruments, classes, a way they interact with the market like ever before. More percentage of the market is engaged in more advanced and active trading like ever before. Here are some solid facts. 18 million new accounts since 2020 have jumped into the brokerage market. I mean, if you think about it, it's 18 million new people have jumped into the market since 2020, right? 9 million new options traders since 2021. After 2021, 9 million new traders have started doing options trading, right? Thousands of new platforms are being created. This world of a brokerage firm offering a vertical platform is being replaced by more younger, nimble, agile platforms. Thousands of them who basically cater to the needs of the customer than any of the large brokers ever can, right? Thousands of educators. I know we have focused on education today. Great education. The pandemic has initiated an era of active trading, and I just spoke about the percentage of people who are engaged in active trading. And I generally call active trading as people who trade more than 3 to more than 10 times in a given month. And I've been vocal about this and volatility, and some of it is largely introduced by the trickle interest rates of the Fed, but net they create a lot of volatility, right? And this situation in the market has created a very, very different kind of a retail base. A few observations on that. There is a massive dichotomy that we see in the market today. Active traders are more engaged than ever before. Active traders are accounts with slightly more higher account values, more cash in their accounts, engage more actively. They are more active in their accounts than ever before. They find tremendous opportunity in the volatility, while the early stage accounts that are smaller, accounts that are less than $1,000, first time investors, they're largely in a big way hold up a little bit, right? They're kind of tapered off. But the reason the market volumes are still on the high side is mostly driven by the engagement of these active traders. Adoption of options continues. Henry is going to talk about this, so I'm not going to say anything more, but adoption of options continues. And there is a growing appetite for platforms and education. That's what we see in the market today. Tremendous amount of appetite for education. And so that's what we're all trying to do. We're trying to get the best education in a market that is changing landscape, both for geopolitical, regulatory, new asset classes that are coming in for all that. But at the end of the day, what is going to let us travel through this is good education. And that's the key. So a couple of days back, I said, let me actually talk to some of the best educators that we're engaged with, and hopefully I can share how retail consumers are consuming the education they give them, and what are they really asking. So I thought that was an interesting thing that we can share. The key word that I heard from everyone is education that is collaborative is consumed very well. Customers are demanding a blended education which has on-site, online, and trading rooms all combined. Tremendous a blended concoction kind of an education is massively consumed. And I can, in fact, Michael, who's going to speak next after me, and I were chatting the other day. This is there's tremendous amount of need in the market for platforms that actually have two-way communication. This top-down, push-down education or content is kind of getting stale, right? So that combined with blended on-site and online and trading room kind of a communication is huge. Personalized. Traders are demanding personalized education. One interesting thing, as if any of you guys have noticed how big Discord has become in this market, for at least if you're dealing in the trading side, bite-sized learning is huge, right? And people are demanding bite-sized learning, and the key element of bite-sized learning is it's continuous. People want to be a part of a community, and people largely want to be a part of a community, And at the end of the day, one key observation that we learned is they want education at the point of impact. So when they're the part of the research and analysis platforms, as they're trying to get their edge, as they're trying to make a decision, education embedded into those locations is huge. So as we are trying to deliver good education, here are some feedback that I thought we got from some of our educators. And I thought, and that's what this event is about, trying to get the best education. And so I'm just going to pause there. We've got some great speakers today, guys. We got Lex, my dear Lex. I hope he doesn't change his shirt every time like he did last time, but I can't wait to see what he's going to do. But then we've got Carter, Michael, both of these folks from CNBC, great friends, great partners. Really, I'm looking forward, like everyone else, to what they're going to say. We've got Henry, always the best. Rob, Rick, Don, my friend from Theo, Chuck, Jason, my old friend Pete. I can't wait to listen to all of you folks. By the way, do not forget my friend Mr. Stefan, who's going to talk about crypto. So great lineup. We put a lot of effort to get this to you guys. I hope you enjoy it. It's going to be fun. I'm just going to join the rest of you guys to see what these great speakers are going to say. I'll talk to you guys at the end. Thank you so much. I hope you guys really enjoy it.
Thanks, Dan. Great job as always. We'll see you at the end. Okay.
Okay.
All right. Very good. Next up is our keynote address and presentation. So we have a dynamic duo for you today. We have two distinguished speakers who will teach us about charting and using charts and technical analysis to create your options trading strategy. I'm going to let them get into it, but first let me introduce. First, Mr. Carter Worth, CEO and co-founder of Worth Charting LLC. Carter's been in the business like about as long as I have, 32 plus years on Wall Street and a regular guest and co-host of CNBC's Options Action. He holds the distinction of being ranked as one of the top 3 technical analysts on Wall Street. Next, our good friend from Summits Past, Mr. Michael Khouw. Michael is a 20 plus year veteran of the financial services industry with broad experience as a strategist, an analyst, portfolio manager, proprietary traders of equities, commodities, index and equity derivatives, both buy-side and sell-side firms for him. He's Mr. Options and also a frequent guest on CNBC. So let me bring him in, guys. I'm adding you in here. Good to see you. How's it going?
All good.
How are you?
Good to see you. So I'm going to do my best and say hello and goodbye because you guys have a lot to cover. If you need me, I will be in the green room. Shirt number 2, just so we're clear. Shirt number 1, auction first. Shirt number 2, going second. All right, guys, have at it. Okay, I'm gonna jump out.
All right. You seem to be keeping pretty busy changing your wardrobe over there. Thank you, Lex. Thank you very much, Dan. So I figured I would kick this off. The theme of today's summit is how to apply technical analysis to trading options. And I thought before we get to how we do this, I think we ought to consider why it is that we do this. So we know that options are a powerful tool. We know they can be used to hedge. They can be used for leverage. They can be used to generate premium. And importantly, they can also be used to inform us. Elevated options premium, for example, or implied volatility gives us insight into the magnitude of future price movements and sometimes even their direction. And we also know that options payoffs are nonlinear, and that when we combine options into spreads, often we can generate risk-adjusted returns that are more attractive than simply buying or selling the underlying asset. That is true whether it's a stock, an ETF, an index, or a future, regardless even whether we have a view or a prediction as to how that asset might behave or not. And so to illustrate that, I thought what I would do first is share some slides that I have. Let's see here. Okay. I may need to be informed on how to make this work since this is my first go round with this. Lex,
Back.
maybe I'll.
Can you hear me? So what you have to do is you're on the same screen that you're.
Oh yes. Okay.
There you go. So now we're good.
Brilliant. Okay. Okay. So I'm not going to go completely into this too deeply, but let's just take a quick look first at some slides here. This first slide that we're looking at is a is the P&L basically of one of our strategies that we call balanced opportunity. And this is just the performance over 1 year. And it probably doesn't look that exciting. But it might look a little bit more interesting if we compare this strategy, whose objective, incidentally, is to be correlated to the S&P. So I'm looking at the SPX index, but also try to take advantage of some of the characteristics that options offer. So changes in implied volatility and also some hedging elements. If I compare our performance over the past year to the S&P, one begins to see the benefit. You can see that over the course of the last year, we're up about 5.5%. The S&P is down about 15.5% over the same period. Now, just so that I'm not cherry picking only our best periods of performance, I figured I would also show our worst period of performance as well, which came essentially off of just after the pandemic lows in April. You can see from that period to present, we're up only about 25% versus 33% for the S&P. So we were certainly an extended period of underperformance there. But the important thing I would show, and this is since the same strategy since inception, what we can see is that this strategy, which doesn't even have a view on the direction of the S&P per se, just using options as a structure to create a more favorable risk-reward profile, under normal market conditions can pretty much keep up, as you can see, from January of 2018 until before the pandemic. But once things get disrupted, the power of options really reveals itself. And we can see that the hedging that we had in place going into first the pandemic and then again more recently created significant levels of outperformance. So if this is what we can achieve with options when we don't have a view on what's going to happen in the future, what are we going to be able to achieve once we do? Well, consider the three principal characteristics that go into the value of an option. First of all, options expire. And most of the options that are traded expire within 90 days or less. The second thing is that options have strike prices. Put differently, they have critical levels. Whether the underlying asset is above or below those critical levels at the expiration date is going to determine their profitability or their loss. And finally, options are priced based on anticipation of volatility, the magnitude of future moves. So it's clear that if you really want to make options even more powerful instruments than they are, having insight into whether or not we are at a critical inflection point and what that inflection point might mean is going to be critical to how successful we are. So with that, I thought I would give it over to Carter at this point so that he can share some of his thoughts on technical analysis, and then we're going to try to provide you with some actionable examples.
Thanks, Mike. Fantastic. And just that, the point of, let's say, technical analysis is trying to find actionable moments. But it's not unique to technical analysis in the sense that however one approaches markets, we're all looking for inflection points. And just to make that clear, I think the fundamental analyst who is studying, for instance, restaurants, they're looking for patterns, right? Patterns. Why are same-store sales this month so much better than the month prior and the month prior? Or patterns such as, why is the average receipt, though, lower? Or a fundamental analyst might be looking at patterns on the balance sheet. Why are accounts receivable spiking here? Or why is cash on hand deteriorating so quickly? Or why is debt going up? So whether you're looking for patterns on the income statement or the balance sheet, whether one's a scientist looking for patterns in the petri dish, trying to find the cure for a disease, or whether one's a quant or a technician, we're all looking for moments where something's about to inflect, a breakout in a career, an actor, or a breakout in a sports moment, a political campaign, and so forth and so on. And so if you will, technical analysis is simply the endeavor of finding inflection points. And there are many ways to do it, and I'm one of many, many technicians. But what I hope we'll do today is show you some of the key inflection points that I look for, and then we will apply it to the market, and Mike in turn will show you an option strategy or two around some of these inflection points. So what I'm going to do now, if we can, is take a look at what I call the cave drawings. These are from those who've gone before us. Some of the original rules, some of the original inflection points go back more than 100 years, and I traffic in only four buys, 4 sells. They're the reciprocal of one another, as you can see. And we're not going to do all of them. We're going to do 2. But what they are essentially is fundamental moments. For instance, on page 1 here, circumstance 3. This is what value investing is. A long and protracted decline, stock that instead of going out of business like Enron or WorldCom or Eastman Kodak, starts to base and bottom. Or for instance, page 1, circumstance 4. This is GARP. Any stock, index, currency, commodity that's in an uptrend that sells off a certain amount is then at a point where it's ARP. It's cheaper, so to speak, and we're trying to play for a bounce. Or for instance, and finally, what is a breakout? A stock that's been range bound for quite some time, typically 6 months, at a minimum 9 months, up to 2 years. More often than not, it represents multiple compression. The business is continuing to progress. The company continues to increase its earnings, buy back shares, acquire competitors, whatever it might be. And then at some point, it literally breaks out because it's gotten so cheap. Earnings are announced and it's off to the races. With that, we're going to look at some examples. We're going to start with page 1, circumstance 1. What is a conventional buy juncture, a key inflection point? And then I'm going to turn it over to Mike. So again, just to be clear, we're looking for this prototype, well-defined tops at a common level that have persisted 6 to 9 months, if not longer. And I'm going to give you some examples and then show you 2 that I like right now. Here's McDonald's back 2-3 years ago, well-defined tops at a common level, and it explodes. Look at the before and the after, before and the after. That gap up is an earnings beat. Here's another one. What does that have to do with JP Morgan? Well-defined tops at a common level, and it explodes. It breaks out. Here's another regional bank. A level, and it explodes. It's not infallible. It's got an error rate like everything else, but we're trying to be there at key moments. Do they all break out? Absolutely not. But when you're at a breakout juncture, we want to try to play the cards as dealt. Hershey's chocolate. Well-defined tops at a common level that have persisted for typically a year or more, and it breaks out. And you'll notice that each one has a gap when it starts to break out. Those are the fundamentals. That's the earnings beat. But stocks set up just before earnings a certain way. John Deere has nothing to do with chocolate. It breaks out. Boeing, it breaks out. Intel, it breaks out. Target, it breaks out. Now, I want to show you just one thing. If you miss a breakout, it's fine. You can't get them all. And some will be false breakouts. But when you have a circumstance, a stock that's been range bound, and if you miss it, do you see how, unlike the others, Target pivoted back and went right back to the point from which it broke out? Doesn't that look an awful lot like on page 1, circumstance 2? So if you can identify a prospective breakout, we want to do it. But if you miss it, 1 out of 4 will actually give you a second entry point. We'll pivot back to the point, just like Target, just like the prototype. Target, prototype. Do another. Watch Sienna. A level. It breaks out. If you miss, that's the earnings beat. You often get the pivot back. Tesla. When Tesla broke out, look at the pivot back. If you miss a breakout, fine. Sometimes you'll never get another chance. It'll go on for years. But 1 out of 3, 1 out of 4 will look like circumstance 2 on the cave drawings. And so here are 2 stocks that are set up right now. Amgen. So the point is Amgen worth more now in the fundamentals world than it was in March? Amgen keeps increasing their earnings, buying back shares, finding new drugs, whatever it might be. And Amgen is toying with the prospects of breaking out. Also this, how many stocks are 52-week highs? 85% of all stocks are down 10, 15, 20% from their highs. The definition of relative strength. And here's another one, chocolate, Hershey, one we looked at before. Well-defined tops at a common level, poised to break out. These are conventional buys as I learned it. Mike, why don't I turn it over to you?
Okay, so I have a couple of slides here that we can take a look at. So it's an interesting thing when we're taking a look at breakouts because, as Carter just described, we're dealing with stocks, in this case, that have essentially been toying with a critical level for some period of time. And one of the things that is a byproduct of that is that you might see volatility as relatively compressed. And that will translate to the price of options. And we have to combine that with our thesis that that critical juncture is that it's going to cause a breakout. So where something has not been moving, it suddenly will begin to. So here we're taking a look at the implied volatility of Amgen, and you'll notice that it's about 25%, which, by the way, is lower than the implied volatility for the index. This is an uncommon occurrence. Generally speaking, an index or an ETF, a portfolio of stocks, will be less volatile than individual stocks will be. It's one of the critical reasons why people diversify their portfolios. But in cases like this, where a stock has essentially been toying with a level, sometimes you'll see this compression. And we can take advantage of that when we're looking to trade options because the options are not that expensive. So in the case of Amgen, I'm just looking out to January at the 265 calls, which cost about $12 when I was looking at that earlier this morning. So you're risking a relatively small percentage of the stock's current price to make a bullish bet. We're keeping this very simple. We're reducing our downside risk relative to purchasing the stock because, as Carter just pointed out, the stock is at or toying with right now. It's 52-week highs. Here's another way to look at it, which you probably don't see as often. This is a forward-looking distribution. This is essentially how the options market is pricing the way Amgen might behave in the future. And although it's going to be hard for you to make out, I'd like you to just take a look at the difference between the red and the green sections. One of the things you're going to observe here is that instantaneously, you don't have to get to the break even of your long call option. Instantaneously, this is going to behave in a more muted way, a little bit like stock will. But when you have a situation like this, where implied volatility is low, where you've chosen a direction, this is a situation, particularly in a market like this, you're with a stock that's at a 52-week high. Sometimes keeping it simple is the best and easiest way. And let's just take a look at Hershey too, because in a very similar fashion, the implied volatility here is even lower. It's close to 22% looking out 3 months. Same setup, same options premia, same trade. Here again, just looking out to January, buying the 240 call, risking just $7.50 a share to buy that call. And again, looking at the distribution going forward, we get a sense now of what it is that the options market is implying. And this is a relatively simple way to initiate a position on an anticipated breakout. And I would just add one additional thing here, which is an options trade can start simple and you can add nuance to it over time. If you want to hold on to a long call option and the stock starts to rally and you want to leg into a spread, you can do that. If the stock falls and your conviction rises, you can look to potentially sell puts, work your way into a risk reversal to offset some of the premium. Trade dynamically around your position. But sometimes it's the simplest course that's the easiest way to initiate a position, and that's what I think you should do in these two cases. Carter?
Thank you so much. That's perfect. And then let's look at another prototype or two, and then on from there, try to get to, obviously, questions and answers, which is in many ways the best part, right? Interactive and so forth. So I want to talk about the importance of trend and changes in trend, and always and forever getting it around to and back to the cave drawings. So we're going to look at this circumstance first, page 1, circumstance 4. And if you're going to use moving averages, why indeed the 150-day moving average is the one that I would recommend, invite you to use. And then also how stocks bottom transition from bear to bull. So here's a supermarket. Now there's a trend line and there's the 150-day moving average. So what I want to emphasize first is that all that a moving average is an automated trend line. You can draw the trend as done here on Kroger, or we can try to automate the process because it takes a lot of time to draw lines. Indeed, when I started, there weren't computers and we would be up all night with pencils and paper, graph paper, putting in trends. But why not automate that process? And notice the 150 moving average. Kroger touches it to the penny, to the penny, to the penny, to the penny, to the penny over and over. And watch this. There's the 200-day. The 200-day moving average is the default in every computer, from Bloomberg to FactSet to William O'Neill, any software. It almost has no hit rate in all the studies we've done. 150, 200, 150, 200. Now, what does a supermarket have to do with gold? Nothing. Gold is as old as the universe itself. There's the trend. There's the 150. This is GLD to the penny, to the penny, to the penny, to the penny, over and over. 200 moving average, it didn't touch once. And yet all the world, all my competitors use the 200-day to measure trend. Don't know why. I know why I use this. I spent a lifetime trying to figure it out. Caterpillar tractor, there's your trend line. There's your automated trend line. What is it? To the penny, to the penny, to the penny. And the 200-day didn't help us. Let's keep going. Here's Alcoa, which has nothing to do with tractors. Here's the trend line. Here's the automated trend line. And here's the dud, the 200-day. Or the QQQ. And there's the 200-day. Or Moderna. And there's the 150-day. The cure for COVID. The rules are in effect. It looks like page 1, circumstance 4, stock, currency, commodity or index that sells off to its necessarily rising 150-day moving average is one of the great inflection points in markets. Do they always bounce to the penny? Absolutely not. That would be absurd. Do we play the cards as dealt when something is down to the 150-day average? You betcha. Moderna, 200-day, didn't do anything. Taiwan Semi, trend line, 150-day, 200. And it goes on and on. Northrop Grumman, 150-day, to the penny, to the penny, to the penny, 200. And if that's the case on the way up, what is the reciprocal? Page 2, circumstance 4. Stocks, currency, commodities, and downtrends that rally to their declining 150 are great short sell moments or a moment to put on options trade. So here's floor. Here's the trend line. Look at the 150. It fails to the penny, fails to the penny. We short it, 200, no good. Here's Kraft Heinz. It's ketchup. Here's the trend line. Here's the 150-day. Here's the 200. Molson Coors beer, trend line, automated trend line, 200. It goes on and on. In any event, quickly, I'm going to end here. Those are trend lines. We can draw them. I took a while to draw those, or we could use the moving average. We're looking for inflection points. When a stock is bottoming out, a bearish to bullish reversal, a bearish to bullish, or bullish to bearish. The point is we can use the trend lines to measure trend, or simplify the process, use an automated trend line. 150-day moving average starts to inflect and turn up, we want to be on the long side. When it's rolling over, we want to be on the short side. Alcoa, Apple, 150-day, we want to find it right here when it's bottoming. We want to find it right here when it's bottoming. Macy's, it doesn't matter what it is. That's the point of this, right? It doesn't matter what their line of business is. We want to find a stock, currency that's bottoming, and I'm going to get to 2 that I think are doing that right now, among many. Micron, uptrend, downtrend, uptrend. What do we have here? Use the 150 moving average to try to measure that process. If your 150 moving average is turning and inflecting, it's a bearish to bullish reversal, get in motion. Micron. Automated trend lines, actual trend lines. That's all that a moving average is. You can see these examples over and over. Not infallible, it's got an error rate like everything else. It just doesn't have the error rate that the fundamentals have, which I was for years, a fundamentalist, and I abandoned it. 2 favorites, Urban Outfitters. What do we know? The 150 moving average is starting to inflect, about to turn. 2, the stock is at its August high. The stock market's nowhere near its August high. That's the definition of relative strength. or even Sam Adams, just now starting to base and bottom. The definition of a bearish, talk about bearish, 1400 to 300, and now starting to turn. Mike, back to you.
Thanks, Carter. So these setups are actually quite interesting for slightly different reasons than the breakouts that we were talking about before. So both of these two companies move around a lot, and they have been moving around a lot. And that's not surprising because, of course, stocks tend to become more volatile as they decline. So the first one I'm taking a look at here, this is the implied volatility for Boston Beer Works, Sam Adams. Now, one of the things you're going to notice if you take a look at this is the 3-month implied volatility, is it has dropped very sharply recently. And there's a good reason for that. The company announced earnings on October 20th. And exactly to Carter's point, actually, that provided the critical data point that helped describe the price action. In other words, we learned why the stock started to behave the way it did only after the fact, which is so often the case. There's wisdom in price, there's the wisdom of crowds. Of course, when you're setting up an options trade, we care a lot about what the options premia are. Because these options premia have already fallen, this is still a relatively volatile stock. As you can see, the implied volatility is about 43%. We've already seen a big move. Off of earnings, I think the stock was up nearly 20%, bounced off of that news. I think the play here is to use a call spread. I was looking at the December 420, 460 call spread. And when I was looking at that this morning, that would cost about $13 per share. So you'd still be risking considerably less than the share price. Now, I want you to think about two things here. One of them is that I'm using a spread. That is because the implied volatility is higher. The other thing you'll notice is that the expiration I've chosen is more short dated. And that's not because my technical view, based on Carter's work, has a different time horizon, but actually it has more to do with the options trade. When we use spreads, if you use very long dated spreads, they will not go to their maximum value, a debit spread, in the short term. They're more likely to behave the way they will at expiration, the closer to expiration that they are. So in this case, using a slightly shorter dated expiration, I get that opportunity. The other thing I would point out is also take note of how much I'm spending relative to the width of the spread. So here we have a $40 wide spread. I have often said that if and when I can, we like to get payoffs that are, at least 2-to-1 on debit spreads, and preferably maybe even 3-to-1. In this case, we couldn't quite achieve that. Again, that's partially a function of the volatility that we see in Boston Beer. Here is another way to illustrate what that options premium actually indicates. And you can see here the implied range that you have over the course of time based on current options premium. It's a big, big move. This also helps illustrate, by the way, some of the risk you are actually offsetting when you use an options trade, because as we can see, the options market is still anticipating that this could move and move very sharply. Now, if we look to Urban Outfitters, the situation's a little bit different. And one of the reasons it's different, we have very high implied volatility, higher than we do in Boston Beer. It has not dropped as much recently. And the reason is because in this case, earnings are still on the horizon. Another big difference that I would point out about Urban Outfitters, and this is always a very dangerous thing. People who watch me know that I come largely from a fundamental background, much like Carter did originally. I didn't gravitate towards technical analysis until more recently, and I rely on people like him to give me the insights that I need. But this is a company that is actually trading quite cheap. We're talking about single-digit PEs here. We're also talking about a very low valuation relative to its history. In the case of Boston Beer, it's still trading probably 25 to 30 times its peak earnings at its current level, and certainly a much higher multiple than that relative to what they're forecasting for the full year this year and next. Not true for Urban Outfitters. And I think what that does is it provides a little bit more comfort to where we might actually be willing to purchase the stock if it declined. And so here I'm actually using a call spread risk reversal. You can see, once again, looking out to December, not as far as January, and for the same reasons. When you're using debit spreads, remember that they will not behave much like the expiration payoff chart, which you can see in the lower right-hand corner of the screen right now, until expiration approaches. So we tend to use slightly shorter expirations. Here, I was looking to put this trade on for something close to even. The prices didn't line up precisely when I was taking a look at that, partially because the stock is up today. But here you're laying out only 15 cents per share, buying the December 25 calls for $2, selling the 28 calls for $1, and then selling the 21 puts for 85 cents. And again, you can also see here on the left, 21, not an unattractive level to buy the stock. Seems like there's meaningful support at that level, and also a reasonable fundamental valuation if we elect to go there. The other thing I would quickly point out about this trade is that notice the distance between the strikes that I've chosen, between 25 and 28. So looking for about $3 in potential profits if the stock makes a move upwards. Try to use these strategies when you do get some meaningful benefit to the upside relative to the risk you're taking. So if I can make $3 and my downside risk is that I potentially get long the stock around 20-ish, that's earning 15% on my risk capital over a relatively short period of time. That's when you want to use a strategy like this. We're not trying to make 1% or 2% or 3%. You want to give yourself at least some meaningful potential reward relative to the risk you take. And that's particularly true when you're dealing with stocks like this one that have high implied volatility. So I thought, especially since we have the ability to share our screens here, and because I know this is an educational summit that we're having, and it's really supposed to be a conversation, that one of the things that might be helpful is if we were able to interact with all of you and answer questions that you may have, and we may even be able to, in one or two instances, I might be able to pull up my screens, and we can try to walk through some potential examples together. So Lex, I didn't know whether you had any comments or questions that you wanted to ask us, or whether there were any from the audience. But personally, I would be very happy to take some of those questions and comments if we have any.
Great. Super informative, guys. Really, really great stuff. So yeah, there are no particular order here. So I was writing down some of the questions from the audience as you were talking. And some of them might not pertain, and just let us know that, I think, right? So one of the big things that we're seeing in the retail space is the birth and just massive growth of these zero DTE options, days to expiration options. So one of the questions was around, is there any indicator or technical analysis available to that? I think I know what your answer is going to be relative to implied volatility and any sort of study that we can apply to it. Now, that's clearly a more day trading sentiment with 0 days to go. But do you guys have thoughts on the zero DTE and what you guys do?
Well, let's talk about. I'll talk about the options premia portion of it first, and then I'll let Carter opine on the technical portion. So, first things first. Number one, I am not and never have been a day trader. That's not to say that I haven't done a lot of intraday trading, because like you, Lex, I was a floor-based market maker. As you might expect, there's a lot of intraday trading that takes place there. And so that's the perspective that I want to lend to answering the question, which is, what is a fair price to pay for a very short-dated option when you are trying to make a directional bet of duration as short as that, right? So between now and the end of the trading day.
Mm-hmm.
And the way to think about that is we need to grasp how much it is that a stock is likely to move before we understand whether or not it actually makes sense to use those options to make that bet. So how do we go about doing that? Well, of course, if you have tools that give you implied volatility, that can be helpful. The problem is that when you're dealing with really short-dated options, sometimes the models, especially the ones that you might be, if you build an option model in your spreadsheets, for example, you're probably going to find that those things break when you're dealing with options that are actually on expiration. So instead, think about it this way. What is the mean deviation for a stock based on its annual implied volatility? So here's the thing. I hear a lot of people, a lot of pundits will actually say this kind of thing even on CNBC sometimes. It bothers me a little bit when they do. They'll say something like, well, if the VIX is 32%, then that means that the index is going to move 2% on average every day. And the way they get there is they divide by the square root of time. So it turns out that if you take the number of trading days in a year, you take the square root of that and you divide the volatility by that number, that's 16, that's where they get 2%. That's actually telling you what the standard deviation is, not what the mean absolute deviation is. The average move is actually a somewhat smaller number. The average move is actually going to be about 0.8%, 0.8 of the standard deviation. So that would really mean that you're looking at an average move of about 1.6% per day. So when you're looking at the options prices, don't think about it in terms of implied volatility. Just think about it in terms of what you think the volatility of that asset is and what that is going to translate into for your average daily move. And then look at the options accordingly. So, for example, if I had an opportunity to buy a call option on something where I thought, at the money call option expires at the end of the day, and I think the move is going to be 1.6% on average, then spending 1% or 0.8% of the underlying price might be reasonable. But beyond that, I can't really give you much help on the technical side because I don't do intraday trading. Carter?
Well, yes. So, what's so important, of course, is knowing who one is in the market, right? There are people who are buy and hold. There are people who are trading for seconds, fractions of seconds, as we know, and then intraday and so forth. The patterns repeat. There are reversals. If you look at a 1 minute bar chart or a 5 minute or a 10 minute, you get the same formations, how something that's been in a downtrend starts to base or bottom. You'll see it in the intraday move in the S&P or the futures right now. And so the rules, if you will, the cave drawings are in effect. You get breakouts intraday and so forth and so on. So it's all replicable. It's all applicable, but it's also important to know who you are in the market. There are people who think they're long-term, but then all of a sudden they dump their stock because it's not going well. And then what happened? Are you a trader or are you in it for the long-term, and vice versa? It's important, of course, to know this. You got to know what your time frame is, where your sweet spot is, and then stick with it.
Okay, great. Thanks for all that. That's awesome. So someone's asking, I think, Carter, maybe this is to you. Why is the 150-day MA better than the 200-day? And that might not be the case, but do you have some thoughts there?
Oh, well, yeah. I thought we tried to cover that, but let's do it again. So I'm not in the why business. I'm in the what business. And what we know is that it is better. I've spent a lifetime doing studies on this, and all the indications after all of the work, and not just me. It's amazing. I'll tell you something funny. When you're on Wall Street, you have associates that come in. The funny thing is the bad ones will stay forever. So you have to get rid of them. And the good ones, they leave and they go off to Goldman Sachs every 3 years. And so I've had endless people, engineers, PhDs in neuroscience, MIT graduates, on and on. And they have all in turn tried to study some of these things. And each, to a man, to a woman, has come back and said, you're onto something here. The hit rate is much higher. But just think about it as this. It's no magic. It's just trend. how to measure trend. Over time, the 150-day moving average measures the actual trend better than the 200.
Okay, great. Question probably maybe for Michael. Michael, how do you determine what option strategy to select based on the analysis? There are a lot of combinations you can use with structuring your trade. How do you know which one is best suited for, a particular technical sort of indicator of sorts, or something that you're seeing on a chart?
Yeah, so I think we were also trying to touch on that a little bit, but I think it definitely bears repeating. So the critical inputs are, first of all, what are the prices of options? So if options premia are extremely elevated, what that means is if you simply buy a single option, if you're going to buy an option as opposed to sell it, you need something to happen for that to be profitable, and it needs to be big. In other words, of the three things that can happen, either it can go your way, it can stay where it is, or it can go in the wrong direction. It needs to go in your favored direction by a significant amount for you to be profitable. So generally speaking, when implied volatility, the price of options is above average, and I have a technical thesis, I'm more inclined to use spreads.
Mm-hmm.
So I'm probably more likely to use something like a call debit spread or a put debit spread. So for example, if we had bullish to bearish reversals, that might also be true. Okay. Also consider the first examples that Carter had, the breakout, for example. So this is something where you've had a relatively quiet period. Now you're expecting a move, maybe even a sharp move. And very often that's a perfect setup for a single leg option because the options premium are already going to be depressed because that's how the stock's been behaving. And that's exactly what provides the opportunity to make that directional bet in a simple way. As far as selling options are concerned, I don't sell naked calls, period. When it comes to selling puts, that's something that I will do opportunistically for stocks that I otherwise want to own. And the reason for that is there's a good chance that I will. So only engage in those types of strategies if you're actually comfortable owning the underlying. And most of us are long stocks on balance. So we're trading options, but we're also long stocks. That's when you want to do something like that. Okay,
great. Quickly, for the 150-day, is it SMA or EMA? Someone's just asking.
SMA, simple moving average.
Okay. Yep.
If we have 1 second, can I share my screen for a second? I just want to.
Yeah, absolutely.
So this is what struck me. Again, I was a 25-year-old, been in business about 3 years, and I was so disillusioned. I thought, I'm going to go to medical school or law school. I started to get out the books, and I ran into someone who just showed me these things, and it struck me on the spot. So here's a chart of the S&P, right? No drawings, no annotations, no judgments by me. Ready? Now watch this. Take it away, put it back. Take it away, put it back. How is it possible that the S&P on the way up stops to the penny, to the penny, to the penny at this trend line, and then when it peaks on Gen 4, it fails to the penny, to the penny, to the penny. In fact, put in some arrows. This chart alone is an anathema to the CFA Society, to the Federal Reserve Bank, to every major brokerage firm and every analyst, because it implies that it's easy. And that's never been said by me. It's not easy, but one has to know the rules of the road. Remember, capital asset pricing models, how old? 60 years. They invented PEG ratios in the year 2000. Technicals, they have charts in the rice market going back more than 100 years. It is the first and foremost way to buy and sell.
Great. And that software that you're using is your own, I'm assuming, and that is all automatic. So you can make that happen automatically, right? Your trend lines, that is.
What I've done here, this happens to be Bloomberg. I use FactSet. I have about 4 or 5 different.
Yeah. Okay. Great. Okay, good. If someone's asking for a study in like Apple and PXT, can you do that on the fly, or is that going to be too tough?
Sure. Right now we could do what's the first one?
PXD. I think is that possibly Polaroid from
PXD? That's going to be a Pioneer. Here we go. Ready?
Yeah, Polaroid. Listen how old I am. Holy cow.
Okay.
Pioneer Natural Resources, what you're looking at there.
Yeah. Right. Now, nothing particularly applicable as the rules go, but look at this. a well-defined uptrend.
Mhm.
Now, what else do we know? What's the relative strength? That's one of the most important things. I'm going to change. So we know what the market's doing, and we know what PXD is doing. So if I did this, watch this. This is a 2-panel, and we're going to have PXD on the top,
Mhm.
right? And on the bottom is going to be relative performance to, ready, SPX. So what do we know? PXD is not at a high yet, but its relative performance to the market is about to make a new high and breakout. I would be large long PXD.
Large long PXD. Wow. Okay. Powerful. I like it. What about Michael? Do you ever use butterflies to pin closing prices in something like the SPX?
So I do not trade conventional flies. I've never personally traded a conventional fly. I have traded broken wing flies.
Okay.
And the reason that I trade broken wing flies rather than conventional flies is because what I don't want to have happen is if I'm choosing a direction, and by the way, there are circumstances where I think maybe something is going to converge. I'm more likely to use a short strangle if I'm playing a range bound thesis, or I'll sell call spreads, or I'll sell calls against long stock. More often than not, because I'm not worried about going completely to zero, I don't necessarily cover that downside. But the thing is, if you're using flies to make a directional bet and you have a target price in mind, what you would hate to see happen is to get the direction right, but the magnitude wrong. It overshoots, so you got the direction right and you lose. That I don't like. So you won't make as much if it overshoots your target when you use a broken wing fly, but at least you won't lose. If I'm bullish on a stock and it goes up, it would be a terrible thing, obviously, to lose money. If I'm bearish on a stock and it goes down, and I have a trade setup that loses money, I did something wrong. So I sacrifice a little bit in terms of the maximum gain, in exchange for which I improve my probability, and the error that I can make in my own judgment. And one of the experiences I had as a futures trader, trading energies, was that things often moved farther and faster than I thought they would. So I never like getting into a situation where if I underestimate a move that I think is going to happen, that I lose. That's why I use broken wing flies.
Okay, got it. So Carter, question earlier, is there some scanning tool that you use to present opportunities relative to how you use your technical analysis? So can you put in a universe of stocks, and if they meet your criteria, that spits them out, and you can go to town on those?
I do some scanning and searching, but I must say that one of the things about, how would I say it? One of the things about having a search to look for, if you program, which you could do, find all securities that have at least a 30% decline, that have not gone lower over the past 2 months, and that over the past 2 weeks are up 5 to 6%. Well, what would that look like? That's a bearish to bullish reversal, a long decline, a base. But once you have a whole bunch of stocks that look the same, you can't distinguish them. They all look like they're bottoming. And so while I do some searching, the purest way to do it, and I was taught this way, is to go A to Z, if you will. And so I just go through every stock in the Russell 3000 over and over and over. It's absurd, actually. Imagine a grown man looking at charts for 14 hours a day, but that's what I do. And I'm trying to have the difference shown, meaning they have magazines for beautiful antique cars, right? And then you look at each one, my God, that's gorgeous, that's good. Look at this Alfa Romeo, look at this old perfect paint job. But when you're on the street and you're just walking around and you see the taxis and the old vans and the FedEx truck, and then this unbelievable cherry red Alfa Romeo or whatever it might be, or MG, that stands out in contrast. If you screen for only beautiful cars, they all start to look the same. And so the point I would make here, and it's a long answer to a very short question, I apologize for that, is that it's actually better to not screen. Might shorten the process, make it easier, but it's better to just do the work, look at a lot of patterns, and the ones that are basing or bottoming or about to break out will jump out.
Okay, Great. Thank you for that. Michael, this might be yours. So I think someone mentioned risk reversal along the way, and a viewer is asking about how do you protect that risk reversal, or do you even protect the risk reversal? So any thoughts around that?
I don't protect the risk reversals generally, partially because a risk reversal is a more, especially call spread risk reversals, is a more protected method to take a directional bet that I might otherwise have taken with the stock.
Mm-hmm.
So here's a way to think about it. If I trade a call spread risk reversal, a zero cost call spread risk reversal where I'm buying something that's close to at the money, maybe a 50 delta call, selling a 27 delta call and selling a 27 delta put. What's the worst? It's a bullish trade. What's the worst thing that can happen to me? The worst thing that can happen is my bet on the stock, the index, the future, whatever it is wrong and it falls. And I have that instrument put to me. I will, in every instance, have lost less money than I otherwise would have trading the stock. You know, it's interesting. Meta is going to be reporting earnings this afternoon, 2 p.m. Eastern time. And I was taking a look at how the call spread risk reversal, the exact deltas that I just described, sets up going into earnings. Now, I don't know what your view of Meta is. I'm not sure that it matters. It probably matters more what Carter's view of it is, because right now people are very undecided about whether or not they're going to sort their problems out. But here's an interesting thing. Over the last 41 reported quarters, if I put on a zero cost call spread risk reversal, I would have made money 16 times. I would have lost money 7 times. And the balance, it would have been a clean push. No profit, no loss if I just put on a zero cost call spread risk reversal. My average return would have been just under 1.8%. For a 30-day call spread risk reversal initiated the day prior to earnings, 29 days after. If I had bought the stock doing that exact same thing, I'd have made money 20 times. I would have lost money 21 times. So I would have lost money more times, and my average return would have been 1.33%. Now, when Meta really takes off, I don't make as much money. But the reason I outperform, and actually if you did a cumulative trade, I actually would have outperformed buying the stock over the course of the last decade, just holding it for 30-day windows, doing that options trade by about 50%. If I invested $1 the first time and then just took my results and reapplied them each time for the subsequent 40 quarters, I'd have outperformed by about 50%. So the call spread risk reversal or a risk reversal, you are taking the risk that you will own the stock. But the risk you're taking is that you will own the stock at a price that is cheaper than where it is today. And that risk will always be lower than buying it at the prevailing market price.
Okay, got it. Perfect. Thank you for that. Now, I think I just learned I can do this. I can show the question. So, Carter, this might be for you. How do you incorporate the VWAP into your technical analysis?
I don't.
Okay, we don't. That's it. Don't
it.
even look at it. So the volume weighted thing doesn't pertain, right?
Might to some, but it's not part of my work. No.
Okay, got it. All right, and then Michael, I think what maybe that viewer was asking about was maybe a synthetic long stock kind of a position, because now all of a sudden you have the short put on, and perhaps they were referring to that situation where can you throw a downside put on and now have a put spread and a long call and something like that. I'm trying to think if maybe that's what the person was asking.
Yeah. So I mean, there are ways, of course, that first of all, what is a risk reversal? A risk reversal is selling a downside put to buy an upside call. Some people will refer to the inverse of that trade, buying the put and selling the call, as that trade. They'll say I'm selling a risk reversal. That's a collar, as far as I'm concerned.
Yep.
I'm collaring up a long position typically if I put that trade on. And generally speaking, the put you sell is going to be lower than the prevailing market price. Not always. Sometimes people will, in fact, sell an at-the-money put, which is synthetically equivalent to doing a buy rate. Your risk is the same as buying the stock and selling an upside call. And then sometimes they'll buy a further upside call to do that because they're looking to basically collect some premium. So one of the things I would pay attention to is if you are concerned about the downside risk, you can sell downside credit spreads. You can sell upside credit spreads. When would you sell a downside credit spread? When would you sell a put spread? Normally, you do not. Why is that for equities? The reason is because the math doesn't usually set up that well. Way out of the money puts trade at a significant premium. And what that means is that the put you have to buy to protect yourself often costs quite a lot. So you might end up selling a $5 put spread for $1.25 or even $1. And that risk-reward relationship isn't that favorable. But there is something interesting going on right now. It may interest a lot of people to know that bullish bets in the options markets recently have gone way up on a relative basis. And what we're seeing is that skewness, that premium in those downside puts, is actually relatively flat. So provided you can collect enough premium, and by enough premium, I mean at least a third of the distance between the strikes on your put spread, that's a way you can mitigate the downside risk. But it's not common that the market offers you that opportunity. Mm-hmm. So instead, use that trade on securities that you like, on securities that you want to own. That has to be the first determinant if you're going to take that risk.
Got it. Okay. Carter, I'm going to rapid fire you again. You ready? Here, and if you say we don't, then we're moving to the next one.
Uh-oh, here's another one. The answer is nope.
Ready?
That was invented. On balance volume was invented by Joe Granville, one of the great practitioners. He also used the 150-day moving average, one of the few. Most use the 200. He was the founder of On Balance Volume. I have found it to have no value at all. Okay.
There's another one for you, the candlestick analysis.
It's excellent. I don't happen to, but that's more of a preference. It's key, though, never to use a line chart, right? A line is just the closing price connected. You want to have a high, low, and close, and candlesticks are simply trying to accentuate that. But a bar chart with high, low, close, open, high, low, close, candlesticks try to make that more clear visibly. For me, it just makes it a little more busy, and I like just a standard high, low, close bar chart.
Okay. And then someone asked way earlier, I forgot to ask this. You have your setups to get into trades. I'm assuming there's an exit sort of setup as well, so that it tells you, okay, this has run its gamut and time to get out.
Right. So, and that's an important thing, independent of fundamentals, quantitative, technical, what to do when you're wrong. There's nothing wrong with being wrong, only staying wrong. So the first thing is, it's really not the hardest thing, despite it sounding, the hardest thing is what to do with winners. And we all know this, right? When you buy something at 20, it goes to 30, and you sell, and then it goes on to 90. That's a disaster. You were there, present at creation. You bought at 20, went to 30, you sold, went to 90. I would call that mismanagement. The easier thing is what to do with losers. Just have a mechanical stop loss. That's the only way you can do it. And whatever you're comfortable with, whether it's 3 or 7 or 15%, once it's lost the amount that you're willing to lose, just get out.
Do you ever put an automated exit on, meaning a stop? You just throw out there, you know where it is relative to your analysis, and let take emotion out of the equation. Put it stop out there and just walk away.
Quite often. In terms of the patterns themselves, well, let's use an example. If a stock sells off to its rising 150-day moving average and one's buying for a bounce, and then it goes a little below the line, what should we do? It's the behavior of the money. So let's say it's $20, having sold off from 30. It's now at its 150-day moving average. We're buying it for a bounce because it sold from 30 to 20 to the penny at the 150-day. And then it prints 19 the next day. Is that tolerable? It's not going to be perfect. How about it goes to 1850? How about 18? Now we're starting to get into a loss that's a little uncomfortable. But here's my answer. It's the following. You either have to be mechanical and have your number, stop it out at whatever that percent that is, or, and either is fine, it's how it gets down to 18. So if a stock has sold from 30 to 20, we're buying it for a bounce off the 150-day, and the next morning it gaps down on 5 times average daily volume to 19, only down $1, I would walk away that instant. However, if over the course of 5, 7, 10 sessions, it drifts to 1990, 1960, the next day 1950, 94, that's allowable, that's tolerable, meaning it's just simply gotten a little weaker. But if it's gapped down and on huge volume, it means that something is wrong, news has been related. So the long answer is I could buy something at 20 off the 150 moving average. It could gap to 19. I want to walk away, whereas I would tolerate a drift to 18 and still stay. That's how it gets down there.
Okay, great. Thank you. Let's do one more. I see time. We're almost done here, guys. Let me get, this is a double for you. Let me put this one out there. You know, if you can comment on that one, have at it.
Yes.
Straight yes. Michael?
So the S&P right now is trading around 17.5 times earnings in round numbers. And if you were taking a look at the last 70 years of investing in the S&P and you said, okay, what happens? What are my returns? Are they better than average if I buy the S&P when that multiple is below, say, 18 times? And that little test would suggest that we are indeed at an attractive level from a valuation perspective. But it's very deceptive to do this, very deceptive. And in fact, if you decided to narrow it up a bit and said, okay, well, what if I bought the S&P when it's, you know, it's had a decline and it's between 16 and 18 times, pretty much right where we are. It might surprise you to learn that, in fact, that doesn't prove to be such an attractive entry point. One of the reasons it looks better when the valuations get below some number, or you pick an arbitrary number and you say, okay, now it's looking cheap. It's because it gets cheaper, a lot cheaper. And you're averaging in all of the returns that happen if you happen to have the good fortune to have identified the absolute low with the intermediate levels that you reach on your way there. I still think that we might be on our way there. And the reason I think that is because real rates remain negative. Every single time folks have tried to handicap what was going to happen to inflation, they've gotten this thing wrong. And it has gotten worse. The other thing is that the Federal Reserve is always looking in the rearview mirror. By definition, they're looking at trailing data. So it doesn't matter actually whether, you know, the next inflation number is going to be good or bad. The fact is that they're driving down the highway at 80 miles an hour without looking out the windshield. Chances are a misstep is going to get made. I don't know which way it's going to get made, but I don't think we've seen the bottom yet. And part of that stems from the fact also that I'm seeing actually a decent amount of bullish sentiment in options, and that's actually worrisome to me.
I mean, just to add to let's just say this, that there are very distinct camps at this point. S&P's peak to trough, the bottom being October 13th, there's a 27% decline. The NASDAQ 100, a 37% decline. That is sufficient in history to qualify as an important bear market. And many people believe that the recent bounce is telling us that it's over. And there are many people who believe that, of course, this is just another bounce, an ongoing problem. But if you were to hold aside all of that and just go to history, we know that the only way an individual stock or an aggregate of stocks, an index, goes up is for one of two reasons or a combination of those two reasons. You either have to have earnings growth or PE expansion, multiple expansion, or some combination of the two. Now, at this particular period in time, most of the earnings are coming in quite light. You saw it out of Google or Microsoft, and in fact, the reactions have been for every stock that's gone up, like a Netflix, you got 4 or 5 that have dropped on their earnings. But either way, from here, how do we get those two things? Earnings growth, when all of the things that allow for earnings growth, margins, labor costs are still very high, cost of inputs, raw materials, et cetera, and so forth, all very high. Cost of capital, interest rates high. None of that is the setup for earnings growth. And for expanding the PE in a stock, well, not when the Fed is raising rates. That's not how it works. So either way, it doesn't seem to me it's a setup fundamentally, if one wants to talk about that, for a meaningfully higher move. But technically, we have an index that's in a bad condition that is bounced a little bit. So what? Yeah.
Okay. Great. They're telling me we're time. So guys, thanks so much for coming. This was terrific, really informative. You guys are the best. Just really great information. We have tons more questions, but unfortunately, we've got to keep it moving. So we'll catch up a little bit later. Thanks again for coming on, guys. Appreciate it.
Thanks for having me.
Okay. All right. Hello, everybody. Welcome. Hold on. Here I am. All right. Our next guest. We're going to keep moving. After this one, we'll have a little break. Our next guest is Mr. Don Kaufman. He is of TheoTrade. Don is one of the industry's leading financial strategists and educational authorities. He's got 21 years of financial industry experience. He oversees TheoTrade's firm-wide strategy and deployment initiatives. And he's also designs and executes some innovative content in the financial education space. Let me bring him in. And hi, Don. How are you?
Good. How's it going?
Good. Can you hear me?
Yeah, man, I can hear you guys great.
Okay, good. Good to see you. I'm not going to tell people where you're coming to me from because I'm so jealous, but if you want to offer that.
Oh, it's on my next slide. So, you know, we're in the middle of a little tropical depression out here, so hopefully my power holds out. By the way, you're dressed like I should be dressed. You look like you got your island wear on today, but yeah, so I'm broadcasting from St. Croix. We live in the Virgin Islands now.
There you go. So very jealous. You're very lucky. That's awesome. I'm going to let you go at it though, because I don't want to take up your time chatting. We'll get back to that later. So have at it, and I'll jump in as we get closer to time. How's that sound?
Sounds good. I'll probably need your help along the way, so stay close.
Just let me know when I need to add a slide, and I see it there, and I'll put it in.
Yep, I'm ready to go with the slide deck over here. So by all means. So again, I want to welcome everybody today, and feel free to let me know you guys can hear me all right. Looks pretty good. Sounds pretty good. So I'm going to talk to you a little bit about what I call a Quants guide to directional options trading. You know, I love this because, you know, Dan asked me to hop on and do this. And he goes, hey, you know, it's about technical analysis and options trading. I go, great, but I'm a quant. So for those of you that don't know what a quant is, I'm a degree of like a math geek, right? So I'm a bit of a math geek. Everything I do in terms of trading has to do some degree of probability and so forth. And I don't know explain exactly what that means today. And a lot of what I do is about logic of the trade. So you guys ready? Because this is going to hurt a little bit. I'm going to pack a lot into the next like 30 minutes. So copyright disclaimer, risk disclosure. By the way, a little bit about me. My background, I spent 15 years. I was actually building Thinkorswim. I was with TD Ameritrade. I exited 7 years ago, and been actually working a lot, in fact, with Tradier and Dan. Still do quite a number of media appearances. By the way, if you ever have to get a hold of me after today, just go to support@theotrade.com. The other primary piece of my career, I think that's pretty pivotal. Everything that I teach here, specifically today, like this presentation, comes from having watched some of the largest order flow ever. I mean, again, I got to see everything that you did as retail traders for the better part of 15 years. Before that, I was involved in the market making side of the business for some years. So I do some CNBC spots from time to time, onward and upward. Listen, the first thing I want to talk about is just volatility in general. I'm not going to be here at all to talk to you about market timing. It's not what I'm about. Volatility, you know, if it's got you down, it shouldn't, because this is the time, like this is the opportunity, and people continuously miss that. So the first thing we discuss when it comes to volatility has got to be risk. You know, your money is on the line, and how you handle risk and really like your own absorption of risk is really going to be the defining factor whether you're going to make money or lose money in this business. Okay, even more so than just bias. When I say bias, I'm talking about directional bias, and that's okay. But you know, too much risk, you're going to panic, you're going to close position continuously, you're going to put stop orders in at horrific levels, you're constantly going to get stopped out. Listen, okay, the bottom line is I've looked at hundreds of thousands of accounts. That's what we did to build education here at TheoTrade, is, you know, study obviously retail and retail trading accounts. As I said, I got to see the largest order flow in the entire industry for 15 years. And one of the critical aspects I'm going to discuss today is I've seen what works and literally what doesn't, and what doesn't gets repeated over and over again. So a key component over here, we got to follow a system, okay? And we're actually going to talk about this today. That's really, you know, the genesis of that system has to come from people like yourself. So I know a lot of us may have market making backgrounds, but you know, the days of market makers and people standing on a floor yelling and screaming, it's completely archaic. Okay. Number two, we got to cut losses and use a repeatable strategy to obtain incremental returns. And obviously, number three, successful trading strategies are going to exemplify the following principles. So one of the first things before I dive deep into trade and trade logic, okay, we're going to look at principles of a trade. Everything that I've ever been taught in this industry, and again, I come from a family of traders. My family started trading in Chicago in the 1970s. They owned as many as 500 seats in exchanges worldwide. It's kind of how I got involved in the business. But everything I've ever been taught in this business, the core of that, the principles of that, follow these three. And it's trade logic, capital allocation, and directional bias, right? So with that being said, let me explain what these mean. Because again, I wanted to hit you guys with something maybe a little different. You know, instead of talking about, you know, the MACD, the Fibonacci, the Bollinger Band. By the way, you guys will appreciate this. Larry Williams happens to live like next door to me here on the island. That's the Williams %R and so forth. Kind of find that ironic, but I live in a community here down in St. Croix that's like all traders. Anyway, I wanted to really dig into the principles of building a trade, and these principles are probably the most critical in this time, in volatility, you know, when markets are completely, you know, wild. So trade logic, allocation, directional bias. Allow me to explain trade logic. You got to place strategy and trade logic first. So the vast majority of people in the markets, they're infatuated. I mean, turn on CNBC or something, which way the market's going to go? What's it going to do? What's it going to do? And I'm fine with that. But what we have to put first is the right strategy. The right strategy coupled with established entry and exit criteria. You don't necessarily have to be right, if you will, picking direction, okay, in order to be profitable. And it's a critical aspect. And that's exactly what I'm going to hit on today. The next, okay, key piece of this, of course, is capital allocation. Now, by the way, capital allocation is never going to be an exciting thing to talk about. Like nobody's like, yeah, I'm so glad he talked about capital allocation. But how, okay, and where you allocate capital has to be strongly considered as a viable portion of your trading methodology, okay? This blows people's minds what I'm about to say, but capital allocation, okay, for all intents and purpose, it takes precedence over being right, meaning that it doesn't matter if you're right in the marketplace. You'll never be able to hold a position long enough to see yourself be right if you're what? If you're over allocated, right? Then we come to directional bias. Now, I'm not an anti-chartite. I have been called an anti-chartite, but I'm not anti-charts. I just recognize where you think a stock or maybe a sector or the market is going to go, and the market's not always going to agree with your sentiments. Like it just doesn't matter. Being right directionally cannot define us as investors or traders, for we might not be right often enough. Our war cry has always been duration over direction. You need to be capable of sustaining your positions long enough to be profitable. Think about that again. Capable of sustaining positions long enough to be profitable. What does that mean? Well, you want to be right or you want to be happy. Okay. I'll always take the stance though. You don't have to be right per se to be able to make money. Why? Experience. Again, watching order flow for decades has taught us just absolutely invaluable lessons. You ever been stopped out of a trade or bailed out of a position only to see the markets turn around shortly thereafter? Now, how many people? And again, I'm by the way, I'm trading on all these different monitors here and watching, on 6 screens. But how many people have ever had that happen, where literally you've been in a position? By the way, this is the interactive portion of this. You've been in a position. You literally got stopped out. You were like the low tick in there, and the market's literally ripped higher thereafter. Anybody been in that position before? Come on, people. Admitting it is the first step today. And I bring this to everyone's attention because, of course, if you've traded in this business, you know, you have literally been, if you will, the low tick from time to time. I say low tick, I mean, you've been like, you know, the absolute unequivocal, like, hey, that's the worst price that anybody traded today, and the market literally rips after that. Well, what I am intending to do today, all right. By the way, I love some of the comments that are coming through over here. It's a little slower over here. what I intend to do today is just to bring you just kind of one core strategy. I just want to introduce you to a real world strategy, okay, and position you and your portfolio with the right trade logic. So, my input, here for this session with Tradier, with the Cboe, it's not about per se directional bias. I'm not here to give you again a MACD or a Fibonacci. I got your 618 right here, but I'm not here to give you that. What I am here to give you is something that you can use, a tactical strategy you can use with technical analysis. And again, when it comes to technicals and so forth, I don't sit here, again, I'm not anti-chart. In fact, if I look at the other individuals we hired here at TheoTrade, I've got Jeff Bierman, who's, basically built one of the greatest charting packages in this entire industry. I've got Brandon Chapman. I just surrounded myself with market technicians. But again, I'm a quantitative trader. And to a quant, I have to have the right trade logic. Everything has to make sense, not just for this trade. I got to be able to do something like 1,000 times. I got to actually look at it in terms of like a Monte Carlo model and say, hey, look, after 1,000 occurrences, this is going to work. So let's get down and dirty. How do you position yourself? I want to have a strategy that overcomes a high probability being stopped out. I don't mind saying this, and you might take offense to this, but stop is a 4-letter word. I do not like stop orders. I've never liked stop orders. Again, 15 years in the brokerage industry. I don't like stop orders. I wish that, stop orders were never on a trading application. And of course, everybody offers them and everybody wants them, but why can't we just have defined risk logic in everything that we do? Just define your risk. Why do you need to stop? Because a stop is guaranteed to do what? To work when it hits that price. We're going to define your risk, provide a high probability of success, limit capital exposure, and never need to buy or sell the stock. Like at present time, I'm not a big advocate of buying or selling stock right now. Why? I mean, just take a look at the marketplace. We sold off big, we rallied huge. We sold off really, really big, we rallied huge. That's just the last 2 hours. It's chaos out there, right? So we're going to talk about in-out spreads. So if you're new to options, how many people here are new to options, right? If you're new to options, well, keep your hands and feet inside of the vehicle at all times. It's going to be a rough ride. So I'm going to give you a crash course on the in-out spread. And the in-out spread is going to be an effective tool, to mitigate exposure. But you're going to see the real reason why these trades can be so incredibly effective. So the in-out spreads are designed to limit exposure and maximize potential with very minimal movement and underlying. So just normal volatility fluctuations in markets are going to work for you. And as they say, fear not the options. This is where, again, hopefully many of you have options experience. If you do not, all I want you to do, and this is for everybody, even those that have some dramatic experience, follow big, broad strokes of logic. Why is he doing this trade? What is the outcome if I were to do a trade like this, right? And it's a critical portion of it. So let's get down to it. In-out spreads explained. All right, I'm going to take you through just a very brief example in here. We're going to go out. I'm going to got a little right on board over here, and hopefully everybody can see it. We're going to go out and we're going to look at a stock, and let's get crazy. Let's say this is a $100 stock. And by the way, every stock example I use, I call it stock. Why? Because I don't know, I'm a heavily caffeinated individual. So we're going to go out and we're going to look at a $100 stock. Are we going to buy the stock? Are we going to buy the stock? No. Do we want to buy the stock? No. Why don't we want to buy the stock? I don't know. Maybe it has earnings coming out and I think it end up down here. Like $90. All right. Call it Microsoft, call it Google. I mean, you're like one trade away from losing, 10, 15 bucks. Or the S&Ps just get absolutely clobbered tomorrow because GDP is spectacular. By the way, you have to love that. GDP comes out spectacular tomorrow, market's going down. Good is bad, bad is good. It's the reverse of Goldilocks. So we look at this and we have this $100 product, right? I'm not going to own the stock, and I'm going to make this as clean as I possibly can. I'm going to go out, and I'm going to buy a 99 call. Now, let's not even worry about the time frame. This could be good for 1 month, for 2 months, for 1 day, for 3 days. Doesn't make a difference. You're going to go out and you're going to buy a 99 call, and that 99 call is actually going to be trading for, let's say, $3. So let's put that down here. Buy the 99 call. It's going to be trading for $3. So I'm actually buying a slightly in the money option. Where do I want this thing to go? Obviously, I'm bullish. If I'm buying the 99 call, I want the stock to go up. Okay. Do I own the stock? No. Okay. 99 call gives me the right to buy the stock at 99. If the stock goes to 105, I have the right to buy the stock at 99. Everybody else has to pay 105. That is going to make me what? Well, at 105 and I have 99 call, I'm going to make $6, of which I paid $3 up front. Definitive out-of-pocket risk on that, though, is $3. Simultaneously, I'm going to sell, okay, a 101 call. Let's get crazy. Let's say the 101 call is trading for $2. So I'm going to turn around and I'm going to sell a 101 call. I'm going to collect $2. Now, nothing could be more simple than understanding, okay, a debit spread. And that's what this amounts to. But this is actually what we term an in-out spread. One strike in the money, one strike out of the money, and I'll get to why we're doing it. So it's a pure dollar debit. No more, no less, because if the stock is precisely at $100 and did the 99, 101, assuming there's not much implied volatility skew, okay, you'd be paying about $1 debit for the trade. All right, so how much can we lose on here? How much can we lose? Anybody? How much can we lose? If you have $1 debit on here, you can lose $1. Do I need a stop order? So the thing that always drives me crazy, whenever I explain this, I go, are you going to use a stop order? No. Okay. I don't like stops. I don't have to like stops. I don't even want to like stops. So where do I need the stock to go? All right. To be profitable, I need the stock to go up. There's no question I need the stock to go up. Where can the stock go? See, one of the keys to understanding the in-out spread is the in-out spread kind of makes you a little bit impervious, okay, to some of the short-term moves. So the idea of the in-out spread is, if you look at it, you're like, wait a second, whoa. Because some of you are, up the food chain a little bit in terms of the learning curve, and you're probably already ahead of me, and you go, wait, is this guy going out there and risking $1 to be able to make $1? Let's actually stay with that premise for a second. Let's say I am. Let's say I'm just crazy enough. You go, risk one to make one. Everybody always learns in this business, you're supposed to risk one to be able to make two, risk one to be able to make three. But options are probabilities. So if you can risk one to be able to make three, wouldn't that be inherently a low probability? In a risk one to be able to make one, you go, oh, it's a 50-50 shot. But is it a 50-50 shot? What I want to talk about with a risk one to make one, and by the way, I like to present this, okay, from the dark side of the force, meaning like I like to look at it and you go, yes, okay, you're going to risk one, okay, for a reward of one. You go, that trade sucks. But at the exact same time, what if we sell off? We get wild. We sell off. We're all the way down here at $95. You're like, throwing up under your desk. What are you going to throw up? $1? And you lose $1. Okay. Oh, hurt me. You're losing $1. You go, did you get stopped out? No. And guess what? Let's say that this trade does have a month of time. So in the first 5 days you've had the trade on, you're wrong. You can do that. You can be wrong. Okay. Stock goes all the way down to $95. Do you get stopped out? Absolutely not. So the one thing that people miss about spreads like this spread makes you impervious to everything that kills you inside of option trades. I told you that what we teach here at TheoTrade comes, okay, from logic of having watched flow. When I say flow, order flow, watched order flow for the better part, okay, of 15 years. I got to study everything everybody ever did, and everybody messes themselves up with volatility and gamma risk and theta risk. This doesn't have any of it. It offsets it. So the thing goes down to 95 and you go, oh, I'm throwing up. You're going to lose $1. And before you know it, the stock pops back to, I don't know, 103 sometime in the next month. What are you? You're gold, Jerry. You're gold. Here's the key point to the in-out spread. The probability, okay, of going up or down, let's say is 50-50. Be a quant for a second. Let's say that the probability of going up or down is 50-50. However, your ability to sustain the loss, okay, and not get stopped out, okay, is your edge. You go, what? So what if you lose $1? Screw it, you lose $1. I got a couple of trades on right now. I'm taking a hit, but I have an extraordinarily high probability, especially in a volatile environment, that at some point we come back around, maybe get above 101. I get out, I get profitable, I move on to the next trade. It's one of the key points of the in-out spread. Does that make sense to you guys? Okay, because this is where people are going to ask me about delta and gamma. I'm going to show that in a moment. This is a Bank of America in-out spread. I just threw this together. And Bank of America, I don't even think it's trading at 37 right now, but I threw this together because it's a real example. And then I'm actually going to look at a live trading application here momentarily. Okay. Lex is going to like this. We're actually going to go on to TradeHawk in a minute. He's going to watch me flounder. Okay. But Lex, I figured everything out on there and more. So let's say Bank of America is trading right at 37 bucks, right? Do we own the stock? No. Okay. Buy the 36 call, sell the 38 call. So what am I into the trade for? A dollar debit. The whole key point over here is, by the way, you can do this trade bearish, and I'm down with that. In fact, I'm actually going to show you bearish examples because most of them work out a little bit better. But here's Bank of America. If it was trading right at 37, 36 call against a 38 call, we sell off huge. You're like, oh, we're all the way down to 34. Okay, lo and behold, between now and expiration, we pull it together. We get to 39. What do? You make a buck, you walk away. You got to understand, it's not just about the probability from the onset. If you just looked at this trade from a probability of the onset, when I say the onset, like when you first put the trade on, if I looked at the analytics on TradeHawk momentarily, it's going to show like a 50-50 shot, 50 shot going up, 50 shot going down. But you have a better probability, okay, and capability of being able to exit the trade profitably because you defined your risk. And it's one of the critical aspects, again, to successful trading in the midst of volatility. Like right now, people, listen, you're in this volatility. This isn't going away. I saw the last question that came up to Carter and Michael. And by the way, I've known those guys for years and years. But actually, the show that they're on, Options Action, it was helped originally put together. The listening to them, I was pretty interested in hear like that final question here. What do you think about the S&P? Okay, I'm right with them. I mean, we're driving 150 miles an hour looking through the rear view mirror. Volatility's not going anywhere. You keep yourself intact, you keep yourself spread, or you're going to get ripped apart in this marketplace. Listen, this is why you want to use it. It overcomes a high probability of being stopped out. You're not going to get stopped out. Defines your risks, limits capital exposure. You never need to buy or sell the stock, and provides a high probability of success. You can initially be completely wrong in terms of price action, okay, and still come out ahead. And I always say, like you need this in your life. So the in-out spreads, you could trade massive stock products, stocks, indices. Like I just want to make sure that everybody is comfortable with the products you trade. I don't care if you trade this with Google. You can trade something with Google with $2 at risk, and that's exactly what I'm about to explain here momentarily. Mere pennies at risk. So with that, let's go to a couple of live trading examples, and for that, oh boy, here we go. So when I say here we go, so TradeHawk, I've been playing around with it a little bit over here, and I've gotten quite good. I like this, the what if. All right, so I know Lex is he's smirking behind the scenes over there.
Smirking. Here I am. Goodbye.
Yeah, I'm going to screw this one up royally. So at some point you're probably gonna be like, no, wrong click. Anyway, I wanted to show you guys a couple of spreads. So I can go out November, 25th. I can go further out in time. But here's one of the key points to make with the spreads. First of all, I know that we're not trading perfectly at 182, but let's actually pull up one strike in the money, and we're going to do a put spread to begin with. Let's actually pull up these 183, for instance, 181. Okay, so it's a 183, 181 put spread. So I'm buying the 83s, selling the 81s, $2 wide spread. Now, could I do a $4 wide spread? Of course I could, but I want to keep this clean. I want to keep it simple. You can see the price of this spread is trading, I would say right around 92 cents, and 92 cents. So why bother with these spreads? See, the cool thing about an in-out spread, first of all, you can take a look at Delta. As I said, what's good about an in-out spread? It negates everything that kills retail traders. It does, okay? What kills retail traders, right? So first of all, we'll look at Delta. So here, all right, and I'm just gonna highlight, here's these 183s. And if I take a look, there's the Delta, okay? So I am buying that little monkey, and then what? Selling this little monkey, the 181s, okay? I'm buying here at about a 50, selling here. So do I have delta risk? Yes, but I want to have delta risk. So I have basically like -5 deltas of risk. Then I look at gamma, and people go, I don't even know what gamma is. Good, you don't have to know what gamma is, because right here, I'm buying it, and then I'm selling it. You know why I'm crossing it out? Because when you buy one strike in the money and sell one strike in the money, when you look at gamma risk looks like this. So I'm buying here and selling here, and it completely negates itself. Yes? Okay, are we okay with that? So the gamma risk in here gets what? Negated. Why do I build a trade that negates gamma risk? Because it kills retail traders because they don't even know what gamma risk happens to be. Now we're getting somewhere. Then we look at theta. What's theta? Oh, theta is the daily whittling down of an option's value. Theta is your worst enemy or your best friend. But in this case, let's go theta neutral. Okay, we're buying 1024 and selling 1032. What have we done? We've negated theta. We don't need no stinking theta. We don't need no gamma. By the way, volatility, Vega. Vega and the final frontier. What do we have in terms of Vega? Yeah, I negated that one too. So the only thing I've actually done with this spread, it's a pure delta play. That's it. It's a pure delta play. And if you want to see it from a probability point of view, okay, not only do we take the trade and we just drop it down to the order ticket over here, we click our lovely lightning bolt, go to send to what if. What that basically means is now you can actually look, okay, on what if at the, well, look at profit and loss analysis. As I said to you guys a moment ago, in terms of the P&L analysis, now I've dropped it in over here, okay, it's very pure trade. It's this 50-50 bet. But the one thing you think about, in a 50-50 bet, that's 50-50 bet by expiration, because when you look at probabilities, those are what we call probability of expiring. There's probability of touching as well. And the probability of expiring is a pure 50-50. But what's the probability at any point between now and expiration, what we term anytime probability or probability of touching, okay? And there's a really high probability of hitting degrees of profitability. There's a high probability of hitting degrees of loss. The whole key to the trade though, okay, when it's profitable, we're out of the contest. You bail when it's profitable. And it's one of the key points that I just stress and stress again. Okay, you want to stay alive in volatility. You want to be profitable in volatility. Directional bias, I'm cool with it, but you got to keep intact. You got to actually have a defined risk place to be able to get in. Let's go to another one. By the way, if you guys have a stock that you want to talk about, by all means. Okay. The one thing I'll tell you though about this, okay, you want to make sure that whatever you're trading is relatively liquid. And this is where people go, I would like to trade Meta for tonight's earnings. Okay. Now Meta has, had its proverbial beep kicked out of it, which is fine. Okay. Like we can definitely trade it. The one aspect that I really wanted to touch on for just a moment is, I can go out 113 days. I don't want to go that far out. I can go much shorter term. Okay. As I start to click into the really, really short duration stuff, I can do a trade for 1 day. Here's the cool thing though about in-out spreads. Time is negated, meaning that the longer I go out in time doesn't necessarily make it, if you will, a more expensive trade. When you go out and buy a call for 6 months, that call is expensive. But if I use an in-out spread, it negates the theta component of it, right? Of course, somebody pulls up Apple. As long as you're in liquid products, okay, you're fine. But let's say, again, Meta's been beaten up pretty badly. Okay, it's beaten and bludgeoned, it's trading like 133. Like if I wanted to do this for earnings tonight and just give myself I just want skin in the game. Like I'm all about that, by the way, as a trader. When I say skin in the game, don't even bother talking to me about a product unless you're willing to trade it. And I'm deadly serious about that. So here happens to be a spread. Okay, I'm actually surprised. This one's even got a little bit of inverted skew in it right now, which is, again, it's interesting because it's just been beaten and bludgeoned. So here is a $2 wide spread, but it's trading for $1.05. I'll just toggle that right to $1 because at some point it would probably fill for that. You come in here and you go send to what if, go over to the what if, category here, and you just take a quick glance at P&L on this particular trade. Again, as pure as it is, about a 50-50 shot. But if you're going to go after earnings, what do you think is going to be effective for earnings? You just go out there and go, I'm going to short me some stock. You're crazy around earnings. Use a spread to find the risk because earnings, this is like all or none. If you're going to get involved in earnings, and earnings can be a wild time, come in, define risk. What's the worst you're going to lose? $1. Hurt me. It's not that bad. That's, I think, pretty critical. Of course, people want to get involved, in and around. Let me just get rid of that tab there. People want to get involved in and around, Apple's announcement. I'm less about earnings because I think earnings are always kind of like a little bit of a roll of the dice, right? I like to look at stuff as I had like IWM over there, but I'm a big index individual. Okay. I like to look at stuff like the QQQ instead of necessarily going out and constructing a trade around what you think, Meta's going to do or Apple's going to do, which go after a little bit of a longer duration trade. In the Qs. So one of the things, again, that's becomes very apparent to people is you can swing trade, hold a trade for a couple of days with in-out spreads. You can trade way out into the future, right? Let's get crazy. Okay. When I say way out into the future, let's go out here, 30 days. You can go out to 35 days. Look how many expirations are in the Qs. I love it. 113 days. It's a little far for my taste, but, I'll come right out here. right, to a a 34-day expiration, and I'll go ahead and start to construct trades in here. Why? It's not really going to cost me more. And again, as I said, I can build trades. For trading 282, half, I can trade something like a 285, for instance, 280, make it a $5 widespread, $5 widespread for 233 debit, done. Okay, go take a look. And again, I like to bring you over here, send a what if. Okay, the what if basically allows me to go through and build different scenarios, right? So initially, when you're first doing any kind of trade, you want to look at P&L graphs and so forth, but you want to see how the trade matures through time. So here's a spread that I just looked at in Meta that's like 1 day. But then I'm looking at a spread right now that's 35 days out into the future. And if I actually changed expirations in here and pushed it even further out, it's not really going to cost me anymore, right? So again, this is a spread that you want to evolve into in the midst of volatility. And it's a go-to thing that I will use for directional bias. Now, with that, as I said, the characteristics, perfect spread to reduce, stock portfolio risk, probability of profitability is high. Again, being wrong, being wrong and coming out right is a great thing. It gives you sustainability, it gives you duration over the direction of the marketplace. So I wanted to leave just 2 or 3 minutes for questions. By the way, if you guys would like, just go to theotrade.com/IE, and opt in to learn a little bit more about this. But by all means, Lex, you got questions? You got comments?
Oh, that was awesome. I learned a lot, actually. That was very great. That was really interesting. So I'm going to put a couple questions. I see we only have a few minutes, so let me hit a few, okay?
Yeah.
Here's the first one. I think you can see it.
So how does in and out spread compare to a double diagonal? It's a completely different beast. Right now, the double diagonal would, I'd have some fear of it. I'd have fear of it because calendar spreads in this kind of volatility, those calendar spreads, they're not really widening until right before expiration. A double diagonal is also thought of as a net neutral trade, whereas this in-out spread, it is really directional. I mean, again, the big takeaway today is that it's technical analysis, options trading. Well, I wanted to be your quant here today and say, look, if you're going to pick direction, use the following, in order to take that directional bias. But I'm not going to be an advocate of the double diagonal, maybe around earnings, but it's much more of a net neutral strategy.
Got it. Okay, let me hit another one here.
Divergence patterns help the odds for directional bias. Where do you find order flow? So when I say I looked at order flow, I had the ability, and Lex, very few people get this in their entire career, but I'm probably one of, 10 people in the entire, US and the brokerage side of the business. I was an executive at a very large firm. I got to study flow. And we actually, when I say study flow, we knew everything that clients were doing on the trading applications. And by studying order flow, you just learn basically what worked and what didn't. Okay, for instance, iron condors, people make money, get absolutely killed. In-out spreads, they were really effective. Okay, buying a call or buying a put works until volatility picks up and then they get annihilated. But you learn a lot about order flow. You don't really get to see order flow on the retail side.
Yeah, that was our little privilege back in the market making days, right?
Yeah. It was even better back in the brokerage industry because not only did we see it visually, but we got to study, times 7 million accounts. So I would do subsections of 7 million accounts. Yeah.
All right. Let's do one more here. What time is it? Oh yeah, we got maybe 2. So what about this one? Let me just lead into this a little bit. So I think I've seen a big influx of people wanting to trade the SPX. So I don't know if you have any opinions. Yeah, well, that's maybe.
Hell yeah, I've got an opinion. I come from the SPX.
Okay, so is it not for the retail sort of tolerance? What do you think?
You better be profitable for at least 18 months before you step to the S, because the SPX, it has different rules. A hybrid product, so it's partially open outcry, partially electronic marketplace. You don't know who you are or what you are until you hit a volatility day inside of the SPX. Because I'm going to tell you right now, most retail, you belong in the spiders initially. Even when you're trading some size, you stick with the spiders. I mean, what do you care? When you look at something though, like what Tradier is built, it doesn't matter. So what? Trade spiders. You're not paying for the commissions anyway in there. The SPX, you've got order routing and so forth. And I love the product. And I don't want to get anybody wrong. I love the SPX. I literally grew up around SPX traders, but you have to know what you're doing. It is the best product if you know what you're doing. But like I say, 18 months of profitable trading before you step into the SPX. Newer traders, they don't belong in there. Okay. The routing fees and so forth, it's fine, but experience before you step into the SPX. I love, some of the Cboe only products, but at the same time, like VIX, similar. Okay. It's a heavily convoluted product, but again, spreads can get wild in heavy volatility.
Great. Okay, good for that. Let's catch up later. I know they want to keep me on the tight calendar here, tight time frame. Don, that was awesome. I really appreciate it. Super great information. I know the audience loved it. So thanks for coming on. We'll talk soon, okay?
Thanks a lot, man. Appreciate it.
I know. Okay, so guess what? Break number 1. Now, for break number 1, we're going to do a little giveaway when we come back. So to be entered into our shirt giveaway, and the chance to get $100 put into your Tradier brokerage account. Okay, you have to enter into the contest. The way you enter into the contest is you have to answer this question right now in the chat. Okay, so all you need to do is type your answer into the chat. We will take those people who enter, and then we'll put them in our Spin-O-Matic wheel. And whoever wins will get the shirt and $100 in their Tradier brokerage account. Are you ready? And then we'll go for our 10-minute break. So here's the question to our first entry. If you had to dress up for Halloween, what would you be? Either a call or a put? This isn't a trick. Are you a call or a put if you want to be entered into the contest when we get back from our 10-minute break? All right, so just type it into the comments, and those who enter will be put into the wheel, and we will spin when we get back. So hang in there. We're gonna take a break now, and we'll be back in 10. Hello. We are back. Good to see everyone again. Hold on a second. We're going to do our wheel spin here. So, first of all, let's see how many people are in here. There's a good number of people in here. All right. Calls and puts, right? We're going to do 2 spins. We're going to take one winner. That's going to get one of these shirts. We'll talk about that later. And don't forget, that's our good friend at Nikki C's, SEA, clothing.com. Let me toss that in here somewhere. I don't know where I have it. Maybe Kayla, you can throw it in. There you go. So have a look at those. We're going to give a few of these away today. 20% discount with options 20. So spin number 1. I think I need to share my screen. Let me just do that. Here we go. And bomb. I think we can see this. Perfect. Let's spin the wheel. Ready? We're going to do 2 spins. First one, 2 different ones. Here we go. Okay, so there is winner number 1, Venkata Parhula. So if you can kind of just give us a little thumbs up in the comments, we have your name there. I'm assuming that's your name. We'll get your email address and send you your stuff. All right, very good. I get to play again. This is cool. My little machine here. So Kayla, I hope you have that one down. Let's do it again. For prize number 2. Robert Wendorf. Robert, way to go. Shirt and $100 in your Tradier brokerage account. So Kayla, I hope we get that one down. I'm going to stop sharing. Coming back. So let's keep moving. Our next guest. He's got a kind of a cult following, this guy, I'll tell you. Mr. Peter Stolcers. So he's joining us next. Pete, he started his career over 30 years ago on the floor of the CBOT. Now, the CBOT is the Chicago Board of Trade, not the options exchange, it's the of trade, in the 30-year bond pit. He's been the SVP for a major brokerage firm. He was a top trader for a proprietary trading firm. and he developed a state-of-the-art trading platform called Option Stalker. Pete is going to talk to us about how technical analysis drives your options trading. Let me bring him in. Pete, you there?
I am here. Can you see me all right?
I can see you all right. Everything looks great. Pete, your name's up there. I think, let me see if we have your website in there. Maybe
Love the shirt, by the way. That's a
Thanks.
nice wardrobe change.
Oh
You're
my
getting
God,
good at this.
These are bright and colorful. I like it. Very comfortable. That's that good stretchy fabric. So really nice. So what I'm going to do, Pete, is I'm not going to talk to you too much until the end with questions, because I want to give you as much time, and I know you've got a big one, so we want to get you moving. I'm going to jump out and let you get right at it. If you have a screen to share, just throw it up.
I do have a screen to share, so how will I be able to do that?
Just go down and hit present down there, and then share screen. It'll pop up, and I'll bring it into the feed. How's that sound?
All right.
Before I leave you, I'll let you do that, and then we'll get moving. All right, there it is. Good deal.
We'll share that one. Fantastic. Okay. I think we're all good. Everything look good on your end?
Everything looks great. You want to share right away?
I'm going to share right away.
Okay, let me do this, and then I'm going to leave you. And if you need help, just call me, and I'll jump back in.
All right, fantastic. I'd like to welcome everyone. Thank you, Tradier and Cboe, for having me. If you're watching this presentation, I'd like to congratulate you, because that means that you're still around. You're still making money. Bear markets have a tendency to wash out a lot of traders. This has not been an easy market to trade. At some point in your career, you're going to look back at this and you're going to know that you've honed a lot of your skills in this very difficult market. So let's get started. How does technical analysis drive all of our option trading? Why is technical analysis important? Well, there are two different types of analysis. One is fundamental, one is technical. Fundamental analysis has some cons to it. First of all, are you an expert? Do you know how to value companies? Some of you might be microbiologists and you might know how to value a biotech company. Most of us don't. Here's what you're up against. You're up against big trading companies that have billions of dollars to spend. They do satellite imaging of parking lots on Black Friday. So they're looking to see how many cars are parked there to gauge what the shopping season might be like. They do satellite imaging of smog in China to see how much electricity the power plants are generating. They have attorneys sitting in courtrooms when there's some type of patent litigation so that they can evaluate where the jury members are. They take a look at supply chains, every little component that goes into an Apple iPhone. They're looking at what these suppliers are doing in terms of their production and what the possible demand might be for it. They have their ear to the wall. They know the lawmakers. They know the legislators. I don't have access to any of this information, so I don't feel that I can compete trading options with a lot of these larger firms who do extensive fundamental analysis. The other issue with fundamental analysis is that you can have the best stock fundamentally, and it can be dead wood for a very long period of time. And so stocks that just sit idle are not of interest to us if we're option traders. Sure, you could say, well, gee, I can just sell some out of the money naked puts to try and acquire the stock. But if it's dead wood, the option premiums are going to be very small, and it's not going to make sense for you to do that from a risk reward standpoint. So if you have a stock that's not moving, and by the way, this could have been a great value here. So you sell some naked puts. Oops, I'm long some stock, but I'll sell some naked puts here. Now you're long more stock, you're long more stock. This price action is what you need to pay attention to. This is technical analysis. This is what the smart money is doing. They are exiting that stock. If you did feel that there was a compelling value for you to have on a fundamental basis, then you would set an alert and wait for a breakout through this horizontal resistance point. Again, technical analysis is leading the way. Technical analysis also allows us to follow the smart money. I'm going to show you some trails of breadcrumbs that institutions leave behind. I want to let them spend their billions of dollars doing all the research, all the fundamental research, and then when they're ready to go into the stock, I'm going to follow that money and follow that trail. Technical analysis will allow me to do that. In this particular case, you can see a nice compression, a horizontal resistance level with a number of touches. Look at what the S&P did. The S&P was selling off this whole time. That's the gray line. What was Netflix doing? It was actually holding its own. It was treading water. Why does it do that? It should be going down with the market, right? Well, every time that the S&P was selling off and that there was a temptation to sell Netflix, there were buyers waiting to gobble it up until finally you've got an earnings announcement here and a big breakout. As soon as the market starts to go higher, Netflix is breaking out. So this relative strength is something that I'm going to be teaching you during the course of this presentation. Direction, duration, and magnitude. Those are super important concepts. What do you expect the stock to do? Very, very important. And no matter what option pricing software you use, it's not a magic weapon that you have. It's going to ask you for inputs. Those inputs are going to be duration and magnitude. So you're having to determine those inputs. Technical analysis is going to help you do that. It's going to allow you to quantify these variables. In this particular case, you've got the S&P 500 selling off. You've got a downward sloping trend line that's been breached to the upside. You have a horizontal resistance line right here that the S&P 500 was able to get through. Now what? Okay, I've got something that's attractive to me technically. How far might it possibly go? Well, it could get up to the 100-day moving average, this black line. Could get up to horizontal resistance. That could be another target. It could get up to the 200-day moving average. These are all possible ways for us to evaluate the direction, duration, and magnitude of the move. And we can take a look at what velocity we have during the course of that move to help us determine which option strategies we should be using. So which strategy, which strike price, which expiration date, those are all determined by your opinion of the duration and the magnitude of the move. And your opinion is going to determine the best options trading strategy. And that's all accomplished through technical analysis. Finally, you are able to get a level of confidence in that trade. And I view this as check boxes. So those check boxes might be stock has a nice downward sloping breakout to the upside. It's got heavy volume. It's through a major moving average. It's through horizontal resistance. It's got some stacked green candles to it. Check, 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 check. With every checkbox that's marked, your confidence increases and your probability of success increases. So you can predict direction based on price action. Now, in this particular case, and when you're flipping through charts, in this instance, I can't tell you what this stock is going to do from one day to the next because it's choppy. It's all over the board. Yes, you're going to find some gurus out there that tell you, well, you just need to sell when the stock gets up to resistance and then you need to buy when it gets down to support. Well, if I'm operating under that premise and I'm long in here waiting for it to get to the upper part of the range, well, the bottom falls out here. The long and short of what I'm trying to tell you is that this would not be an attractive chart to trade options on because we want breakouts, and the breakout is what gets it on our radar, but it's the follow through that makes us money. And in this particular case, you're just chopping all over the place. You want to look for nice, orderly price action when you're flipping through charts. Well, what does that look like? It looks like this, where when you get a nice little downtrend, it tends to continue. When you get an uptrend, it tends to continue. Nice candles of a single color stacked. You can see this nice tight price action and this longer term uptrend. Small little pullback, breakout. These are all bullish flag formations. So nice orderly price action, something that we want to look for. That's going to increase our probability of success. It's also going to increase our ability to predict where that underlying stock is going. It's all about getting the odds stacked in your favor, and spotting those trends is super important. So in this particular instance, there would be no reason to abandon this stock and to try and short it until this major trend line is violated. And yes, you do also have some horizontal was resistance, now is support, that also would need to be breached. Until that happens, you're going to be sticking with the long side on that particular stock. Heavy volume legitimizes the move, another form of technical analysis. It tells you that the institutions are in there buying or selling that particular stock. In this particular case, we've got really nice heavy volume on this breakout. This is Netflix, and this was their earnings announcement. You can see the B here, where we get this big gap up, and then stock is able to preserve that gap, and it preserves the opening price there as well. A day of rest, and then it's off to the races. So that heavy volume is telling us that this stock is ready to go. These compressions are actually very, very powerful. The longer and tighter the range, the bigger and more sustained the breakout. So compressions are awesome trading patterns to take advantage of. So if technical analysis is important, what do we need to learn? Well, I like to keep things very, very simple. Trend lines are very important to me. I trade them a lot. You want to see nice gradual trend lines, and you want to see lots of touches along the way. And when you finally do break a trend line, you want to see the underlying blow through it. You don't want it pecking away at it. You want it to blow through it. You want to distance yourself from it. So the more touches, the better. They legitimize the trend line. The longer term the trend line, the better. The more gradual the trend line, the better. Very, very steep trend lines are easily violated. That doesn't mean that the stock is ready to roll over. It could set up for a bullish flag formation, just like the chart that I showed you a little bit earlier. And we want to attack these trend lines, and we want to blow through them. Basic technical analysis also includes horizontal support and resistance. Those are really easy to spot on a chart. The longer the better, the more touches the better. Nice tight compressions, and those breakouts from those compressions are very high probability trades, just like the Netflix trade that I had showed you a little bit earlier. Major moving averages. This is simple stuff. I'm looking at the 200-day, 100-day, and 50-day moving averages. And we want to also blow through them. We don't want to peck away at them, be above it, below it, above it, below it. When we attack a major moving average, we want to have a long green candle through it, closing well above it, not flopping around back and forth. We want to see heavy volume. We want that escape velocity, because those major moving averages are like magnets. And we want to get through it, and we want to blow through it. And they're relevant because everyone uses them. I do not use the moving averages on intraday charts, only on daily charts. Price action. I could write a book on price action. I use a lot of price action. I'm going to show you a few patterns that really could help you identify some high probability situations. But price action is very, very important. What is the context of the current move? How does today's move fit into the longer term picture? So we always need to start with the longer term picture. Then we need to drill down into shorter time frames. Even if you are a longer term swing trade, that shorter term analysis is going to help you enter and exit the trade more effectively. Stacked long candles with little to no overlap on heavy volume. This is an incredibly powerful pattern. The next segment by Rick Sadler is going to focus on some candlestick patterns and do a little bit more on technical analysis. So I'm just going to show you a couple really powerful patterns. This one is super, super powerful. You can see how the open is almost the high of this red candle. The close is almost the low of that red candle. Tiny, tiny wick, tiny little tail. Another one and another one. When you get three of these stacked in a row on a 5-minute basis or a daily chart, doesn't really matter what type of chart you're looking at, this is a signal that the selling pressure is very, very heavy, and you're going to get some continuation. Now you can look at this and say, well, look at these beautiful stacked candles here. No, these are not the same. This is much different. you get this nice long green candle in here. But wait a minute, look at this long wick, almost half of that candle retraced. Then you get into the next candle. Whoa, that almost went down to the low of the previous candle. Yes, it finished green, but these are very different because you're retracing throughout that candle. That is not the same as that. So it's important when you're learning patterns that you're very picky about the pattern and the setup. This is a wham, see you later, wham, see you later, wham, see you later. Can't come up for air. This has lots of buyers and sellers moving throughout that entire rally. So they're in and they're out. You can see how eventually the sellers prevail. Mixed overlapping candles. Well, what does that tell us? Mixed overlapping candles is a sign of weak trend strength. Just like those stacked candles were a sign of strong trend strength, weak candles tell us that there is some resistance building at the high end of this range. Got lots of green, lots of red. We've got wicks above the body of the candle up near the high. That's also a sign of resistance. Get your upward sloping trend line. And then now you can see how those were the signs that this move was exhausted. Tiny bodied candles is another characteristic that you would have seen in the previous slide. Basic technical analysis, show you a couple of candlesticks. Again, Rick's going to get into detail on some of his favorite patterns. Bullish hammers. This is a bullish hammer off of a relative low. This happened earlier this year. You can see how the market opened here, sold off hard, rallied back to that opening price, and finished well above it. This is an indication that support is in. Long tails under the body, also a sign of support. Important to understand those candlesticks, bullish engulf. If you look at an S&P 500 chart just a couple of weeks ago, you're going to see that the market gapped down and then it rallied the entire day off of a new low of the year. This was a very significant candle. It's something that we had discussed in the chat room, and it paved the way for the bounce that we're currently in right now. Long wicks and long tails, we've covered that a little bit. In this instance, off of a relative low, long tails underneath the body would suggest support. Try and hammer it, rallies back. Tried to hammer it, rallied back. Tried to hammer it, rallied back. These tails are telling you something. They're telling you that buyers are buying those dips, and that's why you're starting to see some liftoff, and it's telling you that there is support at that level. So those are some basic technical analysis techniques that you can use. You don't have to get real sophisticated with it. Where do we start? Those of you who have watched any of my videos, those of you who have been subscribers of mine in the past know that everything I do starts with the market. Market first, market first, market first. If you don't learn anything else from me, learn that you have to focus on what the market is doing. That's the biggest mistake that I see most traders make, novice traders in particular. I like Apple. I like Tesla. They don't even know what the heck the market is doing. And no matter how good Apple and Tesla are, if the market is selling off, you are going to lose money getting long those stocks. And you just look at what Tesla and Apple have done this year. They may be great companies, but they are not going to fight the market. 75% of all stocks follow the market. Super important point. Let me rephrase this. If you don't get the market right, there is a 75% chance that you are going to lose money on your trade. If you get the market right, all of a sudden the odds have shifted in your favor. Always have a chart of the S&P 500 up. Always, always, always. You have to know what the S&P 500 is doing. That is your starting point. This is the first tumbler. What do you mean the first tumbler? This is like a gigantic combination lock. And when all the tumblers line up, you have a window of opportunity for a high probability trade. Well, this is the first and most important tumbler that you have to get right. So you got to know when conditions are good, and you should also know when you should avoid trading. It's another big mistake that most traders make is they want to trade every single market. Every single day is the same. Well, it's not the same. There are times when you can really swing for the fence. There are times when you have to sit back and maybe not even trade. Your confidence in your market forecast is going to drive all of your option trading. This is a chart of the S&P 500. These blue shaded windows are really nice opportunities where you can get more aggressive with your trading. Upward sloping trend line, breach to the downside. Nice follow through here. Now you get a gap higher. You've got to start taking your gains and expect that you're going to get into a sideways market. This is a low probability environment here. Up, down, up, down, up, down. You have no market tailwind. Downward sloping trend line, breach to the upside. Nice follow through, horizontal resistance, 50-day moving average. Okay, this is good stuff in here. Now you've got another trend line that's breached to the downside. That's a good window of opportunity. Longer term trend line here, breach to the downside. This is garbage in here. There's not a lot of trading that you can do in here, although now that you have that bullish engulfing candle and you start to see a series of higher lows, okay, now you can start to sell some out of the money bullish put spreads. And now as you start to get through technical resistance, you can shift gears and get even more aggressive. Stock second. Why don't we just trade the S&P 500? If we're doing our market analysis and we're good technicians, why can't we just trade the S&P 500? Many of you are going to do that, and I trade the S&P 500 actively, by the way, but there's no real edge to it, certainly not like there is trading stock. There are thousands of stocks that you can pick from, and they are going to have perfect technical setups. So why not use that to your advantage? The power of relative strength. This is an edge that I have traded for over 20 years and it still exists. And this is a great way to see the breadcrumbs that institutions leave behind. Instead of trading the S&P 500, if I thought that this was a long-term support level right in here and I started loading up on S&P 500, the bottom drops out, I am going to lose money on that trade. Again, the gray line being the S&P 500. If I find a stock with relative strength and I think that this is a market bottom, but I trade the underlying stock as a surrogate position, the bottom of the market drops out. But look what this stock does. It continues to move higher. It gives me time to evaluate the backdrop in the market and to exit the trade if I need to without getting my head handed to me. Relative strength is a huge, huge advantage. Why does it exist? It's a tell that institutions are out there accumulating that stock. They don't care that the market's down, 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 down. They want to buy this stock and they are bidding it up no matter what. Options last. If you get the first two parts of this equation right, the market and the stock, you can trade almost any option strategy and make money. So work on your win rate. Try and get your win rate to 75%. Trade one share of stock at a time until you get that win rate up. Then you can focus on options strategies. I like to keep it simple with vertical spreads, debit spreads, and credit spreads, and buying calls and buying puts. I can cover almost any scenario. It's just a matter of how close to the money I want to go and how many contracts I want to do. And that's how I throttle my risk, but I keep my positions very, very simple. How do we form an opinion? We're getting close to the end here. We need our long-term market opinion and our short-term market opinion. Then we need to evaluate direction, magnitude, duration of the overall market, and we come up with our level of confidence. Then we drill down, we look at the stock long-term, we take a look at the stock short-term. Again, we're evaluating direction, magnitude, duration. We come up with our level of confidence. So let's find a trade. I still got about, I think, 10 minutes left or so. Market first. Let's do some market analysis. Weekly chart, long-term uptrend, breach to the downside. Now we have a downtrend firmly in place, multiple touches. Longer term downtrend prevails. That has to be in the back of my mind. We do have some horizontal support starting to form. Here's where we're at on a daily basis. Long-term downtrend, breach to the upside today. Actually, we're above the 50-day moving average as well. So we had that bullish engulfing candle. That's nice. That tells me a bounce is coming. We get through this horizontal resistance. We get through the downward sloping trend line. These are bullish factors on low volume. So I have to temper my excitement. Also have major earnings coming up after the close today and tomorrow. Also have an FOMC next week. So long-term trend is down, short-term horizontal resistance and downtrend breach to the upside. That's bullish. Bullish engulfing candle tells me that a bounce is coming. Today was kind of a key tell for me. Market held the breakout from yesterday, even after weak news from Google and Microsoft. That was pretty impressive to me. So it tells me that this bounce might continue. I'm trading against the longer term downtrend, so I need to use smaller size and I need to use more conservative strategies. Big earnings and FOMC on deck. So my market confidence on the upside, fairly low, but I am biased to the long side. So how am I going to use all of this information? I'm going to look for some really good, strong stocks, and I'm going to sell out of the money bullish put spreads on those stocks. So now we're going to take a look at the stocks. I've got some picks for you. I told you I would give you a pick. I lied. I'm going to give you 3 picks. Love this Netflix breakout here. Love the fact that it held the gap. We've been selling this for the last few days, actually. And you can see how the stock is continuing to move higher. I still believe it's going to hold that 200-day moving average right in there, which puts you at 276. I like selling the 270, 250, 270 put credit spread for a 50-cent credit. And I like using the November 11th expiration. That gives me that support level to lean on. And that is, it gives me the 200-day moving average to lean on. And I can see that the stock has strong upward momentum. I believe it's going to continue. Stock's around 300. We're all the way down to the 270, 250. So way out of the money. And I believe the stock is going to continue to move higher. AEHR. Post earnings play. There's your earnings right there before the open. Downward sloping trend line, breach to the upside, horizontal resistance, blew through that. Excellent relative strength. You'll also notice market's been down, down, down. What's this stock done? This stock is in go-go mode. They really like this stock. So in this particular case, I'd like selling it out of the money 1750 put. I can get 50 cents for that. That puts me in a long position right at that horizontal breakout. One final one, ENPH, earnings after the close yesterday. Love this breakout here, downward sloping trend line, another stock that's been super strong during the market decline. 100-day moving average here, longer term uptrend here. So I would like to sell a 260, 250, 260 bullish put spread. Have that support, and I have that support to lean on. 260, 250, 260 put credit spread, 45-cent credit. 3 weeks, you'll make about a 20% return on that trade. That's how I would be approaching it. So options last. One final note, get your win rate above 75% before you trade options. Options are a leverage product. That means you'll lose your money faster than you would if you're trading stock. So until you get a good win rate up, you do not want to be using leverage. Keep it simple. Buy options when your confidence is super high and you're expecting a big move. Sell premium out of the money when your confidence is fairly low. Distance yourself from the action. Take advantage of time premium decay. If you want to find out more about what we do this stuff every single day. Exactly what I showed you today is what we do constantly. can find out more about what we do at oneoption.com. Much of the information on my website is free. I want you to learn how to do this, whether you use our product or not. So let's see if we've got some questions. I hope I stayed within my timeline.
Pete, I know you're worried about that, but man, you were perfect, right to the number. Way to go.
Good. So any
Yeah.
questions?
Yeah, let me put one up here real quick. I noticed this one came in a little bit ago. And folks, if you have some questions, type them into the comment section and we'll get to them. We've got about 3 or 4 minutes here. So what patterns do you like for intraday trading? Is there such a pattern? Is there such a thing for you? I mean, maybe it's a little more swing trading.
Well, I love those stacked candles. As soon as I see those stacked candles of a single color with little to no overlap, if I get 3 of them in a row on a 5-minute chart, yes, I definitely like that. If I am trading on the long side, I want to make sure that the stock is above the prior day's high. So I also want to make sure that I don't have any resistance. I want clear sailing ahead, blue skies.
Okay.
So yeah, I love that pattern.
Okay. Let's try this one here.
How do I feel about the S&P 500 today? I liked what I saw this morning. I like the fact that the market was able to overcome negative news from Google and Microsoft. And I like the fact that we were able to, on the first attempt, fill in the gap and also take out the high from yesterday after a weak round of news. So yeah, I like what I saw today.
Okay, good. Here's another one for you, Pete.
What do I think about delta neutral option strategies? I'm a directional trader. If I don't have an opinion on the underlying, then I keep looking for a stock until I can form an opinion. You're delta neutral in a position 2 times during the trade. One is before you put it on, and the other is when you take it off.
Got it. Okay.
The rest of the time you're adjusting. That's not how I trade.
Right. And then you're a big fan of credit spreads, call, put, depending on what the charts are showing. Is that right?
Very much so, yes. In particular, bullish put spreads for swing traders and longer term traders. Market is typically flat to higher about 80% of the time. So selling out of the money bullish put spreads is a really good strategy. And we will get back into that hopefully next year. I don't see that the market's going to take off anytime soon, but
Right.
when that support level is established, that'll be a super viable strategy.
Okay. Let me look at my time. About a minute left. What time frame is best? So, yeah.
Well, I think that's a question that you have to answer personally. If you're a professional day trader, 5-minute bars are what I use, and I'm a intraday trader. But if you're a working professional who can only spend an hour a day evaluating markets and maybe 10 minutes during the course of the day, then you're really having to take at least a 2 or 3 week kind of trade duration. So I really think that's a really personal preference.
Okay. Got it. Let's I think I know the answer to this one. I'll throw it out there for you. And then we got take one more after this.
No, I don't use butterflies very often, and I'm not looking too much for pins. The pin is something that you can take a look at a day or two before expiration, and I have an indicator called max pain that tells me where that might possibly get pinned. But if you're a distance away from it, then it's irrelevant.
Okay. Got it. Let's do this last one, Pete. You did great. Thank you so much. Let's tackle this one if we can. And then
head and shoulders, cup and handle, all of those types of things. I'm familiar with them. I can spot them. It's not something that I look for. I'm more interested in trend line breaches, horizontal support resistance, major moving averages. And then if they happen to coincide with those patterns, I'll notice it, but it's not something that I search for.
okay. Got it. All right, Pete. Well, that wraps up our time. Thanks so much. You always bring your big following with you. I love it. They're enthusiasts for you, man. All the comments.
We're making money. We're doing really well. I've taught so many people how to trade. It's exciting, and I love to share my passion. So thank you all for attending. Thanks for having me.
You bet, Pete. Anytime. We'll talk soon. Okay.
All right. Thanks
again.
Bye now.
All right. Thanks to Pete for that. That was awesome. All right. Next up, our next guest is Mr. Rick Sadler. He's founder of Hit and Run Candlesticks, Trading for Profits. Rick and I go pretty far back, as we met one convention in Las Vegas several years ago. We became good buddies and have stayed in contact ever since. Rick started trading in around 1988. He started reading books, following traders, and watching webinars. Now he teaches the 9 pro tips he wishes someone had told him about when he first started trading. And these 9 trading tips has made him literally an expert today. So Rick, I'm going to bring you in here. Come on in. How are you?
Hey, I'm good.
You've been on here. Yeah, we got sound. You've been waiting patiently, Rick. You've been in the green room the whole day. I saw you the whole way.
Well, making sure I could get in, and I've been running around here though.
Okay, good. So I'm going to let you get at it. Do you need to share a screen?
Yes, sir. Let's see.
Let's do that before I hop out, and then you can go at it, and I'll come back in as time approaches.
Let's see here. Screen share. Share this. Share screen. Which screen? Share 2 monitors.
Yep. Pick the one you want us to see.
Is it giving me start sharing? Well, I'll share a screen. Oh,
yeah. Try that and see what we get.
There we go.
Yeah, it'll take a second.
Maybe this one. There we go.
Okay, so it's going to look something like this.
There you go. Hey, that's it. All right.
All right, good deal. So, Rick, I'm gonna let you go at it. If you need anything, just holler. I'll jump in. But off you go. How's that sound?
All right. Thank you very much, Lex. I appreciate it. Hey, hello everybody. My name is Rick Sadler. Thank you so much for having me here. And Lex, Lex has been very, very, very helpful to me personally. The Tradier, I use Tradier, and TradeHawk, the platform TradeHawk, I use that. And both Lex and Tradier has been just absolutely fabulous. If I have questions or troubles or anything, they definitely get me through it. So thank you so much, guys. I appreciate it. Pete, I want to thank you very much. You mentioned my name a couple of times while you were doing your presentation. I watched your entire presentation, and I appreciate it. Very nice, by the way. And the whole crowd today, I was, when I found out who I was here with, I was, wow, my goodness. I had to bring my wife and show her everything, who I was talking with, and I really, really appreciate it. So thank you so much for having me here. It's humbling, very humbling. Okay, so let's get started here. Again, my name is Rick Sadler. What I'm going to talk about today is 9 basic trading principles. We're gonna look at some charts. I may jump through some slides and then jump through some charts. I love questions. I truly, truly love questions. There's nothing worse than somebody being up on a stage or behind a microphone and nobody laughs at the jokes or nobody has questions. It's horrible. So please feel free. So a little bit about me really quick. I trade price action and candlesticks. Price action and candlesticks are pretty much the same thing. And I do that. Candlestick patterns. I follow candlestick patterns. I use moving averages. I'm a huge moving average fan. I draw trend lines. I certainly look at support and resistance. Moving averages are nothing more than a trend line that moves around a little bit, but it takes the average of the price action. And honestly, maybe I'm a little bit lazy, but that tends to do it for me. So I follow a lot of moving averages. Scanning that I use a live trading alerts for a scanner to scan for the setups for the chart patterns that I'm looking for. And a lot of my scans in the background have moving averages. For instance, I want a moving average trending either bullish or bearish, and then I want that setup in there, and that's what I look for. I'm a short-term swing trader, okay? I'm not a day trader. I'm not a scalper. I'm a short-term swing trader. My definition of short-term swing trading is overnight to maybe 10, 15 days. I many times only hold a trade 3 or 4 or 5 days. Excuse me. I'm fighting a cold a little bit, so bear with me if I have to grab a Kleenex or something. So I'm 3 to 5 days. I'm perfectly fine with that. And my goal is to put away money in my pocket. My goal is not to pick the bottom and pick the top of a chart. My goal is to make the sweetness in the middle right there. So so to me, it's not about picking a target and hitting a target. To me, it's about hitting my financial goal. That's more important to me than being, entering at the bottom and then closing at the very top of a trade. It's more important to hit that financial side of the goal. Darn it, I just clicked away all my little arrows there, but that's all right. I trade directional options. As far as options goes, that's all I trade, directional puts and calls. I look at, when I'm looking at a chart, say we're looking at a long chart, and I see, let's change that to a different color. I see it move up. What I'm looking for is a pullback. This would be a typical setup. I'm looking for a pullback, looking for buyers to come in. And then what I want to do is profit into that swing right there. If I'm going to buy a put, I'm looking at the other side. Really what I do is everything I do is from the chart. The options is simply a tool. I've described it recently in our trading rule as, if you go to the grocery store and you buy groceries, you go out to the checkout stand. You can use cash, you can use a checkbook, you can use your credit card, a debit card, you can use your Apple phone these days, or other phones maybe, I don't know. There's a lot of ways to pay for it. Well, it's the same thing for me with trading. Trading stocks is about going to that grocery store. I'm going to find the groceries. I'm going to get those groceries, and I'm going to pay for them with either a stock or an option. And so options to me is just a way to trade the chart. Okay. I do trade stock, not very much, not very much at all. But I do. I've got some stock positions on now but overall, most of the time, I would say 98, maybe 99%, I trade the option. When I look at a chart, when we call out a chart and send it out on the members app, we're buying XYZ maybe. I'll put the option that I'm doing or the stock that I'm doing, but like I said, 99% is the option. It doesn't mean that you can't trade the stock, because everything is about the chart. Okay. I think there's 9 principles to trading there's a lot, there's there's a million rules you could write down on candlesticks or trading in general. There's rules about candlesticks. There's a rule about trend lines. There's rules about entry, rules about exit. There's rules about everything. I tend to follow the 9 basic. I try to. I'm human. Do I fall off the wagon every now and then? Yeah, I do. Do I? Well, you know what? I'm not going to follow that rule. I'm going to push this a little bit. Do I do that? Of course I do. But I do believe that if you do follow a good set of rules, I'll try to share with you what I think 9 of them are. Your trading will likely improve. And I doubt seriously anybody out there would argue with that statement. It's trading should be rule based. When you use your emotion or your gut, that just doesn't work out. I tell folks in the trading room, if you have a gut feeling, odds are it's not about trading. You really need to go to the bathroom. That's probably what the gut feeling is. It doesn't have anything to do with the charts or trading. So stick with the rules here, okay? Oh, did I do that right? Huh, didn't know I could do that. All right, principle number one. Now, I happen to think principle number one may be the most essential and may be the most important principle of all. And what I would like to do is show you a chart here if I can. Let's do this. And I'm going to look at the SPY here, all right? And then I'm going to go up to this chart right there. Now, I think the number one principle is trade in the direction of the market. That's what I think that is one of the most important things. We'll talk about counter trend trading in a second. Trade in the direction of the market. You know, if you are, say, over here, this would be a long trade right in here. This would say that the market is saying be bullish over here. And if you're trying to be bearish, you have to think there's a 900-pound gorilla sitting on your chest right now. If you are trying, and there's no question that there may be a chart out there that's shortable. But overall, if you're trying to short in a market that looks like this, odds are it's not going too good for you. I mean, you may have one that's working out, but you're going to have 9 other trades that might not be working out so good. So the net result is 0. And I just think that's painful. On the other side, if you are just bound to determine to be a bull right here, then things are probably not working out for you so well, because the market, and I mean, and my market tends to be the SPY. Whenever I refer to the word market, that I'm referring to the SPY. I look at the Qs. I like to look at some of the big tech like FNGU, things like that. But when I refer to the market, it is the SPY that I'm referring to. So I want to trade in the direction of the market. Now, here's something that's sort of personal, maybe to every trader, and I'm going to share my personal about this, is how do you determine the direction in the market? And everybody might have a different idea what the direction of the market is. An example, there could be an awful lot of traders out there that look at the market and say, well, the market is definitely bearish. I totally agree with you, by the way. All right. I 100% absolutely agree with you. Now, remember, I'm a short-term swing trader. That's what we teach, is short-term swing trading. So while we have a bearish market, we certainly have had some nice bullish relief rallies in here too. And it is all shown by this chart. Now, again, let's go back to that personal side of trading. You know, how do you determine what a trend is? And you could put 10 traders in a room, and depending on their time frame or depending on their outlook, everybody might be a little bit different. So what's important is to establish what your rules are and then trade within your rules. And establishing a trend is establishing a rule. What I use, these are the 2 basic moving averages right here is what they are. The white line is what we call the T line, which is nothing more than the 8 exponential moving average. And the red dots and green dots, this is what we call the trendicator. Now, if you guys can all keep a secret, I'll tell you what it's made of, okay? But you have to promise me to keep a secret here. This is important, okay? Very important. Here we go, ready? It's nothing more than the 17 exponential moving average. Now, hold on, before you just write that down, before you take notes, before you tattoo that on yourself, not that I hope anyone does that, is it's not that the 17 EMA is important. It's not. You could use any moving average you like. Any moving average you like. Now, what you're doing is you're establishing a way to trade, and then you are, well, why don't I have my tool here? There we go. Let's try this right here. Excuse me. There we go. What you're doing is you're establishing rules, a system, and then you are trading around that system. You're not letting your system or a lack of system trade around you. You're not trying to fit yourself to everything under the sun. You create the sun and you fit yourself inside that sun, whatever it may be. So while somebody else might be looking at maybe something slower, say, than we could magically do that. Keep an eye on this. And I want to share with you guys right now, I only have a set amount of time here. Okay. I'm not going to finish. I know this. I'm already one slide and here I am. So I apologize right now. I'll try to speed it up. But this right here is important. Like I said, this could be arguably the number one rule that I believe, in my humble opinion, is important in trading. Keep your eyes on this the red dot and green dot. Again, it is nothing more than the 17 exponential moving average. I'm going to change it to the, say, the 50. I'm going to leave it exponential because I don't want to mess with that. So I'm just going to change it to 50. Look how it changed. See how it changed? So somebody that might say, and forget the white line for a moment. Forget that. Just look at the red dots and green dots. Somebody that's looking at the SPY and says, okay, it's maybe bullish right now because we have the green dots. I'm going to go back to the 17 right now. I think. There we go. I'm going to go back to the 17. I was bullish 2 or 3 days ago on it. So again, you see how it can be very, very personal. You see how it can be very private to you as a trader, because we're not all the same. We don't use all the same moving averages. We don't all use candlesticks. We don't all use price action. We all have our twist on how to trade, and that's okay. There are millions and millions of successful traders, and there's probably as equal amount of traders that are not so successful. Like I said, if you have a system, follow your system. Don't just trade willy-nilly and try to fit systems to you. You work around what you have. I apologize again. I've got a cold here. Let's put this back up here. All right. So rule number two. I'm not going to spend a lot of time on rule number 2 because rule number 1 is much like rule number 2 is much like rule number 1. Trade in the direction of the chart you're trading. I am gonna go look at a chart real quick here. So let's look at a chart, and let's just take the SPY right here. Okay. No, let's look at this chart again. This will be better. See how we're in a downtrend right here? See, we're in a downtrend, and you see the white line right here, or the white line right here, how it's tilting up. This is the 8 exponential moving average. The only way for this to tilt up is if price is moving up. If price is moving up, price moving up. That's the only way. That it is impossible. It is impossible for this line to go up without price going up. Absolutely impossible. But that doesn't mean it's a buy. Not that I follow the rule 100% of the time. Sometimes, I fall off the wagon. It is true. By and large, if we don't chase candlesticks, and I love candlesticks, I love price action, but down here, you got to know there's some kind of price action tipping tipping that white line up. Here, I can put some candlesticks up. See that right there? Oh my gosh, let's get bullish on the SPY, right? No. And by the way, it doesn't matter whether we're looking at the SPY or we're looking at an individual chart. A chart is a chart is a chart. So this might be just the best one we stay on today. So if we start moving up, that is not a reason to be long, because we didn't get green here. You didn't have follow through. Bottom picking. Bottom picking is bad news. That's just bad news. It's embarrassing. It is. In fact, I tell people in the trading room, look, if you're going to bottom pick, just send me your address. I'll get into Amazon and I'll send you a box of gloves, because bottom picking is just wrong. Wait for the trend to start. You want the trend moving up. That's where all the money's at. Stop and think about it. Go look at where you've made money at. I'll bet you steak dinner that the lion's share of your consistent money is made when the trend is up or down. Trade with the trend. Okay. So let's not get bullish on the SPY here. We didn't get green. Let's don't get bullish on this great big bullish candle here. Nothing here had follow through. All of a sudden, we started to get follow through. Now we start talking about it. And that's exactly what I did. I started talking about the bullish activity up here. And now we can start looking at some bullish activity as long as we remain green. Now, if you don't believe that, don't believe me, go prove it to yourself. Let's do this. Look at that chart right there. Absolutely beautiful. All you've got to do is follow what the chart is doing. I'm not going to change colors here just for time. Look at that. That's sideways choppiness, nothing there. Look at bearish, bullish, bearish, bullish, bearish, bullish, bearish. We're just starting a little bullishness now. Just starting. And by the way, I want to stop right there. I don't want anyone to think that I'm bullish on this market. I am not. I've got some bullish trades on. Yes, I do. I've got a couple of short trades on. Yes, I do. I am absolutely willing to take a bullish trade when everything is bullish, but I'm not bullish on the overall market. I'm looking for the market to go down further. We'll see what happens, but that's what I'm looking for overall. Let's get back to our PowerPoint here if I can. Principle number 3, plan your trade. This is where most people get bored and turn things off. Okay, nobody wants to plan their trade. Nobody really does. And bear with me here. Don't throw tomatoes at me. I've been doing this for over 30 years now. I've seen it all. I've got the T-shirt. I've got the bruises on my body to prove that I've had bad trades and bad experiences in trading. And since teaching and coaching, this is one of the things that, and I used to be this way. I don't care about your plan. I don't care about making a plan. Just give me the trade that works. That's all I want. Just show me the chart pattern that's going to make me money. Show me the candlestick pattern that's going to make me money. That's all I want. But I got to tell you, you don't make a plan in trading, it's never going to work out for you. It just will not work out for you. Not in the long term, not for consistency. And if you don't have consistency, there's no long term for you. None at all. So I'm gonna jump to a chart here, and I'm going to show you how to do a quick plan in just a matter of minutes. Okay. I'm going to move this out of the way. Let's look at, on my scanner right now, I see Twitter is moving up. So let's go look at Twitter, see if that's worthwhile. All right, let's look at Twitter. So whether you like Twitter or not, it doesn't matter. That's not what we're here to do right now today. Right now, I'm here to set up a plan on how maybe we could trade this trade. I'm going to take a quick peek at the weekly chart. I do that only so I can see more of the chart without doing this. If I take the daily chart, I'm going to shrink it up so I can't see it. So rather than do that, what I'll do is simply look at the weekly chart, and it gives me everything I need to see. And all I need to see is things like this top right here, right through here. So, and all I'm doing right now is I'm building targets in there. That's all. So now what I'm going to do here is I'm going to set up a stop. And I'm going to show you, this is how, this is a simple way to put a trade plan. And once, if it wasn't for me talking, I could have this done in about 30 seconds. But talking and explaining, it's going to take a little bit longer. So let's do this. I'm going to split the middle only because it's unfair to use the bottom, but I don't think it's fair to use the top of today's candle. So let's move up there. See that number right there? That tells me there's 31.5% that I'm looking for in this trade based on the targets that I've got lined up here. So now let's do this. Let's come over here and we'll take about right there. And I'm going to come over here. I'm going to paint this red like that, make that a little bit bigger. And there you go. Now, we can tighten this up a little bit based on however you trade. But I heard somebody before me mention, we want to look for at least a 2, maybe 3 to 1 risk reward ratio in a trade. This is not hard to make a trade plan right here. Like I said, you can do this in 30 seconds. It just took me longer because I was talking through it. So here now we have a trade where if we were to buy it right about where we are, actually a little bit less here right now, boom, right there. We're looking at a 5.65. And if you feel you need to drop this down, then you can certainly drop that down. If you feel you need to, you want to make that your low. I'm not here to tell you where to put your stops. I'm just showing you how to make a trade plan. So with a 31.25% possible profit area from about right in here, and then you're looking at an 8.4% risk, you definitely are within your 2 to 1 or 3 to 1 win loss ratio right there. That wasn't hard to make a plan. Every chart, everybody should have something like this on your chart. Where's your stop? Where's your entry? Where's your targets on a trade here? So that's a trade plan. It's a must, and it's so simple to do. It's not hard to do. What time is it? I just want to make sure that I'm kind of close here. All right, let's go back to that PowerPoint. Principle number 4, wait for the entry. Okay, wait for the entry. I have 3 basic entry patterns that I like. It doesn't mean that's, everything that we use, but I do have 3 that are, my basic entry pattern. And one is probably our most favorite of all is what we call the 3/8 trap right here. And basically it's where a chart has rallied up, has pulled back. I like to see a green bar. So I'm kind of adamant about that. Again, that may be personal preference here. And then what we've got, the 3/8 trap, the 8 stands for the, there we go. The 8 stands for the T line, or the 8 exponential moving average. And let's just say, whoa, that's pretty big, isn't it? Let's say that that's the 8 exponential moving average right there. That's maybe a little unfair, maybe something like that. And then the 3 stands for the 3 exponential moving average. I'm going to turn that into a line though. And the 3, or pin 3, let's see, the 3 moving average, that's going to follow price up, come back, and maybe something like that. Okay. So what we're looking for is a buy in this area right here. And then the rest is all about your stop, your targets, your trade plan, and go from there. The other entry I like is very, very similar. And that's where you have a high, you have a pullback, and then we'll put a line right here. I'm just looking for an entry below the highest high. I would say 99.9 of all the scans that I have set up this way are less than the highest high in 5 days. So I'm just looking for a rally, a pullback within 5 days. By the way, I want everything here. I want my trend to be trending. Now, my trend only has to be that 17 EMA turning green. A lot of my scans, I use the 34 EMA trending, say, a few days. And so 34 EMA trending for full few days. I want that 17 EMA trending, just like you see, like I've been showing on that chart. I want those green dots there. And then I want the pullback. So I want a trend and a pullback. So rule number one, rule number two, trade. Well, new rule number one, trade in the direction of the market. Principle number one. And principle number two would be trade in the direction of the trend. And we are talking about bullish here. I haven't even mentioned bearish yet or anything. So this is the bullish side. So I've done everything I need to do here. The third option I like for an entry is pretty much either one of these, but a breakout. So like a breakout of that top trap, we call it the top trap line, which would be the 3 EMA, or the breakout of the highest high in the past 5 days. Sometimes I use 7 days, but 5 days generally is what I generally use. So I'm looking for that breakout. All my entries are this way. 99.9 of the entries are this way, right in here. So right there, below the high, the 3/8 trap, below the highest high in 5 days, and then breakouts. Both bullish and bearish trades. Bearish would be just the opposite of this. So bearish would be, I want a downtrend, and I want the, let's see, the chart to move down, to move up. And then if this is the T line right in here, I want that 3 EMA to be right in here. So I want it trapped underneath the T line. And we have other, setups using different moving averages, but this is probably the most widely used that we use here. Let's look at principle number 5. Oh my goodness sakes. I used to be this way. I can't count the times I've coached or worked with people where they seem to think that they've got to make 100% on a trade. I don't know why, especially option traders. I don't know what it is about option traders, but they do. They seem to think they have to make 100%, and I really don't know why. I'm perfectly satisfied with 15 to 25% in 3 to 10 days. I'm tickled pink. Do the math. Do the math on if figure out how much money you put into a position. Figure out if it moves up 10 to 15 to 25%, and how much money is that? Would you be happy with that? Instead of thinking, well, I have to stay in it till it expires. I never stay in anything, until it expires. And you don't have to make the 100%. Just take a look and see what 15 to 25% might do for you. You might be really, really, really shocked at what happens here. So principle number 6, setting goals. This is one of my favorite ones right here. A lot of times I get asked, you buy a chart. You know what? Let's look at a chart. Okay. Where'd they go? Oh, there they are. Let's look at a chart. Hey, again, I want to say thanks for having me here. I absolutely appreciate that. I really appreciate Lex and Tradier having me here. So thanks. Anyway,
I popped in here, Rick. How are you?
Oh, hey, Lex.
Hey, the good news is that we're getting close to time, and I want to take a couple questions. Are you good with that?
Oh, okay. Yeah.
Yeah. So here's a plan. How about this?
Okay.
I'm going to give a plug to Rick Sadler, hitrun candlesticks.com, I think, right?
Yeah.
Okay, that's number one. Number two, we're going to finish up your other principles on an Options Brew TV show.
Okay.
Just as a note, everyone, please subscribe to Options Brew TV. I'm the host of that show, and we get guys like Rick and our upcoming people on all the time. So we'll finish that up. Great stuff. We had a lot of comments. You've got another kind of cult following, Rick. You're a kind of a hero in this space. I love it.
Thank you, everyone. Thank you.
Yeah, no, I know.
I'll send the checks later.
Let me post a couple questions and see if you can answer these real quick. Here's number one. Let me know if you can see that.
Yes. Does a 17 work on the 2 and 5 minute chart or only on the daily? No, Marilyn, they moving averages, candlestick signals, they work in any time frame. Remember, what you're doing is you're setting up where to go. There it is.
Oh.
You're setting up a system, and now you're trading that system. This is the basis of my system. Okay. So if it's green, we're bullish. If it's red, we're bearish. And it doesn't mean that we're going to get bearish here. It doesn't mean we're going to get bullish, but you can see how that works. And there's a 5 minute chart for you. So, like I said, it does not matter if you're intraday. It could be weekly for that matter. Look at the weekly here. Look at the monthly. You still get the green and red or price. Not everybody can change the green and red here. Make it go red and green. Not every chart package can do that. By the way, Lex, that's one of the things I wanted to talk to you about. TradeHawk. Right,
I knew that was coming.
Yeah. So to your question, no, you can use it on any time frame. Thank you for asking, by the way. I appreciate it.
Okay. All right, Rick. You know what? I'm gonna have to let you run. We gotta do a giveaway here. And
Yes.
take a short break, but thanks so much. You're always a pleasure. You always such great info. You're the best.
Thank you very much, Lex. We'll talk to you. Okay. Take care, everyone.
Bye now. All right, everybody. Here we go. We're gonna take a really quick break, like a minute or two. We ran over a little there, but here's how we get involved in the next giveaway. Are you ready? So again, giving the shirt off my back, maybe one behind me, maybe one in the closet. We're not sure yet. And don't worry, they still have the tags on them, and I'm gonna get you new ones, so it's not all nasty. So we're gonna do that. Now, in order to be a participant in this question or in this giveaway, you must answer the following question. Are you ready? Here we go. Question is, if you had to be stranded on a desert island with a technical indicator, which one would it be? Keep it clean. We're looking for an answer like RSI, MACD. So which technical indicator would you be stranded with on a desert island? Type it into the comments. We're going to put you on our wheel. Give us a few minutes, and we will spin the wheel. You'll get a shirt. We're going to do it twice, and we're going to put $100 in your Tradier brokerage account as well. So let's see them. Guess what? Not enough time. We need 30 more seconds. I'm on mute. I'm back. Here's what we're going to do. I am spinning the wheel. Ready? Hold on. Got to share the screen. All right. Can we see it? Here we go. Spin number one. Shirt on my back or one of your choice in your size. Tradier logo. I got to give a plug to NikkiCClothing.com who donated the shirts for this event. Great company. Nikki, that's SEA clothing.com. Use the options 20 promo code to get 20% off your order. And let's spin the wheel. Number one winner. Here we go. I love the wheel spinner. Gita. Oh my God. Unbelievable. I love it. Here we go. Going again. I hope you got it, gang. We're going quick. Jeff Tarter. All right, sounds good. We got them both, gang. I think we do. I'm going to stop my screen share. I'm back. All right, let's move along here. So, sorry to go fast. We're running just a little bit behind. So the next segment is our panel. We have 4 distinguished guests waiting in the green room. They're going to pop on here in a second. They're leaders in the industry. They all have a little bit different take, I think, on technical analysis. And they might not even have a traditional view of technical analysis, but we're going to find out from them. So let me introduce and have each one of them join. I'll bring them in every bit at a time. Here's our guys. We got one more, Mr. Jeff Tompkins. Hi, guys. How are you? Can you hear me?
How's it going, everybody?
What's up, everybody?
All right, you're there. I think, Jeff, you might be on mute. I'll unmute you. There you go. He's going to get it.
Hey, guys.
Good. Good to see you. So this is just a panel. Super simple. I'm going to ask the questions. You're going to give the answers. If you need to share a screen, just go ahead and do it, midway through. But what we're going to first do is go around the board. We've got about, 45 minutes or so. I got, a handful of questions. I'm sure we'll get some questions from the viewers. We'll try to answer those along the way. But let's first do introductions. Rob, I see you first, and we're just going to go around the wheel here a little bit. So just give us a brief bio about yourselves, and we'll move along and tell us about your experience in the industry.
All right, I'm Rob Booker, and I didn't see my name on the wheel, so I refuse to participate in any of this. Just kidding. My name is Rob Booker. I've been trading for 22 years. I was a commodities trading advisor from 2006 to 2011. I was primarily a currency trader for the first 13 years or so. I wrote a book, Adventures of a Currency Trader, which sold a total of 3 copies. I was the host of the Traders Podcast, which was a podcast before podcasts were even a thing. And then I actually sold that podcast and my radio show and YouTube channel a few years ago. And now I'm a retired trader who only trades when the trade is so good, I cannot help but take the trade. So it's nice to be here. I really appreciate the invite.
Great, Rob. Thanks. Jason, what do you think?
So I'm Jason DeLorenzo on Twitter. I'm the Wizard of Ops. I'm an RIA currently. Been options trading for about, 11 years or so. I am not a market maker like all your other guests, but basically I'm an economist that looks for inefficiencies in the market, and I like to trade them. We have also a data platform called Volland, www.vol.land, which is designed to give you dealer positioning by the Greeks in about 200 equities. So very kind of diverse business model. We are kind of focused on non-traditional sources of edge, and particularly as it relates to options, since options have a lot of aspects to them and a lot of different kind of traders. So you can find a lot of edge there. So
cool. Thanks, Jason. Appreciate it. Chuck, what do you think? How you doing, man?
I think a little at a time, Lex, as little as I can. Chuck Fulkerson with TradersArmy.com. Hope you guys are having a great day. Glad to be here. I've been primarily an options and futures guy. I've been trading for about 15 years. I make the joke that when I started, I didn't know the difference in a stock and a rock, and now my head just looks like a rock. But no, we spent a lot of time really focusing on what is it that makes a good opportunity for somebody, and really it's understanding order flow. So we spent a lot of time. I didn't come from the floor. I'm a trained off the charts kind of guy, but I learned to understand what does filled and unfilled orders look like, and that's what we really spent our time talking about.
Cool. Thanks, Chuck. And then last but not least, Jeff Tompkins from Altos Trading. Jeff.
Hello. Yep. Thanks for having me. So I've been trading about 23 years. I trade options, futures, equities, ETFs. I'm a hedge fund manager, so I manage the Altos Capital hedge fund. Then the other side of our firm, Altos Trading, is our publishing entity. So we publish newsletters, trade alerts, financial courses, etc. Been doing that on the publishing side for about 8 years, and glad to be here.
Cool. Thanks for coming. Okay, so again, viewers, I encourage you to type questions in the comment section. We'll try to get to those for sure. But we're going to start up with some simple ones, so some layups. And Jeff, I'm going to start with you again, so keep your mic hot. We'll go back around the other way. So the whole show has been centered on technical analysis. Okay, so can each of you just sort of in your own way define how, what is technical analysis? I know, Jason might have a very different answer from the rest of you guys based on where his strength is, but how do you view this technical analysis concept? What is it to you? What does it mean? In some basic terms, what do you think?
Yeah, sure. So, I mean, technical analysis, I guess at the very core eliminates fundamental analysis, right? So we're not looking at fundamental variables. We're looking at technical patterns or numbers or indicators that are on our charts. So at the core, I think that's really what technical analysis is. It's in terms of interpretation different from fundamental analysis. If we get a CPI report or a Fed meeting and they raise the rates, those are pretty hard fundamental numbers. And there's not necessarily, I mean, there's always subjective interpretation, but as it comes to technical analysis, I think there's a lot more subjective interpretation around that. For instance, we can take an indicator or a chart pattern and show it to 100 different traders, and they're all going to look at it and act on it differently. So, and so I think that leaves a lot of room for education around technical analysis. And to me, that's really what it is, and how it differs from like fundamental analysis, which are kind of obviously the two baskets we look at as traders and investors.
Got it. Chuck, what do you think?
Yeah, what my thought is that price is king, right? So, technical analysis in my mind is just the study of price and volume, but primarily it's understanding where the filled and unfilled orders. And every candlestick we look at is the result of orders being filled, and price movement exists because of unfilled orders. And so what I'm primarily looking for when I think about technical analysis, I think about filled and unfilled orders. Every indicator that exists is nothing more than a mathematical permutation of price and volume. And so I don't really use many indicators. I just primarily focus on the price action of what picture of price was there when it came to filled and unfilled orders. So technical analysis in my mind, is because it's the study of what actually happened.
Okay, got it. Thanks, Chuck. Jason, you might have the most different answer of everybody here, so I'm counting on you.
You can wait for me to be last. I don't want to cross Jeff because he has a gun, a massage chair, and a guitar, so he knows how to party.
Hey, by the way, yeah, I didn't realize my camera angle was so wide, but that's part of my technical strategy, so I'll share that later.
Okay.
Shotgun approach.
That's it. All right, Jason, go ahead. Sorry.
Do you want me to go, or do you want to go Rob first?
Oh, I was going to go you. I'm going around the horn, but
okay, that's fine. So for me, technical analysis is analysis based on the price, both current and prior. So it's like kind of a running price. So anything momentum related, anything that has to do with moving averages, candlesticks, and it's basically trying to find patterns in the price of a security and trading on it. So that's kind of my definition of technical analysis. How I apply it, I think technical analysis is very distinct from any kind of flow analysis that Chuck was talking about mostly. And it's also distinct from fundamental analysis because both of those indicators are outside the scope of just straight price. So for me, technical analysis is anything that has to do with the price, whether historical. Volume is something that has to do with the price because it's how much that price is being traded. So it's kind of aspects in that sense.
Okay, great. Rob, I know you and I talked recently on a show, so you've got some pretty interesting ideas about this as well, I think.
Yeah, so I just wanted to remind Jeff of the old screenwriting rule that you never show a gun in Act 1 that you don't use later on in the movie. So I just want to remember that we do have to shoot one of the panelists today.
That's why it's there.
I'm going to put myself up there. You guys can, whatever. So my take on technical analysis is really similar to, I think, what Chuck said. I really appreciate what you said. It's not exactly the same thing, but I like to think of all market activity as price moving from one level to another. Now, the reasons behind it, I think, Chuck, you mentioned there's a logic behind it. There's something happening underneath the surface there. And I really love that explanation because it's not just cave drawings, right? There's something going on under the surface that creates that. But I think whatever technical indicators that you use, whatever it is, whether it's support and resistance lines or the volume weighted average price or moving averages or the Fibonacci spiral of death or whatever it is that you prefer, what you're really looking at is it bouncing off a level and returning to another one? Is it breaking through a level and going to another one? And that's really all we're trying to do. And we're all kind of trying to do the same things. And each of us chooses sort of our own path to get there. But I think what has been said here is there's something going on under the surface. There's more there than meets the eye. And I think that's what's so exciting about technical analysis to me, is that it represents order flow, or it represents that battle between the bulls and the bears. And I think that's why after 22 years or as many years as we all have here, we're still interested in doing what we do.
Great. Very good. So the next question is, there's indicators, right? The RSIs, et cetera. And then there's candle reading and there's pattern reading. How do you incorporate, the combination of these two things? And do you have a favorite sort of setup or indicator that you use on a regular basis that just seems to be just money for you? Rob, why don't we just keep going, or just keep kind of.
So I'm going to share my screen, and so
go ahead.
I may break everything here, and I may show you something that you don't want to see, but that's fine. Just kidding.
Be careful what you share, Rob.
That's right. Wait,
I was actually on a webinar one time where a guy was like to 1,000 people, and he pulled up and shared a screen, and then there was some interesting material on his screen, and he simply said, well, there's a fry pan bottom, and then he just went on with the rest of his presentation. He just
love it.
Didn't even miss a beat. All right, so
you might share. Yeah, you got it. Here, hold on. Here we go. There you go.
So this morning I was looking at a couple of different. So in the mornings, I'll either trade options or I'll trade low float, high volume stocks, and sometimes I'll even trade some of those pre-market. And so this morning, SINT was a reasonably low float stock. That means the float refers to the total number of available shares to trade. And the volume was outstripping the float pretty big. And I call that a float squeeze, even though that's not a real thing. And I'm just looking at the volume weighted average price. And I'm looking for price to break through that volume weighted average price. That to me is a level or a technical indicator that says, even pre-market, I might use an EXT order and trade before the market opens. That to me is a breakout. I'm looking for something to break out above its pre-market levels, above the volume weighted average price. And then what you mentioned is really, I love what you said. You said, when you combine like candles and indicators. So this one wasn't a great one when it basically printed these side-by-side candle bodies. Like, I was going to make a joke about me and Lex and Chuck, waking up next to each other, but like we're side by side there. And that's like the market freaking out. And there's an equal number of bears and bulls or whatever. And that's just my out. And that's kind of the combination of those things. I'm looking to get in on that breakout, sometimes even pre-market, ride that for a bit. And then, I'll use some historical support and resistance levels. But that candle pattern, I think that goes to answering the question that specifically you asked, is that kind of is what I'm looking. That's one of the things that's like sort of like, okay, now whatever you were doing, set it aside or move the stop to break even, but prepare that things are changing. And that's when I'm really rapid fire, either day trading options or day trading a low float, high volume stock.
Okay. Thanks, Rob. Jason, do you have something similar? Do you use the candles and the indicators?
So I'll share. Yeah, I'll share my screen. I don't use chart patterns per se. I kind of think, the technical trading has the reputation of like astrology for men or drawing on charts with crayons. I'm a little bit more or less in that camp. But one thing I was talking in my introduction about vol land, and one source of edge that I always look for is to try to front run price indiscriminate traders. And you market makers that were high stepping before, talking about how you can see all the flow when we can't. Basically, we're paying you to be, I don't want to say our slave, but you're being paid to take the opposite end of our trade. And you, the market makers, have to manage that risk. So what this tool does is we are looking at, I guess, being introduced to options in this. I've been watching, and it seems like there's quite a bit of involvement in this summit. So we're looking at, which is a price modeling version of how makers have to hedge their risk in order to stay risk neutral. And so this is an example. I'm using Apple, and these are all of the strikes in the options. You can see here on the x-axis, and the y-axis is how much they have to hedge, because you're not a marketer anymore, Lex, right? And in this particular case, we're looking at gamma. So we were talking before about how gamma is a little bit opaque to neutral. It is how much an acceleration hedging needed on the strikes that you own in options. So I take a look at the tool that we built, and if it is positive, if this gamma is positive, then makers have to buy, and if it's negative, market makers have to sell. So in this particular Greek, I look at where Apple is going toward the end of the day, and at the end of the day, the market makers, who are price indiscriminate buyers and sellers, will have to buy or sell in the amount of like say 20 million notional per point. So this is what I look at, and I am a swing trader. I am not a day trader. I just don't have the time for it. I like to eat lunch sometimes. So so I do this like on about a 1 week to 2 month basis. I will see what the patterns look like on the market maker Greek side, and when they have to buy, I buy before them, and when they have to sell, I sell before them, and it's worked out pretty well.
Great. Yeah. Well, we've done a lot of shows on this, and Chuck, I think I talked a little bit about this on one of at one of your conventions as well. So interesting stuff there. So Chuck, how do you use the combination of all this stuff?
Yeah. What's funny about me, kind of interesting, is I don't typically use indicators at all if I don't have to. To me, an indicator it's simply going to be used as a confirmation tool, because I'm looking for the balance between where buyers ran out and sellers ran out, right? So essentially, and if everybody else is sharing their screen, I'll see if I can't do mine as well.
Yep.
When I look at, can you hopefully you can all see right now?
Not yet. Hit that share.
Oops, there we go. Sorry about that.
It's all right. It'll come up in a sec.
There it is. It's my first time using this one. Okay.
Hang on. Yep, I'm getting there.
Okay. So, for example, this is just something simple in the SPYs, right? And this is nothing crazy big, but when I look at something like this little area right here, where I've kind of highlighted this little price point, there's not a lot to see here, but we know for certain that in that period of time, there was an equilibrium of buyers and sellers. Buyers and sellers had to be equal. And so since they were equal in that period, we know that when price moved away, there were no more willing buyers. There couldn't have been. So the question is, did every sell order get filled? Don't know. Are more people going to see that and add their sell orders? So what we look for are turning points where the market has had balance in the past and may find them again. And that, to me, is where I would start to say, okay, well, maybe this would be a good opportunity for a small time frame reversal. Now, certainly that's inside of trend and all of that. This is just one example. I just pulled up a simple one, but the idea is that I'm typically looking for those around areas where a lot of traditional technical analysis traders are going to be trapped, right? So a lot of traditional technical analysis traders are going to utilize, say, this line up here and say, all right, well, if we break that resistance, I'm going to be a buyer. And I want to be, they're going to be buying right into an area where we know that institutions had to be selling in the past. How do we know they were selling? Well, we know they were selling because price fell away from that level. So I look for areas that essentially are areas where in the past, buyers and sellers decided hey, listen, we're going to find some equilibrium, but price moved away from there. And then I want to go, where's there a trap? Where's a trap being laid where the novice traders that are all reading the same books, doing the same things, are going to place all their orders that enough. And I'm not saying that's not to say that professionals are out there looking for everybody else, but there are certainly algorithmic trading systems that do that, that look for areas where there's going to be a mass influx of the money that follows the same tool.
Cool. Nice. Thanks, Chuck. Jeff, what do you think? Combinations of things? How do you look at this?
Yeah. I was going to say, I mean, if kind of combine what Rob, Jason, and Chuck all said, and similar methodologies on my side. To echo what Chuck said, I think, using as far as an indicator goes, I use it more for confirmation than for the initial trade decision. Let me see if I can share my screen so I'm not the odd man out there.
Yeah, just pick the screen and it'll pop up for me and I can bring it in.
Yeah, all right. I'm on dual monitors, so I want to make sure I share.
Yeah, you'll get infinity if you pick the one you're looking at.
Yeah, so let me get over to the chart.
Yeah.
Let me know when you can see it.
I'm good. There you go.
Got it. Cool. Okay, so I'll actually share a trade I did this morning. So a real money trade using. So I look at price action first. So one of the core methodologies I use are pivot points, particularly because I use a lot of these forecasted directional, decisions to trade options, right? So being that they're a derivative instrument, I need to be pretty precise with my timing and those types of things. In this case, this is the E-mini S&P futures. So it didn't involve options, but I use this as a core price action setup for virtually all my trading decisions. And then I throw in, I have just a handful of indicators I can use for confirmation. So just to kind of explain what that is, I look for, again, for pivot. So this would be, and this is when I traded off this morning, shortly after a couple hours into the open. I'm looking for a shift in trend and momentum. So we had this, surge up in the markets this morning, and then we peaked around. I'm in the Mountain Time zone, so around 9:40. And what I'm looking for is a shift in making new highs. And this is a 5-minute chart, by the way, on the candlesticks. This is fractal, can be applied to any time frame. And I'm looking for a shift where we go from making new highs to making new lows. And that's purely price action based, right? We're not using any indicators. And oftentimes when that occurs, we get a follow through with the forecasted trend direction. In this case, that would be to the downside. So I spotted this one this morning, and I noticed we're in this big uptrend. And what I've also plotted here are the Bollinger Bands. So I'll explain a little bit how I use those for the confirmation. But what I'm looking for is, again, the pivot candle, which would be the candle here that I have my cursor over. And then I'm looking 2 candles to the left to see if we have lower highs, and then 2 candles to the right to make sure we have lower highs. And that gives us our confirmed pivot. And once that 5 candle pattern is in place, I'm looking to enter in the direction of the forecasted trend, in this case to the downside, at the low of the 5 candle pattern. But we just do the opposite with a bullish price action pivot. So here was one this just more recently today. And so entry would be right about down here, and this is where I entered. And then I typically manage with a scaling out technique where I put on multiple contracts and then scale out at a 1-to-1 risk reward. I usually define my risk above the high of the pivot candle, and then my reward at a 1-to-1, and then exit half the position, trail the rest. So I actually ended up getting out around 38.60 this morning on the E-minis to the downside, just using that price action pivot type of setup. But I also, as I mentioned, can combine an indicator with it. So one of the common ones I use are the Bollinger Bands. So these are basically volatility bands, and the default settings typically are a 2 standard deviation move from the mean. So each of the outer bands is a 2 standard deviation move from the center band. And that helps me determine if a market has been overstretched to the upside or the downside. So if it's overstretched to the upside and I get a bearish price action pivot, exactly like occurred this morning on the E-minis, then I have more confidence to take a short setup. Or if I get a volatility expansion to the downside and I get a bullish price action pivot, I have more confidence to take a counter trend trade. So basically what I'm looking for with the Bollinger Bands as far as confirmation is I'm looking for price to trail the 2 standard deviation band for an extended period of time. Because whatever market we're looking at, or whatever time frame we're looking at, markets can only sustain a 2 standard deviation move from the mean for so long before they mean revert or they completely reverse course. So you see this happen all the time, right? So I think when you combine, indicators and the right ones, there's a lot of crappy indicators out there. I really like the Bollinger Bands because they give us volatility information, they give us directional movement information, and they give us standard deviation moves. So when we combine those with price action, I think they can be very effective, and that's kind of how I use them. I look for overextensions, 2 standard deviation moves from the mean, and combine those with price action study like the pivot strategy.
Great. All right. Good deal. Let me go back. So that's awesome. So
actually, Lex, one thing. Sorry.
Yep.
And then once I hit the winning trade,
yep.
I go ahead and get the shotgun out. I load 2 12-gauge shells in, and I go outside and fire it off. So that's actually why that's back there.
I think I like that. That's very good.
And I hope the police don't show up.
You're far enough out, nobody cares, Jeff.
That's right.
Exactly. Yeah. I'm out in the woods.
All right, Jeff, I'm going to keep you warm. Okay, we're going back the other way. So next question. Ready? Having learned all this and you guys expressing your, kind of what your setups are, what have you, what's the best option strategy that you can employ to take advantage of these price actions and indicators? Do you have a favorite? And if so, why? And what are some strengths to it? What are some weaknesses potentially? So if you could talk around that, that'd be awesome. Jeff, you want to go?
Yeah, I really like that question because I think all of us that trade options have a favorite strategy or a go-to strategy.
Yep.
I think that could also be a bit of an Achilles heel. So what often happens with options traders is we have a favorite strategy and we identify a technical pattern or a fundamental pattern that results in us making a directional trading decision. And then we go to that go-to option strategy. And it might not actually be the correct strategy for the market. So I think that's one of the mistakes that options traders make is they stick with 1 or 2 option strategies that they like. And then they see them, when they've worked so well, see them fail as market conditions change. One of those variables might be volatility, right? So some strategies option strategies work very well in volatile markets, and some are more conducive to low volatility conditions. So I think that the key there in what I do is to really have a toolbox of option strategies that you can go to, that you're familiar with, that you're experienced trading. And then based on market conditions, you choose which one makes the most sense. And just as a quick example, I don't want to take away time from the other speakers, but one of those kind of an example of how we would make that decision is with volatility skew. So, just like most markets, you want to buy low and sell high, right? So a mistake a lot of options traders make is they buy high volatility and they sell low volatility. We want to do the opposite. So if you're doing like for instance, a vertical spread, you want to, within that spread, you want to make sure that you're selling the high IV, the high implied volatility, and buying the low implied volatility. And that will help us dictate which strategy we choose. So we might not want to set up a credit spread when we're selling the low IV and buying the high IV, then we may want to actually look at doing a vertical debit spread. So it really helps us determine what strategy we use. And that's a big question mark for a lot of option traders. They don't know which strategy to use for which conditions. So,
okay, great, thanks, Chuck. What do you think?
Yeah, I would echo what Jeff said that it's an Achilles heel because, by the way, guilty. When I first started trading options, I was very, very similar to that in much the same way. And so, I'll give you an example. One of the things that I'm a big believer in is I don't necessarily have a favorite because I eliminate the emotional component. So down here is just a very simple volatility indicator. And I say I don't use a lot of price indicators. I do for volatility, this just shows me, my volatility in a given range or a given period. And then I shrunk it on me. Hold on.
Hold on, hang on. Let me get it for you there, Chuck. There you go. Oh yeah, just go. Yeah.
There we go. Okay. So if I'm in the upper fifth, we basically break our volatility down into 20%, bottom 20%, top 20%, middle 60. If I'm in that top 20%, I know that I have to be an option seller. There's no sense in being an option buyer. If I'm in the bottom 20%, I want to be an options buyer and not an option seller. And then in the middle 60, then we get into the nuances of which spread makes the most sense, whether it's a vertical credit, a vertical debit, some sort of a calendar, diagonal, whatever that looks like. So I got away from having a preferred option strategy to really just saying, I'm going to do this strategy that the outlook of the stock tells me whether I'm positive, very bullish, neutral, bearish, or very bearish. And then I cross-reference that with what does the volatility tell me of where I should go. And then from there, I don't make it. I don't have a choice. I've got to trade that strategy that fits that criteria.
Okay, great. Jason, you the man. You trade a lot of options. I know that.
I do. That's because, you see the flow, so you know I trade options. But but I don't have a particular favorite trade like option strategy. I do have, like Jeff said, I have a toolbox of option trade plans that I utilize for different environments. One thing, not to disagree with him, but I'm going to because he doesn't have the gun. Chuck said that, when there's high implied volatility, it typically, you want to be an option seller. And when there's low implied volatility, you typically want to be an option buyer, which makes sense. But there's plenty of academic papers out there that talk about how high implied volatility tends to be too low and low implied volatility tends to be too high as far as comparing implied to real volatility. But that being said, I'm sitting there taking notes on what you guys are saying and extrapolating. But particularly in this current environment, skew is pretty flat. So if you find a good stock that you like that offers dividends, you could put a collar around it for pretty cheap and have edge on the dividend. Also, because skew is cheap, or skew is also flat on the horizontal, from a time spread standpoint, I like to put on calendars and diagonals and try to take advantage of the horizontal skew. So basically what I'm saying is that form a toolbox for the different environments that you will be in, and then apply those trade plans, not just the trade, but you have to have an entry and an exit plan, sometimes determined on price, sometimes determined on some sort of data, anything, and utilize it and stay disciplined in it. I think trade planning is the one advantage that retail investors have, flexible trade planning, than many institutions and funds.
Okay, thanks for that. Rob, what do you think?
So when it comes to, I agree with everything that everybody said, and I've learned a ton just by listening, and I'm intrigued by everything that everybody said, and I agree. You got to have different strategies for different times. But if you want to, if we're going to talk about what my favorite strategy is, then I'm going to come clean about two things. One, I'm a degenerate gambler. There's no benefit to me saying otherwise. I love trading, and I love short-term trading options. And my favorite strategy is, you can just Google, there's a couple of lists on the web. You can Google Chinese stocks listed on the US stock exchanges, and you're going to get a list of basically a bunch of trash. And you can disagree with me if you want, but it's a bunch of trash. And what I love to do is I love to see those pop up. Now, whether we're using the Bollinger Bands, I love that as an indicator, and some candle patterns to go along with it. Jeff, I love that. I love buying puts on garbage. So I love it when Bed Bath & Beyond pops up, not a Chinese company, but you know what I'm talking about. Or PDD, for like a week, a year and a half ago, the CEO of the Chinese company went missing, and then they reported numbers, and they were just all fake. I love buying puts on some of those companies which are in extended downtrends, generally don't have very transparent accounting, pop up and reach sort of a limit at a technical indicator, print a nice reversal pivot type candle pattern, and then I'll just buy options. I'll buy puts that are near the money, that expire within 2 weeks, sometimes 2 to 3 weeks, especially if I can get a monthly, that's great. And then I love doing that. So you're talking about my favorite strategy. I love sort of being a pessimist and betting against garbage. And I know that basically that turns me into sort of a degenerate gambler sometimes, but I do stop out of trades. I don't like extraordinarily large losses, but that's what I love to do. Out of everything that you could possibly do, if you put me on a deserted island and you made me trade one thing to get off the island, that would certainly be it.
The long put.
Yeah.
Yeah. That's where we grew up, on the floor. I was always a pessimist. I thought only bad things could happen because I always had the opposite side of everything. right? So I was so scared.
Chicago. I mean,
I know. I mean, I get it. So yeah, we were bred to think the worst, and we always had to have protection. That was it. You know, I lived through a lot of crashes in my life, and it was scary. I'll tell you that. So
I like to ask the question, where are people being stupid? Like, I'm stupid. So when do I get euphoric? Like, what do I love that blinds me from reality? We've all seen this. We've seen this happen with Tesla. We've seen this. I love Tesla. I love the cars. I love the company. I think Elon Musk is a cool dude. But people get euphoric and wildly crazy. Zoom during the pandemic had like a 1,000 price to earnings ratio. I like to ask questions like, where are people becoming euphoric and stupid? And then where does it pay to be a pessimist?
Well, you could have done that in GME, I think, when it went euphoric. And I want to say the stock was trading 400 and the 800 calls with a couple weeks ago were $12 bid. Now, that seems a little bit high to me, but what do I know? I know someone who sold those and made a very lot of money, but I don't think I would have been scared to death to sell those. So.
Yeah. I mean, everybody else can speak to this, but there are tons of options that get purchased, which are for whatever hedging purposes or whatever, that are just absolute. It's just wild. It's wild that some of that stuff's out there, but everybody's got their own reasons. And I know there's hedging and all that other kind of stuff, but
yeah. All right, let's go around again. Rob, keep the mic warm. Ready? So, you know, back to a little bit of my experience. When we were on the floor, we didn't use charts. Okay, we didn't use them at all. We didn't know how to use them. We didn't know what an indicator was. We had no concept of how to read a candle or a pattern at all. And one of the dumbest jokes that went around our floor is there's a chart on every ship on the bottom of the ocean. So what's the point, right? So I guess my question is are there limitations and weaknesses of using technical analysis, you know, especially around the world of options trading? I mean, is there anything that stands out that could be a sharp weakness? You know, some people say to me, it's a lagging indicator. Why do you want to look at a lagging indicator? So I said, I don't know the answer to that because I'm not smart enough and I don't know charting very well. So what do you think, Rob? We'll start with you.
Yeah, so I might disagree with others, and everyone here is entitled to their opinion, and there are people here that have made a lot more money than I have and been around a lot longer than I have as well. I don't believe there are bad indicators or bad technical stuff. I believe there's reasonable, smart people can disagree about that. I believe there's bad risk management. Mm-hmm. And no matter how firmly I believe that Billy is a worthless company, I bought the $9.50 or $9 puts that expire November 18th. No matter how convinced I am of that trade, if that thing breaks above $11 a share and I've lost a few $100s in exchange for the ability or the potential to make a few $1,000s, if I reach that limit, then whatever technical analysis I did, whatever theory I had in my mind, I have to just admit that it's wrong. So I think everything breaks, right? Everything. You ever heard the phrase, well, it can't go any lower or whatever, it can't go any higher. Of course it can. Like, no matter what, whatever you look at, whatever academic papers back you up, if Nassim Taleb comes over to your house and drinks a cup of coffee with you and convinces you that Bitcoin is worthless, Bitcoin could still go to 100,000 and everyone in the world can disagree with it. So I like to say, whatever you choose to focus on and whatever toolbox you have of a variety of strategies, don't ever get so married to those strategies that you can't see what's really actually happening. And I think, Chuck, you were the one that brought this up. Price action or whatever is actually what's happening. It's what's happening, not what you thought was going to happen. And, you can't just keep extending the goalposts and you can't keep removing your boundaries because the market will take advantage of you and it will throw you in the trunk. It will drive you out to a field and it will shoot you in the face and it will leave you there like Jimmy Hoffa and it will not feel bad about it. So you got to admit when you're wrong. And that's been my big weakness. So it hasn't been the charts. It's really been over the years when I've bet on stuff or I've gotten convinced of it. I've refused to admit when I'm wrong sometimes. And that's just very costly.
Okay, good. Jason, what do you think?
So I think there are pros and cons to technical analysis. I am not a proponent of chart patterns as a source of edge. I think that, first of all, I agree that price is what's happening. And I agree with Rob when he says that. And I also, I mean, when I'm looking at the strategies that Chuck and Jeff and Rob are showing, and they're showing kind of trend reversals, I think the common theme of what is good about technical analysis is that it provides a strong trade plan. And for me, planning is the most important part, including risk management, like Rob was saying, and being disciplined and following your plan. I've been shot in the face a couple times by the market by, not accounting for certain risks. And I've been shot in the face by not following my plan correctly. And I think that no matter what indicators you use, those are the two biggest things that you need to have on hand as a trader. And I think even prior to this roundtable, all the other presenters have basically said the same thing: trade planning, risk management, and that's pervasive. Other than that, though, when it comes to actual indicators, people say when the relative strength index reaches 80, then sell. Well, it could also reach 90. It could also reach, 100. I mean, there's nothing saying that it can't come, that it has to come down at 80. There's no rules to that. When it crosses the 200-day moving average, that means sell or buy or something. Or when the 5-day moving average crosses the 200, all of that, it basically boils down to trade planning and levels. Again, for the retail investor, you are at a major disadvantage in that you're not the market maker that can see all the flows. You're not anything, you're basically a person with charts, and charts is all you have. And so I think that identifying patterns and forming a solid trade plan around them, I think is very essential for the retail investor. And then just one other comment. One thing that I see a lot, especially on Twitter or something, the price of something, like we sold off an SPX because we crossed below the 200-day moving average. That is absolutely not true. Like Rob said, there's something else going on underneath the surface that you kind of have to keep in mind. It's the technical indicator is not causation. Even if there is a correlation, you can't think that the technical indicator is the reason why something happened. So I guess that's my 2 cents. I don't know if I answered the question right, but
no right or wrong, Jason. You know that. Chuck, what do you think? Any limitations that you can focus on?
I think the limitations on technical analysis, for me, the biggest problem is the subjectivity that can be involved around it, right? People say, oh, it's following the trend. Well, what trend? The daily trend, the hourly trend, the 15-minute trend? Or people say, well, look, I use my Fibonacci levels. Well, where do you start it and where do you end it? And so I think there's a lot of subjectivity that can be involved in trading that make it inherently more difficult. And that's why I think it's a little bit more of an art than it is a science in many ways. I think it's a combination of an art and a science. And back to what those guys said, it's all about risk management, right? The whole idea is how do I manage and handle risk? So I think that there is a lot to be said for the junk that is out there. And that's because of the arbitrary nature of many of the tools. My whole goal is to minimize or even remove the arbitrariness by having a probability score on something. And if it scores high enough in probability, I have to take it. And if it scores, it's kind of like what Rob said earlier, I only take trades that I have to take, that I just can't refuse. Similar to me is like from a technical analysis standpoint, I know that if I score it on a probability score and it scores a 9 or a 10, I have to take it. If it scores less than a 6, I don't take it. And so to remove that arbitrary nature, if you will, knowing that there's always going to be that piece there. So I do understand the whole, problems with technical analysis, because I think there are a lot of limitations when you focus on that.
Okay, great. Thanks. Jeff, any thoughts on this one?
Yeah, I guess the benefit of going last is I can just say copy that. I mean, everybody made good points. But no, I love Rob's comment. I mean, he hit the nail on the head that it's so often we focus on entry and technical analysis, and then that ties into what Jason said. Correlation is not causation, so you got to be careful. If you see a technical pattern that might confirm what you believed in, then it's just basically correlation bias. So you have to be very careful of all those things. But really, it's the management of the trade that is crucial. And frankly, we see a lot of the marketing stuff out there these days that solely focuses on entries, right? Because that's what gets all the attention. And you seldom see the management component of it. And that's what really leads to the success. I think you could throw a dart at the dartboard, really, and Yeah, you might be getting some edge with some of these indicators and chart patterns and things, but you can throw a dart at the dartboard. There's the old kind of anecdote. You have two traders that walk into a room, trader A and trader B, and they both trade the same stock. One shorts it, one goes long, and they both make money, or they both lose money, right? They can both take the opposite direction and both make money or both lose money. Sure. So it's always important to keep that in mind. I think as far as eliminating the chart, like you said, Lex, I mean, you didn't have charts to trade off of, and I don't think we really necessarily need them as it relates to the options market. So the beauty of options is you've got all of this technical information in real time, right? So you've got all your Greeks, you got your theta, your gamma, your delta, you've got your volatility information, you have implied moves, you have all this really great information that can actually allow you to make trading decisions without a chart, frankly. And I do that from time to time, especially if it's more of a swing to long-term trade opportunity where I don't need to be very precise in a short period of time. I predominantly just use the options information and don't really actually use the chart, because that can actually tell us whether it makes sense to buy or sell. What is the market telling us? I think it was Rob that also threw in, taking a contrarian approach. If you see things getting too out of whack, often it makes sense to take the other side of it. So.
Got it. Good. Okay. We got a few more minutes left. We got a couple of points here in the comments. One of the ones I saw earlier, though, is, and I won't go around the board. I'll just let you, if you answer, we'll try to not to talk above each other. People are always confused on time intervals. You use a daily chart, a minute chart. I know, Chuck, you might use a 60-minute chart, which is interesting to you. Anyone have any thoughts on that? Chuck, you want to go first? Looks like you're eager to.
Yeah, I got some big thoughts on this, because I think this is where when I see traders falter, it's primarily because they don't understand time frames. And it's usually because they're looking at too many time frames. You can't see the forest through the trees. So my belief is this, and I want to stay consistent. If I'm going to be a swing trader, I'm going to use a weekly chart, a daily chart, and an hourly chart. That's it. Nothing more. An hourly chart maybe to refine my entries, the daily to get in and out, and the weekly to tell me the trend. If I'm going to be a day trader, I might use a 4-hour chart. If I'm trading futures, a 4-hour chart for trend, a 60-minute chart for entry, and a 15-minute chart for trend. But my rule is I never look at more than 3 time frames. One, which is the big picture to tell me, am I a buyer or am I a seller? And that's going to be my general trend direction. 2 is what's my entry criteria, and then the 3rd is simply for refinement or stop losses. And I think I've taught in 10 countries and lots of continents and all over the world, thousands of people. And when I see people making mistakes, it's because they're using too many and the wrong time frames.
Okay, great point. Anyone else have a thought on time interval?
Well, time intervals are kind of like.
Talk a little bit about time intervals.
Yeah, go ahead. Yeah, Jason, go ahead.
Jason, you go, and then Rob, I'll take you after. Go ahead, Jason.
All right. So the one comment that I was going to have is, a lot of times I find that traders are making decisions on time intervals that are different than what they're paying attention to. And most of the time they're looking at every single tick. If somebody is bearish right now, and I think we've had a couple, I don't know where we're at now in S&P, but we've had a couple of strong upside days in a row. But they're bearish out until December or out until January. And they start getting panicky because we just saw a large move up, but their time frame that they're looking at is 3 months out. And I think that disconnect contributes more to early exits or late exits than anything else. So I don't look, as you know, I'm not really a chartist. I'm kind of like Jeff. I look at option statistics and dealer positioning or whatever, and make my decisions based on that more than I do based on the actual chart. But my one comment is, make sure that whatever time frame you are trading on, use the appropriate charts and also use that appropriate scope when you're looking at markets, like Chuck was saying.
Okay, great. Thanks, Jason. Go ahead, Rob.
So at the risk of being canceled, time frames are like pronouns. You could use whatever ones you want these days, but you can't expect that it's going to make sense to everybody else. You have to use what's right for you. And I love the idea of settling into, whether you're a swing trader or a day trader, Chuck, or whatever it is, settling in. Like day trading from a weekly chart, it's just patently idiotic. But if you want to do it, don't let anybody convince you otherwise. Stay true to it. If it's working for you, the only true indicator of whether something works or not is if you're making money. And if you're not making money, then you're doing something wrong and you need to change. Like, and so, but if you're making money, let the whole world argue with you about it, and they can just, what themselves. It doesn't matter. So I think it's settling into what tried and tested stuff works. Like, try that. If you want to be a day trader, start with that short-term combination. If you want to be a swing trader, try that out. But if it doesn't work for you, don't be afraid to try something else out.
Okay, good. Anyone else, Jeff? Anything on this? So you're like me. I look at second charts, second candles.
Yeah, I love it. Yeah.
Candles.
And then you look back and say, I wish I would have traded that.
That's right. I have no attention span for anything longer.
No, yeah, I just once again agree with what everybody said, and I think it's just to sum it up, it's a subjective thing, right? Is it a 5-minute chart isn't right for every trader. It might be right for one and wrong for the other. So it depends on other personal subjective variables. Is it I can't remember if it was Jason that said earlier on if you're not a day trader, you don't want to sit in front of your screen, you want to go have lunch and stuff, then why would you trade an intraday chart? I mean, you're just setting yourself up for failure. So it's important to trade, the time frame that fits your personality and your style. Yep.
Okay, great. So guess what? That's time for us. Sorry. I mean, that went by fast. That was great, guys. I really appreciate you coming on. Really informative. I love, everyone has a little different approach, and there's a lot of agreement too. So really great getting your perspectives. Thanks for coming on.
Awesome.
Guess what we're doing next? I'll let you on for a little bit here before we take our next little break. I think it's only a 5-minute or something. We're going to give something else away. Again, a shirt off my back that's sitting in the closet, and we're going to throw $100 in your account, and you have to answer a question. Okay, you ready? And Kayla said, don't make these answers so hard. My gosh, I was typing too much. So here's a question. It's going to be either or. Okay, and the question is, which option strategy flies? A butterfly or an iron condor? Those are your only two choices. Type that into the comments. If you get it right, you get into the wheel to win one of these unbelievable shirts from NikkiCClothing.com, NikkiCClothing.com, 20% off with options 20. But let's try to win one of these. Guys, thanks for coming on. Appreciate it.
Appreciate you having us.
Thanks, everybody. It was great to see you.
Thanks. Bye.
Bye-bye.
I'm back. All right, we're going to get ready. Guess what's next? We're going to shift gears a little bit and talk crypto. Let me spin the wheel, get a couple winners here real quick. And then we're going to meet our next guest, Mr. Stefan McVeigh. Give me a second. I hope we can see that. Spinning wheel number 1. Which option spread can fly? I think they both can fly a little bit, but so your answer was correct either way. Winner number 1. Russell Roaring, a Nikki C Clothing shirt and $100 in your Tradier brokerage account. Let's do it again. One more time. Kayla, I hope you got that. I'm going fast. Winner number 2. Janice Johnson, I believe. I hope I said that name right. So Janice Johnson, awesome. Another shirt and another $100 in the Tradier brokerage account. Very good. I am going to introduce my next guest, who is, as I said, Mr. Stefan McVeigh, one of our own, works at Tradier. Stefan brings over 13 years of fintech experience across product marketing and compliance to our team. He's got a passion for retail investing, and he helps drive innovation across our APIs, web and mobile platforms. So we're moving into our next phase of growth, which is crypto and futures. And Stefan's kind of one of the key people who's driving that, and can speak to it really, really well. So let me bring in Stefan. Stefan, welcome. How are you? Everything's working. You sound good. I love it.
Thank you. Thanks.
And you're at the stand-up desk too, right?
I am. Yeah. It's been a long day, so standing up for this discussion with you.
All right. Good deal. Good deal. So we're going to talk crypto, right?
We are. Yeah.
Okay.
That's what the topic is today. So
that's the topic. So it's not like options trading, but maybe it is. We'll find out. So we're going to discuss, traders' journey into crypto. It became so popular, practically something we had to do. Of course, once it became so popular, it had a crash, unfortunately. So too bad for that. But it's still a very popular product, right?
Right.
So let's talk a little bit about, how is Tradier going about building the product for active traders? So, tell us a little bit about, what our community looks like and, how you're envisioning this. What have you guys been doing for that?
Sure. So it's, I joined Tradier about a year ago, and I've known the founders for a long time. We all worked together at a firm called Trade King in the option trading space. They left to create Tradier, right? And as that evolution of the companies happened, retail investors are demanding other asset classes. So you have your equity, your options that Tradier has today. And obviously futures has been a big one that's been asked for by clients. Crypto's been another big one that's been asked for by clients. I joined the team to help get crypto into the marketplace for them. And so, after talking to a lot of the connected platforms that we have, after talking to a lot of clients and then having dealt with it on my own, we're an API first company. So all of our own platforms utilize our APIs, which is what our connected platforms and educators are using as well. So, from the ground up, we're kind of taking our crypto solution and integrating it into our brokerage API suite, as well as some of the advisor API suite that we have, which will then give access not only to our front end platforms, but also to any connected platform and any educator that's currently using us. And so when we thought about the feature set, like we knew it couldn't be disconnected. When we thought about how can clients go about using this, is it a separate login? Is it a separate funding mechanism? Like all those sorts of questions came up. And, quite honestly, people want to be in and out depending on the volatility, depending on the trades that they're in. And so.
Oops, I think we lost Stefan there. Okay, Stefan, you might have disappeared on us. Now, guess what happens? You get to hear me sing and dance. Now, thank God for that. He came back in.
The blockchain crushed me. It just kicked me out.
Yeah, blockchain crushed you. So yeah, I was about to start singing and dancing until you got back in, but thankfully.
That's all right. Yeah. Well, it was nice. It let me down easy by saying it wasn't my fault, and then booted me out. So
I got you.
Let me back in. But yeah, so all in all, like when you look at our solution, you're going to have your hub account, which is essentially your brokerage account. And then, if you decide to add on crypto, it's going to be seamless within whatever platform you're in. So we'll work with a lot of our connected platforms to get it integrated into their stuff. If you're using our Dash or mobile, or even TradeHawk that you're building out, you'll be able to seamlessly kind of trade between the two accounts. So we're excited for that. And that's going to be coming up here soon.
Yeah. So now will Tradier take delivery of coins? Is there going to be a wallet? How's it going to be? What's unique about how you guys are going to offer this?
So I
should say we actually, but maybe not.
Yeah, it's a great question, Lex. It's almost as if someone prompted you to ask me that question.
Yeah.
So there's different paths you can go down, and in all likelihood, half of the audience is not going to like it, and then the other half will, because there's definitely some strong feelings towards being kind of self-custody, holding it in a cold storage, holding it yourself, or keeping it on an exchange in a hot wallet that allows a bit easier of movement between it. So kind of the path that we're going down is it's tied to your Tradier brokerage account. So the Tradier crypto account, and we're using Apex Crypto's solution, who we're using on the clearing side for equity and options, allows us to keep it all kind of tightly monitored under one roof. And in this instance, it is held in essentially an omnibus account that individuals are trading in and out of their positions, right? So if you hold Bitcoin, if you hold Ethereum, it's there in your account when you log in. There's functionality that could allow you to send and receive it into certain wallet types. As we explored some thoughts around preventing money laundering, preventing fraud, preventing scams, preventing, positioning our clients' accounts as potentially being ones that fraudsters would want to go after. Like you want to design it knowing like, hey, traders are in and out of things, and we want to build it in that functionality. So when you're liquidating positions on the crypto side, the fiat is then swept back into your brokerage account, which is where kind of the USD is held for you. So if you need to use it again to buy another security or another coin, it's readily available. You don't have to, go liquidate over here, and then transfer that money yourself back over to go buy. Like, we want to make sure that it's quick and easy.
Okay, got it. So can you speak a little bit to how Tradier is going to price trading crypto? Now, I know there's an industry sort of, I don't know if it's a standard or not, but I think they trade notionally for the most part is how they price trading. Is that accurate? And what will you guys do differently?
Yeah, there's definitely a few different models out there. So I think, for anyone that's trading kind of Forex, there's spreads kind of baked into some of that trading. Crypto's essentially a lot of the paths that these kind of fintechs are using out there is a spread baked into the quotes that the individual is seeing. Not many of them are super transparent about what those spreads are. They're not necessarily transparent about how different coins have different fee structures that they're baking into it. And the unfortunate reality is, as regulation has slowly tried to creep into it, it hasn't necessarily addressed this side of it quite yet. And so, from our side, the model that we're going out is similar to some of the other ones around. It's baked into the spread. So our initial within the Tradier subscription, 25 basis points is within the spread. As we looked at some of the competitive suite out there, there's ones that are priced 100, 200 basis points, or 1 to 2% of that notional value that an individual is trading, which it's primarily greed that's driving that pricing structure. But overall, we looked at what's enough that we can run a business and what can pass on as much savings to the retail investor as possible. My entire background's in retail investing as a retail investor myself. And so, not only are we building this for our clients, but, selfishly, I want the least expensive crypto solution I could possibly build so that I can use it. And so as we're kind of going down that path, like, pricing's a big component of it. As well as just functionality. So I think if you look at a lot of the other players out there, when they talk about, commission-free stuff, if you go into their user agreements, if you dig into what they're kind of doing behind the scenes with some of the stuff, it can be concerning. And so it's not as though everyone's going through and reading those documentations. I enjoy that for some odd reason. I like seeing that some of these companies are doing that. And, whether it's fortunate or unfortunate, I use a lot of these products that are out there. And so I'm getting to go through some of those bankruptcy trials that a couple of those fintechs are having. Because as a client of them, we're listed as creditors to all of them. And so we get to see how that's transpiring, where two really large retail investing shops declared bankruptcy, and what's going to happen to these coins that these individuals had. The lending side is a whole other atmosphere that got a lot of these places in trouble. And we saw a lot of coins that get pumped and then drop down. A lot of people are referring to it somewhat as the Wild Wild West, and there's definitely lots of coins hitting the market that individuals can trade on different exchanges. So it's something that we take seriously around kind of protecting our clients and trying to protect their assets as they're getting into these volatile and a bit more riskier asset classes. And so, yeah, that's kind of the approach that we're taking on it. I think having a compliance and brokerage background and, entering, I wasn't on the option pits the way that you were, but I started on the desk in 2008 during the financial crisis. And so you get thrown right into the mix, and you get to hear how important, assets are to your clients, who are individual investors just like the rest of us, right? And so that means something to us, and we're here to make sure that we help guide them on the direction they're looking to go.
Right. Okay. Now, is crypto, is it marginable? Are the same risk parameters pervasive in the crypto space as it is in the equity and option space, or is it completely a different animal?
So it's in our offering, it is non-marginable. So think of it as you're buying options, right? It's 100% requirement if you're going to be purchasing a call option. So in that case, or an extremely volatile equity security, like when you think about buying power, treat it as something that we're treating it as something held at 100%. And so that's not to say as more guidance and things enter into the market, that wouldn't be the case. I think as we approach it from a order management system side of it. So I'm on the product team, right? So my job is to help get the product to market and what will that product look like. But there's a lot of behind the scenes kind of functionality that's being used to build this solution. And so order management is a huge component, so that buying powers are accurately reflected, because that's what matters to active traders, and this stuff's happening in real time. And so being able to move funds quickly and efficiently so that things can settle on time. And that's really the big difference, right? If you look at, say it's a cash account and your options are settling in 1 day and equities are in 2 days. Well, cryptos, it's settling in real time. And so when there's no, unsettled funds in that capacity. And so we're looking at some of the other solutions within the margin accounts, and, potentially some derivatives that may come to fruition on the crypto side of things.
Yeah, I was going to ask about the derivative side. So when options are available, they may be available already on crypto. We're obviously going to have those. Is that right?
Yeah, if they're within kind of a regulated entity, right? So I'll be curious where the SEC goes with some of these ETFs that are looking to do spot Bitcoin, for example, and kind of what that would open up. So obviously, being on the crypto side, you'd be buying the coins themselves. But as this market matures a bit, and maybe the regulators will change their tune, you may start to see some spot ETFs, and those would have kind of your traditional options that exist in the brokerage side today. I imagine we'll start to see more things like that happening if the futures exchange start to regulate this a bit more. There's already some futures that are trading on some of these coins, and so that's definitely things that we're looking at as we're looking to expand. But at the end of the day, right, we're here to provide solutions for active traders, and so a lot of the feedback we're receiving is helping to shape the direction that we're going down.
Right. So I'm wondering if we trade options, do we have the ability to make them cash deliverable? Meaning, so you don't have to take delivery. I mean, I always worry about delivery with these sort of things that aren't kind of guaranteed by an OCC type entity.
Well, since we're just making up products right now, sure, we can definitely do it. And if that's what you want, Lex, let's do that. I would say, like, on the crypto trading side of things, like, Lex, you are not responsible for delivering that coin to whoever just purchased that from you or whoever you bought it from. That's the stuff that we're handling. When you think about the different liquidity providers that are out there, you can just go to a Coinbase or a Binance, right? And their exchanges, you can open accounts and trade through them. The way that we look at it is using the solution we're using, you can kind of source liquidity from different venues. And even if you go today and look at like Coin Market Cap, you can look at the different exchanges and what some of their pricing is on certain coins. The size of your trade is going to make a difference. The time of the day, because liquidity is different throughout the different times of day, and since it's a 24-hour asset class, it can make a difference, right? And it's global, and so you have some foreign investors that are up at different hours than we are, who are tapping into the same liquidity pools that are maybe with a Coinbase over here in the United States. So those are some of the things we have to continue to work through and evolve. But the way that we're approaching it is almost like consolidating different liquidity providers so that we can get the best fill that we possibly can on it.
Okay, cool. I'm gonna post kind of a quick comment question. Do you see that one?
Yeah. So is a good question, and it's one that I'm currently talking a bit more with internally. So there's a few things that we're kind of thinking through. The major coins like your Bitcoin, Ethereum, those would definitely be available on day one. So there's probably around 40 or 50 that we have access to, and we continue to add new ones. It's a fairly straightforward thing for us to add some. The issue can come into play with if it's low liquidity ones, it may not be tradable up to some point, right? And then you have to figure out how to handle those sorts of situations. And so, initially we're looking for ones that have deep liquidity, just so that our customers have a good experience as we're launching this thing. But there's definitely going to be more details to follow on it. If there's any suggestions around ones that you or other clients are looking for, feel free just to send them in, and we can, we're keeping a running tally on the different ones that we have going on. There's no like Tradier coin. We're not having our own proprietary coin or anything like that. It's really going to be the major ones that you're seeing. And also the ones that, as we talk to our educators, like we've had some great platforms on the summit today. We've had some great educators on the summit today, and hearing like, what are they interested in? What are their consumers interested in? If you're doing technical analysis, which the majority of the time is a bit above my head on this, are there certain coins where you feel like there's better opportunities utilizing those strategies? And so those are the types of things that we'll take into consideration as we're, adding coins to the offering.
Okay, that's great. So what's the time frame? When do you think this is going to launch? What's your best guess?
Is Dan gonna jump into this thing and tell me?
He's listening in.
He's listening in. Yeah, I'm gonna get a text from him. How's this? As I say this. So right now where we're at, we're doing some initial testing on some of the stuff we built on the order management side.
Yep.
We're going through, in essence, a certification process to kind of go, hey, from the start to the finish, what does that whole flow look like? We know what this is going to look like. We know how this thing is going to function. We know what the features are. We know how all the transfers and movements are going to work. So we're feeling good about, all the requirements to get this thing done. I would say, in the coming months, I'll be kicking the tires on this thing to make sure that any kinks or bugs are worked out on this thing. And there'll be some other internal testing going on as we start to relay this out to, our front end customers. I would say once we start to get this into the API, we'll be reaching out to platforms of ours to also work with them on integrations, just to get some feedback from them as it's going.
Okay, great. And then I think you mentioned this, but I just want to be clear on it. Are you going to be able to have one single account at Tradier brokerage and be able to trade crypto from that account, or are you going to have two? I know most places probably separate that out. Do you have any?
Yeah, from the legalese side of it, it is a separate account, right? Like they're separate from a structure, kind of where they live. From a user experience, it's very clear that it's your crypto account that you're using, but it's all within kind of one integrated platform. So mobile, for example, when you're logged into your Tradier brokerage account, if you have a crypto account tied to that, then you'd be able to trade. And one thing to keep in mind, so say I have an individual Tradier account, I could have my individual crypto account tied to that. So it's kind of one package. The way that I would think about it is all right, I have an individual account at the parent level, and then I have all these different asset classes that I can trade. Legally, they're separate entities who hold it and all of that. But from your user experience, which is extremely important, it's all done in a way where you can move between these things. Got it.
And you said it's the new OMS or whatever you said about the launch.
Sure.
So it's dependent on that, is what you mentioned, right?
Yeah, a bunch of jargon, which just means when you place a trade on any platform or through any external platform, that's coming into our systems, and that's the decision around, hey, is there enough buying power? Where should this thing be routed to? How are we returning the information back to the platform for you to see it? So there's a lot that goes into it, and some of the features that we're trying to bake into this too. If you're holding Bitcoin, for example, and you want to move into Apple stock, we want to just you can just buy the Apple stock with your Bitcoin, right? And so that would be something that's a first in the space. There was a European company that had done it a few years ago. They don't seem to be around anymore, but it's a way to open up, use cases around how you can facilitate trading, but also, do you want to hold Bitcoin? There's some individuals that's what they want to hold as part of their savings, but they may want to use it to go buy a stock for whatever reason. And so we want to be able to facilitate that for them without having to liquidate, convert to USD, and then go buy the stock later on. So just simplifying the process for people, giving more use cases on it. There's different methods of using, crypto in society today. We're just focusing on the trading side of it. So we're not a payments company. You're not going to be swiping a debit card at Starbucks to get some coffee with it. Is it possible? Sure. But we're focused on trading and traders. And so when you look at kind of the features that we'd be rolling out, it's with that in mind.
Got it. Okay, here's another one for you from the audience.
No. So I'll leave it at that for now. There's a lot of ongoing discussions around different things because it's not marginable out the gate. That's just not something that we're going to be to facilitate. That is one of the higher ones that we're hearing from individuals about what they want to be able to do with it, because obviously some people aren't bullish it, and it's just another strategy, right? You want to be able to hit both sides because you're just interested in volatility and not necessarily long-term things. So, no, completely great question. Completely hear you on that one. There's paths we're trying to take to get to certain features like this, but day one, that will not be an option.
No, not at all. That'll be part of our option strategy when we have it.
Yeah. There's, as you grow a business like this or an asset class, it definitely opens you up to other things that you can go down. We could have gone down a path of working with every state, getting our bonds so that we can be a money transmitter. That we wouldn't have crypto anytime soon if we were to go down that path. New York's taking a few years to get approval at best, if you get approval, and so that kind of limits where you can be. So there's a lot of things that we had to work through around how do you get your clients a great product that works and is stable, and you're not just rushing something to market, but not taking an eternity and going down a path that requires a lot more and may not provide a lot more benefits to your customers. So yeah, those are all things that we thought through, but ultimately this is definitely the path.
Okay. All right. One more minute. How did you get so ingrained in crypto? You seem to know so much about it. It's such a new product.
I don't.
You don't?
I don't.
You're faking it, right?
Yeah. So it's I love alternative assets. So
okay.
when I hear day trading, I love selling cash secure puts and covered calls. That's the type of option strategy individual that I am. Sometimes a spread. I love the alternative asset market, and I think blockchain and other changes to regulations have opened up avenues to get exposure to other asset classes. So trading cards, real estate. There's different avenues now. Franchises are now being kind of lower minimums coming to the retail investor. So I love the opportunity to test out new ones. And so back in 2020 during COVID, I took some time and I just started investing. Like for me, the best way to learn anything is to go do it. And so I just started investing. I opened accounts at a bunch of these fintech ones to try them out and see how they go, what was good, what was bad, what did I like, what did I not like. And then ultimately, when I was thinking through what's the next step of my career, I wanted to this was the class that I thought opened up a lot of opportunity, not just to trade coins themselves, but the underlying technology is something that you can use to potentially make the brokerage side a bit more efficient and get active investors access to other asset classes that may not be available. And you say like, well, there's real estate. Well, we have REITs. Like I can go buy a REIT on Tradier if I want to. It's like, okay. There's other, potential things. So I look at, we provide people with the ability to grow their wealth. And they want to be doing it in an active way. And so what else can we bring to the table through these technologies that give our clients access to that?
Cool. All right. Yeah. You know the deal. It's we're on the time limit, Stefan. Thank you so much for coming on and giving us the info about Tradier crypto. Yeah. That's awesome.
Do I win a t-shirt?
You win. Yeah. You're an insider. You win a t-shirt for sure.
Someone asked if you had a signed shirt. I didn't see your answer to that. So I want one of those signed ones.
All right. That was all really good stuff. Very, very, very smart stuff. I love it.
All right. Appreciate it. Right. Thanks for having me.
We'll talk soon. Bye.
Cheers. Bye.
All right. Welcome back. Here we go. We're getting to our final guest. Good friend, a long timer in the industry, Mr. Henry Schwartz. Henry is Senior Director and Head of Product Intelligence at Cboe Global Markets. Well, there's a whole bunch of Information Solutions Group. That's the longest title I've ever seen. He's a veteran of the equity derivatives markets. He came to Cboe following the acquisition of Trade Alert, which was his product that Cboe now has, which is an order flow tracking platform. Tremendous platform. And, Henry has such insight into order flow and all the data. Let's bring him on and say hi to Henry. There you are. Good to see you, Henry. How are you?
I'm great, Lex. Thank you for the intro. Good to be here. Although I need to give you an updated bio because I got promoted, so now I'm a vice president.
Oh my
instead of
God.
a senior director. We changed the name of the department from Information Solutions to Data and Access Solutions.
Oh my God.
I
I'll
think
do that for next time for sure.
everything else was right, but I'm very glad to be back, and I was listening as much as I could today.
Mhm.
And I don't know if you saved the best for last, or you just kind of figured you'd help me out and put me on. But I'm glad to be here, and
No.
and happy to kind of show off a few things. And
Good. Let's do it. You know, you got maybe 40-ish minutes, 35 minutes. I know. Are you going to share a screen? Well, let's get that.
I am going to share a screen. A couple
Do
of
that
different
now.
Let me try.
And everyone, please shoot some questions in the comments for us for after. For Henry, Henry, what's your nickname, Mr. Order Flow? I forgot what everyone calls you.
Mark Longo called me the Flow Master.
The Flow Master, that was it. I couldn't remember. You
Sounds
are
like
the Flow Master.
a good plumber. Can you see that?
Oh, let me put it in. Hang on. There you go. That's what you need?
Hey, that's what I need, and then I got stuff behind it, but it's all going to be on this one screen.
You got it. I'm going to jump out so you can take the show, and if you need my help, just yell, and I'll jump back in.
Okay, I will. Great.
All right. Yeah.
So thanks everybody for sticking around for me. I've been in the business for 30 years. As Lex said, I came to Cboe about 2.5 years ago when a company that I founded was bought right in the middle of COVID. But all I've done for I traded for about the first 15 years and then of my career, and the last 15 years has been order flow analysis. And I know that the theme of today is technical analysis, and I do have some thoughts on that. But I want to show off first a couple of slides. So sometimes I do a deck with like 35 slides. I'm going to spare you some of that today, but I do have a few things to show off because, as I said, I pay very close attention to options data. Our markets put out an immense amount of data, and I just presented some slides at the Cboe Risk Management Conference last week in Iceland, and that's what I'm going to start out with. I just want, and the theme of that conference was really kind of like what the heck happened over the last couple of years. And so I called it While We Are Quarantining, and I will explain what the visual aids are on the slide. They help me remember the data. I'm going to go through this quick because I know I want to get to some trade analysis and some option sentiment analysis in the context of technical, thinking about it from a technical standpoint. But just kind of a real quick, how big is this market versus what it was just a couple of years ago? So call volume today, average daily volume this year is around 21.4 million contracts a day compared to 10 million just 2 years ago. So this is more than doubled, up 111%. Put volume also up about 110%, so more than doubling there as well. What's interesting is put volume is now running at an all-time high on a daily basis. Call volume is not. Call volume last year was about 24 million contracts a day, as the kind of the COVID meme stock kind of bull market, events all kind of coalesced. Total option volume, 40 million contracts a day, all-time record. We're going to hit 10 billion contracts a year this year, which is a new all-time record. Records all over the place. We had a couple 60 million contract days at the beginning of the year and a 50 million contract day last year. So incredibly busy markets, more than double in 2 years. Average daily spot volumes, the underlying share volume, is also up to 11 billion shares a day on average. That's up 71%. So one thing that kind of jumps out at me is the difference, so option volume has more than doubled. Stock volume has not more than doubled. And that kind of, the reason for that is because we're seeing a lot more day trading of options. So, I know most of you are kind of, I would call you, we call really sophisticated option traders pro-tail. So they're retail, but they're kind of, edging into the professional skill set. It's a good thing. Average daily option premium is $23 billion a day now. That's tripled from 2019. Okay, $23 billion a day is $6 trillion a year. Just so you know, average daily count of trades is over 5.5 million trades per day. 2.5 years ago, it was 2019 average was 1.7 million contracts a day. So a tripling of kind of the number of executions. So what you can see there is the average size is shrinking. That is a consequence of more small account activity, more algorithmic approaches to the market, kind of orders just getting smaller. Average daily open interest, 420 million contracts a day. That's up 46%. So same deal, more day trading of options. You don't get as much open interest bump. Also, the 0-day options trading phenomenon, meaning like, the contracts that expire today, seeing incredible amounts of volume, that volume never becomes open interest, right? Because it expires before OCC would be able to publish open interest. The number of listings that have options on them now is almost 6,000, very close to 6,000, from 4,300 pre-COVID. So this was actually a multi-year low, and now we're at an all-time high in terms of the number of listings. That's coming from new stocks, new SPACs, and a lot of new actively managed ETFs. These target outcome ETFs basically are ETFs that have optionality embedded in them, like basically they call them buffered returns. So you buy an ETF, you can't lose more than 10%, but they sell some calls to basically cover the cost of that put. The number of listed contracts across all these underlyings and all these new expirations is 1.66 million. That's a record. That was the record. That was the September expiration record. We'll probably have another record at the December expiration, but 63% higher than it was. We used to always talk about how we thought it was kind of a dangerous point when the listings were approaching 1 million, because it's a lot of, Lex, you guys know this, running a brokerage, managing the number of strikes, the way you have to display that to your clients and let customers dig through an option chain when there are, literally millions of contracts available, takes a different approach. And then the number of options max VIX this year was 3645 just a few weeks ago. That's up 43% from the highest VIX in 2019. Although I think most of you will point out we did hit 82 in between these 2 years, right? We hit 82.69 in March in the COVID, kind of the depths of the COVID sell-off. And the number of expirations, 74 expirations out there now. So like if you go and you look at SPX or SPY, there's 30-something expirations, right? Cboe has Tuesday, Thursdays, as well as Monday, Wednesday, Fridays in SPX now. So there's an expiration every single day. That goes out a few weeks. And other products have also added in weekly options over the last, really over the last 7 or 8 years. And then now I'll give you really quickly why the pictures are here. 21.4 million contracts is the number of Twitter followers that Cardi B has. 109% increase in put volume is the increase in Guerlain Bleu, which was Queen Elizabeth's perfume. That's the sales increase since she died. 40 million contracts a day is the number of pickleball players predicted by the U.S. Pickleball Association by 2030. Average daily volume for shares of 11.1 billion. That's the weight of the Great Pyramid of Egypt in pounds. $23.9 billion, $6 trillion a year. That's bigger than the GDP of Japan. Makes it the 3rd biggest economy in the world, if you think about it that way. 5.5 million trades is the number of daily riders on the New York subway where I live. That's actually pre-COVID. Now it's like 3 million. Open interest of 421 million contracts is, that's the size of the lottery winner in California, Mega Millions last April, $421 million. 5988 listings. This one won't matter to you at all because this is how many miles we were from Florida when we were in Iceland. It went over well at that conference. Number of listed contracts, 1.66 million. That's 238 million Icelandic krona. 36.45 VIX. That's the price of Bitcoin in 2013. I know we just heard something about crypto. And 74 expirations. That is the age of Ted Danson. Okay. Now moving on to option sentiment analysis. I know the base here is talking about technical analysis, and I will tell you something. I started in the options business in the 90s. I worked for Hull Trading, a spectacular market maker on the Cboe. Technical analysis was a no-no. It was voodoo. If you're kind of a true options pricing geek, it's hard to reconcile a log normal distribution of returns, which is what Black-Scholes assumes, with this concept of support, resistance, some of the kind of more esoteric technical chart patterns, this and that. So I was like, okay, this is all bullshit. However, I have two things that happened to make me a little more of a believer. One was in a class at NYU. We had a guest speaker, which was Ralph Acampora. I believe he was the analyst at UBS or maybe another bank. And he came in to talk about technical analysis. And he said, whether you believe it or not, think about it from the standpoint of supply and demand, right? There's a lot of people that think Apple's kind of a little bit expensive up here. They're not going to be buyers. But if Apple goes down to 130, all of a sudden they're like, oh, I was waiting for this. Finally, I'm going to be a buyer. That's some demand. When it gets up to 175, there's people who are happy to start unloading it there. That's your supply. And that I kind of understood. I'm like, okay, it is simply supply and demand. And, that it works in at least in a framework of how to think about it. So I'm not a huge fan of some of these other technicals, Fibonacci, clouds, and this and that. However, I do acknowledge the fact that if a bunch of people are looking at it and everybody agrees that there's going to be demand at certain points. And the other kind of little data point that I have is, so with TradeAlert, which was this data company that we were selling, that basically I'll show you, it alerts on option activity. I was in Boston talking to a big hedge fund manager up there who's since retired and moved to Florida, but he owned a baseball team. And I'm kind of showing this off and that off, and this was not an option guy, this was a stock guy, but he was willing to listen to me. And I said, oh, look, here's an example. Oh, here's a trade that just happened. Somebody bought, 12,000 calls in XYZ stock, and here's the strike, and here's how we model the buyer versus seller, so we can tell it's a buyer, we can tell it's new open interest. I'm going to show you that. And he says, hang on a second, and he turns to his computer and he buys 100,000 shares of this stock. And I'm like, okay, that's you barely know what I'm talking about, but you're certainly willing to swing around some size. And he said, no, it's a DMARC 6 or something. And I was like, I do not know what language you're speaking. And he started talking about some technicals that are published by a company. It's kind of a proprietary approach. But the reality was, is this stock was already on his radar as a stock that was kind of towards the bottom end of some sort of a channel or something. And this option trade, in his mind, he's like, the reason they bought those calls is because they think this is a good time to get in, and they're using these calls as a levered way to express a view, which leads us into what sentiment analysis is all about. So there's some assumptions, and I've been in this business for a long time. I strongly believe all of these things are true. The basic assumptions are that option traders are smart. Okay, options are complicated. You don't have a lot of poorly capitalized, dumb traders in the equity derivatives market because they don't last very long. So there's a reason somebody pulls the trigger on an option trade. Every option trade, meaning there's 5 million kind of data points a day that somebody's made a decision to get into the trade. So I do not think that it's a good idea to ignore the option flow and what is happening in the options markets, which is why when I go talk to a stock trader who barely knows options, who says, I'm scared of options, I'm like, well, you don't have to trade options, but you should probably pay some attention to what is being done in the option markets, because the tail can wag the dog, especially in options or futures, right? Is because that's kind of the first point where people deploy capital, and then you might go into the stock itself or the ETF, whatever. So every trade contains information, and that information can be directional. Well, the information is directional, meaning every option trade kind of has one direction that works better, right? Every option trade has timing, right? When does this thing expire? Like in a week or in 7 weeks? And when are earnings? Is it before or after earnings? The timing matters. The urgency of a trade you can identify in the in the data, and I'm going to show it to you. Some trades are kind of like, yeah, somebody's bidding for this, and they don't seem to care too much about getting filled, in the next 10 minutes or 2 hours, versus somebody just paid through the offer for a large chunk of calls, and I'll show you the difference. Sophistication, there's options. Like I said, there's 40 million contracts a day. About a third of that is trading in complex orders, vertical spreads, calendar spreads, butterfly spreads. So there's a difference there, right? Somebody aggressively buying a whole bunch of calls is a totally different story than somebody, buying a 1x3 spread, right? There's a different kind of level of sophistication, and you look at the trade and identify what the initiator is thinking. And then there's implied calculations. So I'll show you on the data. The data itself is the data, right? 6,000 of the Apple June 160 calls traded $1. That's the data, okay? But there's a whole bunch of things that you can apply out of that, impact and everything else. But also there's some more subtle things like what's the interest rate that is implied in this trade. So you can actually, if you guys play around with an option model, you know what the inputs are, right? One of them is interest rates, one of them is dividends. Those are actually interest rates, dividends, and volatility are kind of the only hard ones. The rest of them are all visible to everybody. So you can basically solve for any of them by holding the other ones constant. So you can look at a trade, especially a RevCon type of trade, which is a borrow trade, and say, oh, somebody is basically locking in a borrow in GameStop at 14%, something like that. So implied calculations matter. And then really the goals that we have when we're looking at options flow is to make better decisions, to look for opportunities. I trade off of this stuff. We have most of our customers trade off of it. Some of them are brokers, and they're talking to customers that are trading off of it. But there's short-term impact. There's longer-term. Both of those kinds of trades you can find by understanding the option flow and paying attention to it. And then this one to me was kind of the genesis for building the whole system in the first place, which is I don't want to be on the wrong side of something. So if I'm getting long a stock and then all of a sudden big call sellers and put buyers come into that stock, I have to kind of think about that, and maybe I'm on the wrong side of that in terms of direction or delta. And the other way to think about it is, volatility whips around, and different traders have different kind of levels of understanding of volatility. I think it's important to understand vol. However, it doesn't answer every question, and you can kind of spend forever trying to understand every little nuance of forward volatility and earnings volatility and all sorts of things. To me, volatility is mostly it's a measure of supply and demand in options, and it's also a estimate of what the market is expecting in terms of how volatile a stock is going to be. Okay, so there are times where you'll look at a position and you'll be like, wow, the vol in this thing is kind of low, and I'm going to go buy it. Well, I don't want to be on the wrong side of that. If somebody's buying the vol from me because it's low, I just want to at least know, like, ooh, okay, it's probably not going to get any lower. So I don't know if they're right or not, but I'm probably not right. Maybe I'll get lucky and nothing will happen. So avoiding the wrong side of positioning, I think, is very important. And then just learning, just getting better, because every trade that you see, somebody probably smarter than you, smarter than me, has put some work into it and said, okay, I'm willing to deploy capital, cross a bid offer spread, assume risk, and I want to know why they did that. Okay, so quickly, just and we will get to some live data too. The anatomy of an option trade. So, like I said, the data is the data. 1,500. This is from a month or so ago. 1,550 of the Activision Feb 22 puts, 67F puts traded at 410. You're going to see that anywhere on a Bloomberg, on your Tradier terminal, any platform should be able to show that to you. If it doesn't, then you have a bad platform. The rest of this is kind of the good stuff. So, and this is how we approach it. And we're happy to kind of sell our Trade Alert terminals, terminals to people, but that's not what I'm here for. I'm here to just kind of show our approach. We have a reference theoretical value that's available to us, so we can actually say, look, the market in this trade, in this contract, was 4 to 415 before the trade happened. Okay, so this is actually slightly above the midpoint, right? The mid is 407.5. So trade at 410. So it's a little above mid. Okay, that's why it actually says ask side, but it's also 2 cents above the theoretical value. This theoretical value is a fitted value. Lex and Mike Khouw and everybody that all the option guys you've been talking to today kind of know how market makers fit their prices all day long. They have very sophisticated systems. Nowadays, it's billion-dollar companies that tend to do it, like Citadel, and Susquehanna, and Jane Street, and all these guys. But the basic function is the same. You're trying to fit a smooth, non-arbitrage volatility curve to become an options surface, which is then used for pricing theoretical. So you have some information here and now. So, well, it traded closer to the offer than the bid. So that kind of leads me to think it's probably a buyer, because the buyer has to pay the offer. In this case, they did a little better than that. It was 2 cents above the theoretical value. So that is also a vote in favor of this being a buyer. And then there's one other piece that matters, which is the implied volatility of the trade, which was 42.2, which was up almost a point from the day before closing vol. So now you have 3 points of reference to help make the determination that, like, oh, somebody bought these puts, okay? And then there's a little more information too, which is it was $636,000 in premium. Okay, that's just price times size times the multiplier. But you want to get that, you kind of want to be aware of that pretty quickly. It traded in the form of an auction, which is a mechanism in the options markets nowadays where a lot of trades, rather than somebody just lifting the offer, they automatically go into this price improvement auction. It lets more people respond, gives the buyer or the seller a chance at a better price. One thing that's important, it also kind of, it clarifies kind of, okay, this person was a buyer at any price, but they went into an auction. They happened to get a better price. The volume of this contract was 1,600, of this option was 1,600 contracts at trade time, meaning this is the biggest trade of the day. Okay, this includes this. The open interest was 6,000, so that's an important piece because you're like, well, is this a new money going into a position, or possibly is this somebody unwinding, right? Somebody covering a short. And the open interest tells you that it's actually possible this guy or girl was closing. So it gives you a little bit of like, okay, before I panic and think that Activision's going to go to zero because somebody's buying, $600,000 worth of puts, you have to take a step back and go, well, it's possible they're closing, and actually you can kind of go and backtrack and try to figure out when they got in. I'm not going to do that because we don't have time, but it's doable through the data, right? Because as long as you have all the trade history, you can see when they got in. And then the delta of the option was 48, the gamma was 4, the share impact was 75,000 shares. So this share impact is just the delta, 48 times the size. So meaning that the market maker or market makers that took the other side of this trade, okay, so somebody bought puts from you. If you're the market maker, you're happy to sell them if the price is right, but you do need to go hedge your delta just in case something happens. So most market makers hedge, not necessarily in the stock immediately, but they're kind of unloading the equivalent of 75,000 shares or $5 million worth of stock. So this is not a little tiny trade. This is a pretty solid trade. And then this is $14,000 of Vega. Vol traders think in Vega terms all the time. What that means is that if the vol from this position goes from 42.2 to 43.2, the buyer is going to make $14,000. And then here's where the stock price was. So all of this information, is telling you something. Like, you now know something besides the fact that just 1,500 of these puts traded. You now can make a very solid judgment about what the motivation was, which one was the buyer, was the initiator buying them or selling them. The only thing we don't really know here is, was it a opening or a closing trade? Okay. I grabbed a few trades in Colgate from September 9th when I made these slides, and then I want to go through them, and then we'll actually look at some real data. And I will do my best to tie it back to technicals. So just as an example, so here's a kind of a bunch of trades, some decent sized trades in Colgate from the 9th, and think about it all from that same kind of framework I was talking about. You can see that they're all above the theoretical value, right? So in time order, it was this middle one came first, and then this one, and then this one. But this is a pretty consistent call buyer, and there's not a lot of time happening in between these, right? So they bought 2,500, and then they came back and bought another 2,100, and then they bought 3,300 towards the end of the day, or a little bit later, only a few minutes later. The volatility of the trades, was higher on the day. This last one traded on the floor, which actually tells you something important, which is the information is not quite as reliable as it is on these multi-market or electronic trades. It's a nuance, but it matters, because if you're comparing a trade that printed on an electronic exchange versus a trade that printed on a floor, you're going to trust the electronic trade a little bit better. And then when you aggregate all the data up, which is kind of the fun part, right? Like, here's on a trade by trade basis, I can tell you, ooh, looks like a buyer. Ooh, looks like a buyer, and it's opening. Ooh, looks like another buyer. In this case, if this was the only trade I saw, the very last one, I'd be like, I can't quite tell. The vol's up, so it might be a buyer. However, it traded mid. It priced exactly at theoretical. So there's only one factor here that tells me it's a buyer. The other two are more clearly a buyer. And you put them all together, because although there's a lot of participants in the listed options market, the flow like this is going to be the same buyer. Okay, if you're looking at something like Apple or SPY, you've got a lot of different participants at the same time. As soon as you get into kind of the single stock world, it's a much smaller universe. So when you roll all this data up, okay, so by the end of the day on the 9th, we had 19,000 calls had traded, which is 8 times normal. So again, it's a quantitative characterization of what's going on. Like, hey, 8 times. Think of it as if you're a broker and you're talking to a customer. Like, listen, the call volume in Colgate was 8 times normal today. It usually trades 2,200, but today it traded 19,000. By the way, the put volume was crud. 779 puts traded. So the focus was all on the calls. Combined, the volume was 6 times normal. Okay, between the calls and the puts. And then there's a piece of information that comes out overnight. So you don't know this at the same day, but you do know it the next morning, which is how much of the flow was customer versus firm versus market maker. So what you kind of want to see in a normal trading situation is customers and market makers. Firms don't usually get too involved, especially in single stocks. In ETFs, they do. Okay, a couple more little nuances, and then some real-time stuff. The market's closed. It's not that real time. See, Lex, if you put me earlier, we would have had tradable action. Colgate, so this is one of those trades, the 2169 lot. So you notice back here, it says multi for the exchange. Okay, in the U.S. markets, there's 16 exchanges. Next year, we get another one, so it'll be 17. Cboe is the biggest, and that's where I work. But you've also got Amex, Philly, NASDAQ, MIAX, Fox, there's a whole bunch of them. When it says multi, that means that you can kind of see what's going on here. So 2169 traded, the quote was 110 to 135 before, and then all of a sudden you start getting kind of simultaneous trades. You see what's happening here? So like 98 on EdgeX, that's another Cboe exchange, 34 on C2, more on EdgeX, then GemX, then MIAX, then MPearl, that's Miami Pearl Exchange. And so I chopped out a piece of it. There were 44 pieces to this sweep that touched 14 exchanges, and it took less than a second. A lot of these we see are 2 or 3 milliseconds. So these routers are very, very fast. People have spent a lot of money building these shotgun routers that go and grab the liquidity available. And so again, it tells you, this kind of goes to that point of urgency, which is like somebody paying the offer across 14 exchanges is a little different than somebody just sending one order to the Amex and letting a broker work it. So this is the last slide, and then I'll show you a few real-time things, and with a technical angle, and then I'm gonna be out of time because I talk too much. But just kind of showing one of the impact. You know, like I said, delta impact is how much stock there is to trade. Okay, so that's an important piece. The other impact is in volatility space. So after this trade took place, you ended up with a volatility structure that looked like this blue line. That was the current day, okay? Which actually was lower than the day before. So what that's telling you is, like I said, volatility is easiest to think of as supply and demand, okay? It's also, you know, when the markets get scared, volatility goes up. But outside of that kind of dynamic, it's just supply and demand. So when you see a spike in a certain term, it tells you something like there's something about the 49-day kind of part of the cycle that that somebody's interested in. And so, and when you go look, these were Octobers at the early September, so that was around the 40-day term. Okay, I'm going to close this and show off a few real-time things. Oh, let me show one other thing on that Colgate trade specifically. So this this little chart here is the intraday for Colgate on the 9th. And you can actually see, I'll zoom in on it. This is trade alert stuff. So if you want to play with it, reach out to me or call Lex and he'll point you to me. But you can see the spikes in call activity around 10 in the morning. That's those trades. You also can see what's happening with the stock. So the stock is the blue line. And before the trading, it was 77.5. And after the trading, it was actually up about $1. Okay, so now this is a put buyer, right? So this is not the panic reaction. Okay, and this is important to understand. What you're looking for is kind of aggressive activity, and this did look like aggressive activity. However, I said it could be closing, and this kind of makes sense to me from a closing standpoint. The volatility did go up. That's the blue line. So the at the money vol went from 20.5 to 21.5. That's the reaction of the market going, whoa, somebody's coming in to buy these. They back off their pricing. They basically raise their vol levels through supply and demand. But if it's all demand, the price is going to go up. So vol went up, but the stock didn't react with kind of a downside move. So there's another way I would look at this and go, yeah, there was a put buyer, but it doesn't actually look. It doesn't actually look like a put buyer that kind of spooked anything. Okay, I got probably a minute or two, and then Lex is going to kick me off. But a couple of things that I like to look. So from a technical standpoint, I'm going to look at Credit Suisse, just so you know what we got here. So this is the little trade alert terminal. This is LiveVol, which is another Cboe DNA market data terminal, right? So LiveVol is more of a comprehensive. It does a whole bunch of things, volatility, skew, everything basically. Whereas Trade Alert is looking at one specific, does really one specific function, which is order flow analysis. But if you look at something like Credit Suisse, okay, his earnings tonight, or no, tomorrow morning, okay, and Credit Suisse is a bank that's gotten just annihilated in the last couple of years. Look at the activity today. 46,000 of the 6 strike calls have traded, and 98% of them traded offer side. Okay, it's a very directionally bullish trade. If you go look at the individual pieces, you can kind of see like, wow, the largest chunk was 33,000 in a sweep. That's what this this ISO opening is. That traded from 14 to 15 cents. That's how you get an average price of 14.9. But that came after these other sweeps, right? So that's a big position, and so when you sum it up, it's 98% of that was offer side. So there's another way you can look at it, which is when you sum up all the delta of that activity, you get almost 1 million shares. Okay, so you can look at delta on trade by trade, but if you just add it all up, calls being bought as positive, puts being bought as negative, and vice versa. This is 838,000 shares. Okay, and so if you compare that to what trades, average daily stock volume in there is 22 million shares. So it trades a lot, but still 800,000 shares is a pretty decent chunk. Okay, so that's significant. And then try to tie it back to technicals. If you put things in context, okay, just in a range sense, okay, where has this stock been? So the 52-week low for the stock was 392 at the beginning of September. Okay, it was 11 bucks a year ago. So the stock's in the 8th percentile. It's gotten completely creamed, and so what you're seeing is a call buyer into earnings when the stock is been really beat up. And there's kind of one last piece you can put on it, which is what is the market expecting in terms of an earnings move? And I think, Lex, I think we've talked about this. I know, believe you have the functionality to show it too. But the market's expecting a 15% move based on the option straddle. It's not that hard. And you can put that in context with all the other moves. Okay, this thing has never moved more than 10%. Okay, so that's a pretty hefty gap. Basically, the market is bracing for the biggest post-earnings gap since, at least in the last couple of years. So I would look at this trade. I'm actually, at Cboe, we're restricted from trading a bunch of the financial names, so I'm not allowed to trade Credit Suisse. If I was going to go put something on, I would look and say, okay, it's a $5 stock. Somebody's buying a bunch of 6-strike calls. Okay, maybe it's just a flyer, but it's a pretty decent trade, because even though it's only 15 cents, it's 15 cents times 46,000 contracts. So, so I can't do it in my head, but so almost $700,000. So that's how I look at things. I hope it's been helpful. I'm happy to take questions, but we probably don't have time.
Yeah. Hi, Henry. How are you? Can you see me?
I can.
Okay. Yeah. Thanks for that. Yeah, we ran a little bit over. I'll let you go a little bit. Oh, where'd you go? Henry left. Well, if he comes back, we'll thank Henry to his face. So, yeah, Henry is a wealth of information. His platform's awesome. His Trade Alert. It's actually Cboe's platform now. I think I was going to ask him when he came on. I think you are able to get it. It's it's not exactly the inexpensive. There's a lot of data that runs through it, but really a great product with unusual activity and what have you. All right, well, let's close her down. We're going to bring Dan Raju, our CEO, back in for a little closing thoughts. Oh, hold on a second. Henry's back. Sorry, Henry, you disappeared on me.
Yeah, that was my error. Sorry.
No worries. I already signed you off, so I already said goodbye to you.
I mean, the good stuff was over, but I'm happy to take any questions if you had any.
Yeah, I kind of said we probably have to get rolling though. So okay. Next time we'll do that. Thanks for everything. It was awesome. One quick one though. Can the retail folks get Trade Alert, or is it just for institutions, or is it what's the quick answer?
No, we are happy to handle retail. It was designed for institutions, but so my caution would be like you should know what you're doing before you call us. But if you go to trade-alert.com, you can request a trial, and we're happy to turn people on and help them make some sense of the options market.
Okay. Terrific. All right. Well, you and I will catch up later. Thanks for doing that. That was awesome. You're always a wealth of information. Thanks so much. And we'll see you soon. Bye, Henry. All right. Dan's going to come on, give us some closing remarks. I'll shut it down at the end of that real quick. Probably have about 5 minutes left or so. And, thanks again for everyone joining. Here's Dan Raju. Hi, Dan.
Hey, Lex. How are you?
Good. So I'm going to turn it over to you, man. I know you have some closing remarks to make.
No. Yeah, thanks everyone. Looks like we had a great show. I mean, it was amazing. Lex, you do an amazing job. I don't know how you put all this together. It's amazing. Hey, so, Henry, every time Henry called himself the flow master, which is amazing. But Henry's presentation was amazing. I was trying to suck up as much information as I can. And hey, and all the presentations today were really, really amazing, right? I mean, I think we put a great presentation together. I mean, Carter and Michael to start with, then Henry, Rob, Rick, Don, Chuck, Jason, Peter, Pete, great presentations. So, really wanted to, say thank you. Thanks for everybody who put so much time and effort to put this show together, right? I really, really appreciate that. Thanks for taking the time. It means a lot. We put a lot of effort in everything that we do. We try our best to go ahead and, make sure that we are providing you content that actually is of quality. So thanks for attending the event. I really, really appreciate that. In addition to thanking all the folks who presented and all the folks at Tradier who put the event together, special thanks to Cboe for supporting us on these educational initiatives. So it's been a great event. It's been one of our largest events that we have done. Thank you, everyone. I know we'll be meeting quite a few folks in December. It looks like we are having three events with our partners in December. Can't wait. I'm sure I'll be meeting some of you folks. We've got the Traders Army folks. You've got Eric from the Trader Oasis side, and even Todd, and all these amazing events that are occurring in December in Vegas. So looking forward to it. Once again, thanks everyone. Thanks for taking the time. I hope we did a good job. When we started this, we want, the first two events we did were very generic. When we polled our customers, they said, hey, why don't it's more valuable to go specific? So that's when, how does technical analysis apply to your options trading was an idea that everyone came together. We put a great, we thought we put a great roster of speakers together. Hope you folks enjoyed it. And thank you again. Thanks for taking the time. I know I'm the last person between you and your time. So I'm just going to wrap it up and say thank you to everyone. Lex, you might be muted.
I'm good at muting and unmuting. So, all right, Dan, thanks so much for all your remarks. It was a great event. Everyone, great. We want to remind you, subscribe to Options Brew TV. I'm on there live on Thursday mornings. So would love to have you. We always have interesting concepts to talk about. Love to have questions on that as well. So would love to have you there. Thanks, as Dan said, to our guests. Everyone was outstanding. Thanks to Tradier, Cboe, terrific partners in this. Really a great deal. And thanks to Nikki C Clothing for giving us the shirts to give away. Really great stuff. And don't forget about that promo. And the winners of today, if you stay tuned, we are going to send you an email. We're going to need sizes and a little bit more information from you. We'll email you to get that information. Other than that, and people keep asking about the recording. It will be on Options Brew TV and on the Tradier YouTube channels, the recording. So look for that in the coming days. Okay, so everyone have a great day. Have a great rest of the week. It was awesome. We look forward to doing this again. So have a wonderful week, and thank you for coming.